Welcome to Ore Day 2022. Introducing Stewart, Chairman of the Ore Group.
Hi, I'm Stewart, founder of the Ore Group, and I'm very pleased to be back for another Ore Day. We have a terrific lineup of speakers who discuss their global macro views and how these events impact the metals we need to protect your wealth and power our lives. Then, of course, we're going to profile the Ore Group's portfolio companies to show you ways to invest in and gain leverage directly to these metals. And it's these very metals that I find so interesting because of their volatility and their inevitability. They're inevitable because investing in the periodic table means these elements are not going away, they're static. The only thing that changes are their supply and their demand. And the volatility is the thing that presents the opportunity. If you can recognize these cycles, you can get in at very cheap levels. So if you can make a well-informed and patient bet on what is an unloved metal, you can sit back, wait for the wave, and in time, returns can be unlike anywhere else on the investment horizon. But it is, of course, easier said than done. Now, over the past 24 months, the truth has been completely stranger than fiction. But if you look back, history is full of black swan events, and they're actually a lot more common than we think. Few could have predicted that the West would be wealthier, at least on paper, as it endured a global economic shutdown, or how well the physical commodities performed at the same time during this period. Now, to me, the question is not what happened yesterday, it's about what metal is the next mover. And given the chaos, confusion, and inflation, gold looks incredibly interesting, especially if this turns out to be the crescendo of a monetary policy experiment that began back in 2007. We've seen debasement's effects before, and we know how it ends every time. The only question is when and what can you do to protect yourself? I can think of no better insurance than gold. And while outcomes are always uncertain, I look to the history books for a reasonable guideline on how the masses and the powerful react during times of war, pandemic, inflation, and megalomania. And now with deglobalization, the trend, the West must reprioritize what matters most to it. To me, it's a return to real productivity if we are going to compete with China and Russia, who are currently sitting back and watching the West divide and conquer itself. And under this status quo, the West is surely to lose its global status. Perhaps then we'll see a reversal of policy back towards growth. But real change seems to only come through crisis, and in this case, it may be too late. Another dominant theme for the metals is climate change policy and the mandated elimination of fossil fuels. There are huge pools of capital and powerful politicians riding this wave. But how realistic are their timeframes? Have they really done the math on the amount of metal required to replace the energy that they seek to eliminate? I don't think they have. And I think the talk of energy transition is far too cheap and far too easy. Few realize that building the new energy green infrastructure will require a supply of metals that is simply not in the pipeline, and that the world is many years behind these rosy forecasts. We're more likely to see a trend reversal before the transition truly takes hold. But make no mistake about it, it will occur, and when it does, this transition will require a tidal wave of capital and a change of attitude towards permitting. That's the exciting part. Just like commodities, I think it's inevitable, and its impacts will be more profound than the Industrial Revolution. But to get there, we're going to need copious amounts of uranium to produce this green power, copper to transport it from A to B, and nickel and other commodities to store it. Otherwise, we're back to coal and other fossil fuels. No investment decision is entirely safe, but the Ore Group has bet on these metal building blocks that the world relies upon and consumes. This is our investment thesis, and this is what we're going to talk about today at Ore Day. So please stay tuned and enjoy. Thank you.
Introducing James Puplava, President of Financial Sense Wealth Management. Joined by Anthony Moreau, CEO of American Eagle Gold.
Hello, my name is Anthony Moreau. I'm a host of this portion of Ore Day. With us here today is none other than Jim Puplava. Jim's based out of San Diego, California. He is an expert on the economy. He's a financial planner, financial advisor. He's a media personality. He's got a podcast. He's got a website. He's a founder and the CEO of Financial Sense Wealth Management. He's a very smart individual and someone that I'm looking forward to listening to. Jim, thank you very much for joining us.
Well, thank you for having me on the program. I guess maybe the question we ought to start out with is probably what everybody's wondering right now, which is inflation. So it surprised a lot of people, but 2 years ago we wrote about it and we saw this coming. And I think, Anthony, one of the big things that we're seeing now versus, let's say, what we saw in 2008 when the Fed was printing money, but why didn't we get the kind of inflation that we're seeing now at the gas pump and just about everything that you're buying? So with COVID, they were shutting down the economy to control the pandemic, but at the same time, they were passing these massive, and I mean massive, stimulus bills. I think the total was somewhere in the neighborhood of 7 trillion. So they were putting money into people's pocketbooks. So they were giving them more money to spend. At the same time, they were cutting supply. They were shutting down the economy, shutting down manufacturing. I don't care if it was here or it was in China. So, the classic definition of inflation is too much money chasing too few goods. So here we are in 2022. We are seeing inflation rates. I think the last print was like 8.3. Many think that is understated. I think it's over 10%. I think we're in double digit territory. I mean, just look at anything you're buying today, whether it's gas at the pump, food at the store, insurance premiums, doesn't matter what you're spending on your utilities, all of that. So we've got this inflationary environment. And I think one of the things that this did, it really surprised the Fed. The Fed thought, well, when the supply chain issues get resolved, the cost of goods will come down. Oil will remain low. This is going to be temporary. So last year, the key word was transitory. This year, the key word is called soft landing. And in my career, Anthony, probably spanning 4 decades now, I've seen the Fed do a soft landing once. That was 1994. So it's more likely we're going to get a crash landing. And I think what we're going back to is a market very similar to what we saw in the late 60s going all the way up to 82, where you would have a couple years of a bull market run, stock market would do well, inflation would continue to rise along with interest rates, and then we'd have a bear market. Then we'd have another bull market and a bear market. So if you look at the stock market, and we have a chart that you'll include in this, we show the stock market from 1966 to 1982. Basically, it was stuck at 1,000. It'd get up to 1,000, we'd have a correction or a bear market. It'd go back down to 600, go back up again. I think that's what we're headed into for this decade.
So Jim, how do you see this getting corrected? What's the fix here? How long is it going to take?
I think by the time we get to September, it's widely expected the Fed will raise interest rates another 50 basis points this month. They'll probably go again in July with 50. I'm questioning whether they're going to go in September. I think a lot of it's going to depend on what inflation is looking like. I'm sure the Fed would like to say, hey, we've tamed it and go on pause, because they know if they keep raising interest rates, and we've included a chart of our debt, both government debt, consumer debt, and corporate debt. There is just so much debt out there, Anthony. I just don't think we can see this economy withstand the kind of interest rates that we saw in the 70s, when you got 10-year treasuries got up to 15.5%. If they get to 2.5% this time around, they'll be lucky, because you're already starting to see a pullback in housing. We've gone from bidding wars to people reducing prices. We don't have a big inventory build in real estate. I still see real estate as a positive investment this decade. But I think that it's going to be fits and spurts that we're going to see. We're going to see them go in an interest raising cycle. They'll pause when the economy weakens. Maybe we'll get a stock market rally that could last a year or two, but then inflation is going to continue. And the reason is debt and the amount of spending that government's doing. And at the same time, we're doing a lot of things. I don't care if it's government mandates, if it's regulations, it's environmental regulations. We're cutting supply. So like in my own state of California, we're bracing for brownouts this summer. because we already shut down one nuclear power plant. We're holding off on the second one, but we're trying to go to this green economy where we're all going to drive electric cars. Well, guess what? Solar and wind doesn't work every place around the planet. I mean, it works well out here. We get sunshine and we have wind, but it doesn't work elsewhere. And to do green, you have to have commodities. You're going to need copper. You're going to need lithium. You're going to need nickel. You're going to need silver, all the kind of things. So one of the things that we see in this decade is we do see a bull market, but it's just not going to be in the bull market you're used to. I think it's going to be more like the 00 decade. You're going to have a bull market in commodities. So we're very heavily invested in energy right now. We own copper, we own base metals, we own precious metals. And I think those are going to be the outperformers this decade versus, let's say, what we saw in the last decade, where if you were in bonds, you made money. If you were in stocks, you made money. And the other thing that I think is going to go out the window, Anthony, is in our profession for almost 4 decades, we had what was called the 60-40 split. You put 60% in equities, 40% in bonds. So when you had a bear market like we did in 2008, your stocks went down, but your bonds went up, so you didn't lose as much. That isn't working now. If you were in bonds this year, treasuries are down close to 20%, stock market's down 20 to 30%. That's not going to work. The other thing I think is going out the window is passive investing. So if you look at the last 10 years, you didn't have to be a genius. Just put your money in an S&P index fund, NASDAQ index fund. You made money, and you probably outbeat most of the money managers on Wall Street. I think this is going back to value investing, and it's also going to go back to active investing.
You talk about inflation, et cetera, in these commodities. The first thing I think of, the first thing I look at is the gold price. The gold price is supposed to be protection against inflation, storage of value, and it's still sitting at around 1850. Sure, it touched 2100 a couple of months ago. When does the price of gold go up, and does it even go up?
No, I do think it goes up, but if you look at gold, and I want to go back to the 00 decade. So if you look at the 70s, if you wanted to own gold, you owned coins, or maybe owned gold stocks. I can think of one fund I used back when I got in the business, International Investors. It was probably the only gold fund out there. Most people weren't in the futures market like you see hedge funds today. Fast forward into, let's say, the 00 decade, what did you see? You start seeing ETFs, GLD, you saw SLV. So all of a sudden now, investors had an easier way that they can invest in precious metals. You just go on your laptop, type in the ticker symbol, press a button, and wham, you own gold and silver. You didn't have to go into a coin shop. Today, there's ETFs and mutual funds for just about every single investment on the planet, for every single commodity on the planet. And then on top of that, we have cryptocurrencies that have come in. And I believe a lot, especially with the younger crowd, that the cryptocurrency has garnered a lot of money that might have gone in traditional gold and silver investments. But the fact that gold is holding in this range, in this 1850 to 1950 range, I think speaks well for itself. And where I see the launch pad for gold is when the Fed begins to pivot and the dollar begins to go down. Because one of the things gold is competing with right now is a strong dollar, because interest rates are far higher in the US than they are elsewhere in the world. And that is bringing money into the dollar.
Let's talk oil and gas. Where do you see oil going right now? It's trading around $118. Do you think $200 isn't the possibility? Can it ever go back to 30? When we saw it at 30, we saw potential of it going to $0. It's hard to understand what's going on. What's the market sentiment? There's always talk about ESG, electrifying. I'm confused as much as anybody, Jim. Help me understand a bit here.
Well, let's go back on one of the key things and why I think oil is going to 130, 150. And so for those of us in California, we're already approaching $7 a gasoline. I saw a newscast yesterday in LA, diesel's at 9, gas is at 8. Brace yourself, because that's where we're heading. And the problem that we have fundamentally, and this goes back to probably 2014 when we had the Saudis with the price war, they were trying to put American shale producers out of business. And what that did is it drove the price of oil down below $100, down to levels that companies, even in the shale business, couldn't make a profit. In fact, very few shale producers made profits. And what happened is the industry stopped investing. So with oil down at lower levels, the needed investment that should have been made was not made. And we were in a 6-8 year bear market. In fact, you take a look at 2020 and 2019, some of these big oil companies from Exxon to Chevron actually lost money, and they lost billions of dollars. So when you're losing money or you can barely make a profit, you're not likely to go out and spend a lot of money. So there's number one, fundamentals, lack of investment. Because like an oil company, or imagine a department store, you're selling merchandise, you better have new merchandise coming in the back rooms to replenish it. Oil companies need to do the same thing. When they're pushing oil out the front door, you better be making discoveries that are coming in through the back door. So fundamentals, number one, lack of investment. Number two is ESG. So, all of a sudden wokeism has hit Wall Street. So you've got hedge fund managers trying to get on the boards like Exxon. They get on the board and they're saying to these oil companies, we want you to divest yourself of oil assets. I can't think of anything dumber to do than what we're doing right now, because like it or not, we are going to be burning fossil fuels for the next several decades. This idea that we've hit peak demand, and by 2030, you and I are all going to be driving EVs, and we're no longer going to be needing oil and gas. That's just not going to happen. So ESG is another one. Third has been what we've seen with the Biden administration shutting down the Keystone Pipeline. It cost $8 more to put oil on a train. I mean, that's good news for Warren Buffett, who owns a railroad that hauls it. But it's not good news for consumers because it makes the cost of transporting fuel more expensive. Then, of course, on top of that, you have the Ukraine war, Russia being a major producer. I just saw this week the EU is going to stop taking Russian oil. Well, what's going to replace that? Who's going to come up with that? And then finally, the final factor, which I think this is geological that most people don't understand, is we have about 500 giant oil fields in the world. There's tens of thousands of oil fields, but there's 500 that really matter most. And probably we could get that down to 300. These were the big oil fields that were discovered in the 30s, 40s, and 50s. Oil fields like Ghawar in Saudi Arabia that accounted for half of Saudi oil production. Those oil fields are now in decline. And the problem is we're not finding elephants to replace those giant oil fields. And an elephant is defined as 500 million or 500 million barrels of oil or more. And we're just not finding them. In fact, oil discovery peaked in the 60s in terms of size, and we've been declining decade by decade. If you take a look at, there was a study that just came out, I'm trying to think where I read it, but oil companies are only replacing about 86% of their reserves. So, and there's only 3 or 4 areas of the world where we could get the excess capacity to produce that extra oil. One would be the US with shale. Second would be Iraq, probably has the biggest potential within OPEC. And then I'm gonna bring up something that goes back to the 00 decade. There was a gentleman by the name of Matt Simmons that ran Simmons International. He wrote a book called Twilight in the Desert in 2005. He had studied the Middle Eastern oil fields. And one of the things that I think the world is in for a shock is we're going to wake up and find out Saudi Arabia does not have 2.5 million barrels of excess spare capacity. They can't even produce 10 million barrels. And part of that, Anthony, is their biggest oil field, Ghawar, was discovered 75 years ago. So they're doing everything from water injections, natural gas injections to keep the flow rate going, but it's in decline. It's declining at 6 to 7% a year, something called oil depletion, and we don't talk about that. But that, in a nutshell, if you add it all up, spells higher oil prices.
With all this ESG and that you mentioned, the banks can't even lend these companies money for their oil projects, even with oil at $100, $120. What does an oil company do, a smaller one, a private one, in order to get the funding?
They're going to have to, try to find private equity or something like that. And even private equity, in the decade, Wall Street was funding anything they had to do with shale. It was increasing production. They didn't care if you were making money. You could say, hey, we produced 1 million barrels last year. We're going to produce 1.5 million this year. That's all they were going for, was growth. Well, fast forward and you do that for a decade and nobody made any money. All of a sudden, and I think this is realistic, you would say, if you're on Wall Street, show me the money. If you want to give me money, I want a return on my money. And you're even seeing this with the larger oil companies. Instead of investing right now, they're buying back stock, they're raising dividends. So, Wall Street is in show me the money mode, or it's in the ESG mode. Either one of those is poor. And until financing really gets to a lot of these companies that need it, you're not going to see shale production climb back up to the 13 million barrels I think we reached at the peak. And even then, the problem with shale is, you reach your maximum production within a year, 2 years, you're going into decline. So with shale, you always have to keep drilling. And what does that mean? It means you have to have more money to keep those drills going. No problem if you're Exxon and Chevron, which have moved in heavily into the Permian Basin in Texas. But if you're a smaller company, it's not working.
Let's talk metals really quickly. What's your favorite metal moving forward? We already touched on gold, but which one would you invest in? Which one would you finance?
The one I like, and I think it is a screaming bargain, is silver. I mean, if you take a look at what was 1980, gold hits 800, silver hits 50. Gold went from 800 to recently we went up close to 2100. Silver touched 50 briefly in 2011, and it was a flash, and that was it. So if you look on an inflation adjusted basis, silver has never been cheaper. So that's number one. Number two, it's kind of has two faces to it. A lot of people will look at silver as basically an industrial commodity. It's used in solar panels, used in production. But there's a monetary element to silver as well. I mean, think of the British pound based on silver. So, silver was more of the metal used by the common person, where, the very wealthy had gold. So I think silver is more practical, more people can afford it. And I think it is grossly undervalued on the basis of inflation adjusted. I think it's right. What is it today? Somewhere around $22. And if you look at it in inflation adjusted, it should be well beyond that. So that's my favorite metal, along with copper.
Now, we talked about oil and gas. We talked about energy, ESG. It begs the question. I think the greenest metal, literally and figuratively, is uranium. I really think that is the key to electrifying the world. What's the disconnect here with uranium? You got two disasters that happened in Japan and in Ukraine, years apart, accidental, and it's affected everyone's mindset on uranium. Yet uranium really is the cleanest metal, and all these people that want ESG are still pushing back against uranium. When's uranium going to have its time? When's it going to go up? And when are people start going to realize that it really is a safe metal? It's really the best thing if you do want to electrify the world.
Well, I agree with you 100%. It's the only way the green works. In fact, we own uranium, so I'm a big believer in it. The problem that you have is Hollywood and the greenies themselves. So you had 3 Mile Island, probably the worst disaster has been Fukushima, where we actually had people die. But if you take a look at 3 Mile Island here, nobody died. And in Fukushima, yeah, there were a couple deaths and stuff like that. But, how do you predict a tidal wave that comes in? So if you look at the accidents that we've had in natural gas, the accidents that we've had with wind turbines, the accidents that we've had with oil and transporting oil, and you compare that to uranium, and more importantly today, with the new technology that they have in these uranium reactors, I mean, if we can make them small enough to power an aircraft carrier and a submarine, we could be making small enough units to power smaller towns in the Midwest, in smaller areas. I think it's going to be forced upon us. Already some of the politicians, like our own Governor Newsom here, is backing off. They shut down one nuclear power plant, but now we've been warned this summer to get prepared for brownouts, which I'm getting ready for. I'm going to get, my house is solar powered, and I'm going to be getting batteries for a backup system and nat gas generator. So as you get more and more brownouts, people are going to get ticked off. And politicians are, you can't just say, well, climate change. Well, tell that to somebody that can't run the refrigerator or put on the air conditioning or turn on the lights. There's only so much that the public is going to have patience with. So I think eventually that's coming our way. I predict by mid-decade, we're going to be talking much differently about energy than what we are doing right now. Right now, we're still coming out of that ESG mode and climate change and things like that. Well, if you're really serious about climate change, number one, I think oil will be going into decline because of peak oil. I'm a big believer in that. I think we've just postponed it. So that's an issue. But what are you going to do if right now, most people, they pull their car in the car at night, it's in the garage, it's not drawing on the grid, you're using less electricity at night. What do we have today? I mean, I'm just take a look at the back of my desk. I have computers, I've got laptops, I got iPads, I got iPhones, iWatches, all these electronic devices that we're charging at night. And then all of a sudden you tell everybody you got to have an EV. And all of a sudden you got your EV in the garage at night and that's pulling on the grid system. We don't have the grid system right now that can handle where they want to send us in terms of let's going to this green economy. So, you know, seems to me that there's a lot of lack of critical thinking here. I mean, it's nice for a politician to get up there and say, look, I passed this law and we're going to fight climate change. But translate that into reality. Okay, you're not going to allow diesel trucks in California after 2030. How are we going to get food to the stores? You know, are you going to get semi trucks? I just recently drove up to Seattle on a road trip. And the thing that really hit me, Anthony, was number one, how big the state of California is. I always thought it was, you know, it ended at San Francisco. It's another 200 miles longer. But as I was going up the 5 up to Seattle, I've never seen as many trucks in my whole life. And one of the reasons is all the major cities on the West Coast are all along the I-5. So those trucks are there because they're getting goods. So I look at the freeway system as the nation's economic artery system. And I look at trucks as being the blood that lubricates the economic system. You know, I just don't see in 10 years or 8 years now that we're going to have electric trucks running on batteries as big as some of these semis. I mean, you see double tractor trailers on the road. You're going to power that by batteries? I don't think so, at least not at this point.
Well, if they are powered by batteries, I can tell you one thing: those batteries will be powered by coal, gensets, etc. I was down in Australia at the end of last year, and what was really interesting, there's a Tesla station near Perth, and guess what was powering that little Tesla station out in the middle of nowhere? There's an HFO genset. So it kind of goes to show you we don't have the infrastructure there, but we still want to pretend that we're really giving back to the world. You know, in the end, Jim, do people care more about ESG or their pockets?
They care more about their pockets. I mean, if you list the priorities of people right now, right at the top of the list is inflation, because they're filling it in the pocketbook. I don't care. You go to a restaurant, you go to the grocery store. I mean, I have a favorite little fast food restaurant. It's a chicken place here. And I used to get a dinner for 2 for 19 bucks. 2 months ago, it went to 23 bucks. I just went there last night. It was 26 bucks. So that reality everybody is seeing on a week-to-week basis. And sooner or later, you know, inflation's up there, crime's up there. There's a lot of things that are priority. If you look at the bottom of the list, I mean, what's climate change to people? How can they put that in a context financially to them personally? You know, this nebulous thing, well, 50 years from now, if we don't do this, well, that's 50 years from now. They can't predict weather 3 days from now. And you're going to tell me you have a computer model that's going to tell me precisely what the weather is going to be 50 years from now? I don't believe that.
Jim, you're kind of scaring me here. And with that inflation thing, I was at a store we have in Canada called Costco, and everything was up in price from last time I was there. So I'm feeling it too. Where do we park our money? What I hear here is, copper is good long term, uranium is good long term. All commodities really are good long term, including oil and gas, nickel, gold. Now, besides buying an ETF, you can't really buy those physically. You can't store them. Where do we invest our money? What would you advise someone that's in their 20s looking to start investing?
The thing I've always liked, big believer and follower of Warren Buffett. If you look at the way he invests in companies, he invests in companies that generate large cash flow, either cash flow as a business or cash flow in the form of dividends. So I like essential things. Our income fund is invested. We own 4 drug stocks, doing fine, dividends going up each year, stock price going up. We're talking about aging demographics. What does that mean? It means people get older, you're taking medication. If your doctor says you need to take this to handle your blood pressure or get your cholesterol levels down, you're not going to say, I don't know, the Fed's raising interest rates now, I think I'll put off on that. No. So I like essentials like that. I like consumer staples. We own, soft drinks. We own tobacco, smoke and Coke. I mean, those things do well no matter what market. And then we own commodities, and I still like technology. I'm just, we got rid of our technology stocks last year. I'm waiting to get back in because, we're not going to stop inventing stuff with technology. So, it's just going to be a different market. I think value investing is coming back. So you look at things that are underpriced. I think commodities are going to be a big winner this decade. And I also think that, technology stocks are still going to be a good investment. I just wouldn't buy them right here. I think they have further to correct, but there's plenty of places to look. And there's a well-known personality, Kramer on CNBC, and he says, there's always a bull market somewhere. And that's what you have to look. And I think the big bull market this decade will be commodities. But that doesn't mean you put all your money in commodities. You can still put your money in equities. I just think you're going to have to be a lot more selective, and it's not going to be a passive decade. So, but as far as I'm concerned, I mean, I've owned oil stock for decades. I come from a family that started, my grandfather went to work for Standard Oil when he came over from Europe. And so he did 2 things. He bought real estate and Standard Oil stock. And that Standard Oil stock has been passed on to a couple generations. So I've owned oil stocks for the last 2 decades. Wasn't that great from 2014 to 2020, but I always got my dividends. Those dividends went up, and now those stocks are going to the moon.
Yeah, well, look, it's amazing. You invest and you hold on to some of those key companies, you're bound to do well. We come from a junior exploration market group. And, quite frankly, you're talking about oil and gas, how they haven't made any new discoveries, et cetera. That's compounded in the commodities space. There's been next to no large discoveries made really in any commodity, maybe 1 or 2 each year, but not enough to supply all the need that's going up increasingly. So I think the junior space is really going to be feeding a lot of these larger companies. And you add into the fact that you have inflation that's affecting some of these construction decisions. It's a perfect storm. So I think it's just a matter of time before these commodities really start to boom. So that's what we're excited for. That's the business that we're in, but I really do appreciate your insight. So right here, we have Jim Puplava. Thank you very much for joining us from San Diego. Jim, we're going to let you say one last thing before you go. What's the one takeaway that everyone here should have?
Inflation. Just focus on inflation. This is going to be an inflationary decade, and just adjust your portfolio and put it in alignment with that trend.
Well, thank you very much, Jim. Thank you for your time, and thank you for joining us.
All right. Thanks for having me, Anthony. All the best.
Please welcome back Stephen Stewart, joined by Charles Beaudry, VP of Exploration, QC Copper and Gold.
Hey, Charles, welcome back. Nice to be talking with you about our favorite topic, the Opimiska and QC Copper. How you been?
I've been well, thanks.
Good. So, look, I'm just going to cut right to the chase here. I think the Opemiska is one of the most exciting exploration projects in North America right now. It was a mine for 40 years. Let me ask you your opinion. Is the Opemiska going to be a mine again?
I very strongly believe that it will. On the basis of the resource that we published last fall at 103 million tons at 0.85% copper equivalent, we can't speak specifically about financial parameters, but anybody who can build a financial model on this project will see that the project is economic. So it's our view that it is going to be a mine, and we're focusing everything we can to determine what size this thing is going to be. And so this is what the primary objective of our exploration program this year.
Okay, so last year in September we came out, we published this resource. It was, as you said, 104 million tons at a nice high grade. It sits 2 or 3 times the grade of an average porphyry. It's 4 times the cutoff grade. So this is a very high grade project right in the middle of Quebec with excellent infrastructure. So we got a great starting point, which was that resource. Now, as everybody knows who's following us, we've got the 60,000 meter drill program focused again within this pit area. So tell our viewers about the objective behind this 60,000 meters and what it's ultimately going to deliver.
Yeah, certainly. Well, I'd just like to highlight the nature of the resource that we defined last fall. It's a very high quality resource. There's 80 million tons almost that is in the measured indicated category. So that's considered, in terms of a maiden resource, it's almost you never see that. I mean, that's just for all purposes. You never see that. Typically, it's more indicated with a little bit of inferred, and we do have a little bit of inferred, but it's only about 20 million tons. And the nature of that inferred that was determined is such that it was very conservative, which is kind of strange because normally the inferred estimate is usually less conservative than the rest. But in this case, for technical interpretative reasons, it turned out that the resource, the inferred resource, was very conservative. And what that means in practice is that there's a lot of material that we can eventually interpolate, and it was left out. And so what we are trying to do with the current drill program, which is about 60,000 meters, as you mentioned, of which we're about a little over 35,000 meters into that program. We have 2 drills running. We're going to have a 3rd drill start running in about a week. So, and we're going to be running our drills until the maybe even late summer, depending on how things are going. We're not really fixed on the 60,000 meters. It's more of the objective that we're trying to attain. And that resource is going to be, that drilling will have 2 components to it. The first component will be within the pit, because we know that we're confident that we'll be able to expand the resource in the pit, adding significantly to the indicated and definitely to the inferred category, so that we can arrive at the end of this drilling program with a resource that's substantially larger than what we published last fall. And in addition to that, we know that we're going to be able to add some small satellite resources, which are going to fit in small pits in the outside of the conceptual pit that we defined last fall. Now, if you recall, that pit that we defined last fall had a very high strip ratio. And I like to explain to people that the reason why it was high strip ratio is because the average grade is quite high. If our grade had been lower, it would have been lower. And so we have an opportunity here, since we have a 7-to-1, there's a lot of waste in there, and we have a great opportunity to convert some of that waste into ore. And so that's what we're going to be focused on. But in addition, we have the opportunity to define maybe 2, 3, maybe even 4 satellite resources outside the pit. And the final element that we're going to be including is we're going to be investigating the exploration target that had been defined by RPA way back in 2014, which they defined a target that was somewhere between 3 and 11 million tons at between 1.5% and 2.5% copper. So let's just
and
say
that's at depth, though.
That's underneath, so not in the pit. That's right.
We will be referring to as peri at depth.
That's right.
It's been undefined in terms of our exploration or mineral resource estimate so far. but we have a pretty good idea it's there.
Yeah, well, we know we have the block model that RPA worked with back in 2014, so we know where it is, and so but we're bringing more to the table, because in addition to the drilling itself and the assaying, as we've said, we sampled the complete hole, we split the core right down the middle, right down for the whole complete holes, and we're sampling everything. So we're bringing a lot of this low grade near cutoff grade, which we used at 0.2 last year, and we probably will be using something similar this year, depending on the metal prices and depending on the size of the overall resource that we can define. But we're looking at a resource that is at depth on Perry that is going to be close to 2% copper, and something that's at that grade. If we can see in the volume of that the possibility of mining it in bulk from a large ramp at the bottom of the Perry pit. That could add potentially 400.
Become very interesting.
That's right. We have close to 500,000 pounds of copper 500 million pounds of copper that we could add to the overall resource. So if you take all the things that we talked about, we could, if we're optimistic, which I think we should be, we have the potential to double, the resource or at least the amount of metal.
Contained metal. Yeah, the contained metal. Which is at the end of the day what we're after. Let's go back. I want to focus on what to me I think is the priority for 2022, and that's really that pit. And you talked about a lot of that inferred resources. It's either not calculated or it's calculated as waste right now. And it's been said we're trying to drill waste into ore. Right? To me, that's the objective. Talk a little bit about that and how that will impact our strip ratio. I think that's sort of low-hanging fruit, and also again, that's going to itself will increase the contained metal, because in an open pit you have to move that rock anyway. So we're moving it from the expense pile into the revenue pile, and I think that really helps our economics. That's correct, and the reason why we're optimistic that we can do that is as I mentioned at the beginning, is that the way that the inferred most of the inferred resource was defined was quite conservative, and the reason why I'm saying that is because the search radius they used in what we called the halo mineralization was only 20 meters, and the result of doing that is that all of the resource basically collapses around your drill holes. And we had quite a few drill holes. We had done. We were at about 75 holes new of our drilling that we did that we included in the MRE, the mineral resource estimate last fall, and of that there was quite a few of those holes were twin holes in order to validate the historical assays. But there was also quite a few holes that were infill. And when we did the audit on the resource on the block model, it was very clear that there were large gaps in that material, that inferred material, that were labeled as waste because of just the interpolation algorithm. So we figured right there that if we go back in and we infill some more, that we're going to be able to bring that material in. We're going to also be doing a reinterpretation of the geology. The primary vector or the primary control on mineralization that we see geologically is the stopes, which were the high-grade veins that were mined by Falconbridge. But in addition, we're pulling out of the data set the historical logs and everything. It's a big focus of our work right now is capturing geological information and using that with Leapfrog, which is software that we know, three-dimensional software, to reinterpret the whole envelopes of mineralization. And we are convinced that is what's going to allow us to really add a lot of this modest grade material that is clearly above the cutoff grade, but right now is being labeled as waste. Okay. And that's going to lower our cutoff, our strip ratio, and it may allow us to go deeper on the deposit, because our limiting factor is not the mineralization, because it keeps going below the pit, but it's the strip ratio itself in the pit that's our constraint. Okay, so to sum up 2022's objective, Couple things. One, we're reinterpreting the geology away from the veins and the halo into a mineralized envelope.
Correct.
That's our new way.
Yeah.
And then we are looking to, in effect, drill what's counted currently as waste and put it into ore. That's another objective. And then we're looking at satellite deposits, which are outside the existing Springer Perry deposit. And then we're evaluating the Perry depth.
Correct.
So there's really three different angles
Yeah.
here that we're, in 2022, looking to bolster
Yeah.
the ultimate payable metal of this deposit. Is that fair assessment?
That's exactly what we're doing. And keep in mind that there's none of this stuff is unknown. We have 18,000 drill holes from the Falconbridge years, and we validated all those assays for all purposes. And so we have a lot of information. The key is to include as much geology as we can, because when you're defining, particularly on the measured and indicated, it's not just a question. I mean, in the end, we know that the criteria for defining these categories, these classification, ends up being the number of samples and the number of drill holes that are used to calculate the grade of the block. But in practice, you have to add soft information too, like the geology and the structures and stuff. So in that vein, in addition to the compilation work that we're doing this year to add to that, we're also we're building a coherent, comprehensive structural model that will help to explain all of the mineralization that we're seeing in the pit in particular, but in the camp in general. And we're going to be using this model as the backbone for the justification, if you want, of the interpolation algorithms that we're going to use.
Okay. All right, so I think that's pretty clear understanding what our
Yeah.
objectives are for 2022. And I'm going to talk about 2023 in a bit, which includes the Robitaille and the Cook and then another land package. We have a big land package here, lots of targets. But before that, I want to talk about the town. The town of Chapet, the district of Chibougamau. You were just up there with Derek not too long ago. We had an interview with the mayor and the councillor. To me, and I've been there, of course, and I think, this is a mining town. That town of Chapet was built for the Opemiska mine. Obviously, we're proposing to put a new major industrial complex at the doorstep of the mine. That presents challenges. I think there's challenges no matter what you're going to do. If you're going to build an open pit mine or a mine, these days you have to pay very close attention to the social license and investing in the community. And I think that's something that we've paid a lot of attention to this year. As you know, we brought in Derek Teevan, who we're going to be talking to. Derek was involved in building Detour, so he knows how to navigate those channels. But I think, social license is so important, particularly in Quebec. But you've been the guy on the ground since the very beginning in 2019 when you had that first town hall, and we sat down with the town. It was very well attended, and you told them exactly what our plans are. So what's your interpretation of the town and the region and how they view the Opemiska and the potential, the economic potential, the jobs, and might I say the opportunity for their children to remain in Chapet?
Well, I think you just nailed it right at the end. The issue is that when the mining camp was shut down, when Falconbridge decommissioned the district in '91, there weren't very many jobs that could replace what they were doing. The guys that are working for us right now in the core shack, most of those guys worked in the mine back in the 80s, and they were like just kids. They were young adults that worked for a year or two, a couple of years at the mine. So there is a nostalgia, definitely a nostalgia for that period, but they understand also that. And we made it very clear right from the get-go in 2019 that we were not returning to Chapet to reopen the old mines. And even if we admitted that the mine left about 2.5 million tons of broken and half-broken ore underground, but it's just the economics of that just don't make any sense in today's world. But we told them, though, is that, and we explained that from the beginning, is that the nature of the style of mining that they did was such that they were limited to a minimum mining width of 2 meters or 6 feet, if you want, and a grade of about minimum 1.5% copper. So the result of that was that there was quite a bit of what they called low grade mineralization, but with us is quite economic, in the wall rock around these veins, and that's the primary source of the material that we have in our resource. There's also, in addition, some veins that were never mined because they were too narrow or they too discontinuous. And this is all material that's going to come out in the wash. It all comes out in an open pit. So our challenge in the open pit is to separate out what's mineralized from what's not mineralized. And the more specific we're going to be in our interpretation, the higher grade we're going to get. That's ultimately what's going to happen. And so we are focusing very much on this notion of reinterpreting the deposit in terms of these mineralized envelopes around the veins, and we are convinced that that's going to be the source. Now, in terms of the community, so they understand that it's going to be a pit, and they kind of know where the pit's going to be, and we haven't hid from them that the pit's going to come right up to town and may encroach on it eventually. But the thing is, we emphasize that what people have to keep in mind is the issue is not who's going to get moved. That's not. I mean, those people, anybody gets moved is going to be compensated very generously. That's not the issue. The real issue is the people who are not moved, who are staying around, and they're going to be close to the pit. We told them that we know from Malartic, from Canadian Malartic, that the issues really that people get concerned about is the issue of the noise, the issue of the vibration, because they're going to be blasting every noon, every day, and they're not. It's not like underground blasts. These are big blasts they do. And the third one is the dust. The wintertime, we get northwest winds that go over the town, and during the summertime, it's a bit better, southwest wind, but nonetheless, you still get a lot of northwest wind in the summertime. So so these are the issues that people are grappling with. Having said that, they are quite aware of this. Okay, we've made it we've been very transparent. I've really focused very much on building the relationship. We have the advantage, well, certainly have an advantage that our project manager there, Denis McNichol, he was born and raised in Chappé. So that's.
And his mother still lives
there.
His
mom still lives in Chappé, and so
we've got our ear to the ground.
Exactly. So and he knows everybody, and so it's been a very I think it's been very constructive, our relationship with the town. And if our viewers, our audience has the opportunity to review our most recent video, our promotional video that we've done, that was filmed about a month ago. It's very short, but people can see you in that video really what's at stake here, and the reaction of the mayor and one of the aldermen, that the town councillors, they're very clearly optimistic that this project is going to be very favorable to the town of Chappé, and which is going to allow, to get back to the beginning of what I was saying, is that when they shut down the mine, the kids had to move out. And so the demographics of Chappé right now is really it's skewed towards the retired boomers and stuff like that. But this is finally the opportunities is going to allow the kids to come back to Chappé, to work in the mine, and to build their families close to their grandparents, and that's going to be that's really what people are.
Yeah, I agree. That's my
really,
sense in all the interactions
absolutely.
I've had with the people of Chappé, and just the bottom line, it's a mining town, it's a mining culture, a lot of history there. People are excited about new economic opportunities. That's our sense. But at the same time, we have to invest in the community, both the First Nations and the local community of Chappé and the broader region of Chibougamau, which is something that as soon as we came out with that resource, that became one of our top priorities is let's make sure that the community knows exactly what we're doing and we communicate constantly. So moving on, I think I'd like to discuss our plans for 2023. We've talked about the pit and the satellite and the Perry depth, but then we've got the Cook and the Robitaille mines. There was a third and the fourth mines that form part of the Opimiska, and beyond that is just the whole area along the Gwillim Fault is just open all the way to the northeast, and it comes in a VMS environment, which is something you know very much about. So talk to us about the exploration upside, not even just the exploration upside, but the Cook and the Robitaille and the stuff that we know, but we haven't yet sunk our teeth into.
Yeah, well, I would say that one of our focuses since the beginning was to expand our footprint. And ideally, we half of it we purchased, and half of it we staked. So we acquired. We're now up to close to 25,000 hectares, which is considerable thing. The work we did on the deposit allowed us to conclude geologically that the Gwillim fault, which is really, it's located right next to the historical mines, that the Gwillim fault is the key to the whole story, and it was movement along that fault which created the structures that we're seeing that are mineralized at Springer, Perry, Robitaille, and Cook. And so the implication of that is that contrary to previous interpretations where the Gwillim fault was late, posterior, and came after the mineralization, what we proposed is that no, we think that the actual mineralization came in the latter stage of the movement along the
So
Gwillim
you've
fault.
got a new interpretation of the genesis of the deposition of the mineralization, and that
Exactly.
has potentially profound implications on how we look for new stuff.
Exactly.
Right? Yeah.
Not only for the camp in general, but in terms of our own property, we have targets, and we just flew in that context. As you know, when you're dealing with structurally hosted deposits, it's all in the structure. So these structures they post-date the rock, and so these are things that you can see on the magnetics. Okay, so in other words, because obviously there's not 100, we're not dealing with 100% outcrop. There's actually less than 5% outcrop over the property, but the magnetic field is measuring the amount of magnetite in the rock, and this is intimately related to the lithologies and the geology, and sometimes to alteration. So we flew the whole property at 75 meters with a small helicopter, and the result is a incredibly high resolution magnetic survey that we're still working on, and we're filtering, and we're going to be doing some inversions, and we're going to be doing a lot more work with that. But the interpretation, the structural interpretation, using what we know of the geology plus that very high resolution magnetic survey, is going to allow us to identify structures that, using the comprehensive structural model that we're going to define this year, that's going to allow us to actually identify fertile or specifically favorable oriented structures that are on the edge of this major fault. And there's another fault that's parallel to Gwillim that's also on our property, and that's a fault that was never interpreted as being significant in terms of mineralization, and we're going to be exploring along that trend. And finally, you mentioned the VMS. Well, there is in the Chibougamau camp, at the base of the volcanic succession, there's a VMS, massive sulfide environment that we discovered deposits at Lemoine, which was a small,
very high grade.
Yeah, it was only 700,000 tons, but it was running 2% copper and 6 grams gold. That, if you do the math on that, that's pretty interesting. And along the same horizon, on the north flank of Chibougamau, is the Scott Lake deposit, which is significant. It's not
19 million tons,
yeah,
6%
yeah,
zinc, 2% copper.
There's a lot of metal in the system there. It's a bit of an orphan because it's never been able to really develop that.
But it shows that the region is totally fertile.
Yeah, and we have that same horizon. We've defined it over an extent of over 8 or 10 kilometers on our property, and we've explored it right now with a deep penetrating EM over barely 1.5 kilometers. So we're still lots of work to be done on that side. I expect that in August, when I'm returning, I'm going to be doing some field work. So I'm going to put on my boots and grab my hammer, and I'm going to be looking at some rock, because there's some fundamental questions that I'm asking, and in the big picture sense, that I'll be able to answer by looking at some rock.
All right, so in summation here, I think we've got a hell of a start here. We've got a very big deposit. We think it's going to get bigger, and we know we've got low-hanging fruit on it because we've got a lot of data. Outside of that, I think we're just sort of scratching the surface on the potential to see how big this whole district and land package can be in terms of metal. I mean, that's sort of how I see it. Now, I'm just going to close up by talking a little bit about the corporate situation. Maybe I'll even touch about Baselode because you've been instrumental in putting that land package together with James. But in terms of QC Copper, we've got a lot of cash right now. It's a tough market. I think we're trading nearly at our enterprise value, if you can believe it. I think it's a phenomenal time to sort of for investors. Certainly, we sold 7 million shares in Baselode. It netted the company $8 million. We retained nearly 11 million shares in Baselode. You know James very well. You and I and James all put that company together, and it's that has achieved a rare milestone, a grassroots exploration discovery on the Hook project, which you worked back on in the 80s.
Yep.
And we're really hitting it on that project there.
Amazing.
So what's your? Let's just give you a quick synopsis of what's
funny.
going on with Baselode.
Well, it's serendipity, right? I mean, the point is that I worked in Saskatchewan in the early '80s, and I had the fortune at that time to work primarily in the basement. We had a company I was working for. We had projects in the basin and in the basement, and I was working primarily in the basement. So I saw environments in the basement that were comparable to the environments we're seeing in the basin, except we could see them on surface. Whereas when you're in the basin, you had to drill down to it through the sandstone. In many cases, very altered, very weathered sandstone, and it was very difficult slogging for exploration and everything. But just to finish off, is that it was always for me compelling argument that if you were in the basement rocks, okay, that your structures would come up to surface and you'd be able to see. So it's still unconformity mineralization, but we know from the geology of the basin that these deposits, they extend way down into the basement rocks. And that's exactly, when I first met James Sykes, he was talking like that, and I would say, finally, someone who talks my language.
I remember when you guys met. I think all three of us met at the same time at the PDAC, and you guys sort of clicked instantly on the opportunity there. And
it was wide open.
I guess it was an idea, and now it's sort of coming to fruition with this discovery on Hook. And they're really hitting it, right?
Yeah, we were lucky. Yeah, we were lucky, right?
But you got to be good to be lucky.
But
you have
that's
to be
okay.
well financed.
But that's okay. But the point is that the idea itself was very good, and that makes the difference between going from the discovery itself to the economic deposit. Because if you're in the sandstone, okay, you struggle through that whole process to try and demonstrate that thing's economic. Things like Cigar Lake, clearly very big deposits, but even today the economics are difficult. Okay, finding a deposit in the basement rocks, however, you can open pit that thing. You can start it out just as an open pit. So your wall rock is competent, it's solid. So the economics makes so much more sense. And then it was all open because nobody believed it, right? So we went out, we staked a ton of ground, and it just happened by serendipity because we were doing the right thing and we had the right ground, and then we were fortunate enough to make an early discovery. But the idea was there, and the concept, I think the exploration concept was very, 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 very good one.
Yeah, well, no, I agree. We had good people, good, well financed, good ideas. James has really taken the bull by the horns there. But I will concede, we got a little bit lucky. I mean,
that's fine.
We'll take the luck in this
that's
business.
Right.
When we get it, it's a high risk business. Right. So I think, just to sort of sum up there, Baselode is a great investment. I think it cost us $500,000 in paper. It's turned into $25 million in value for QC Copper. And I think we're long-term shareholders of that. But when the time's right, we'll take that win from Baselode and we'll put it into the ground.
And if we pull back just a bit more, okay? So we talked a little bit about it. If we pull back a bit more, and we were talking about this earlier, that the successful juniors is rare. Okay, there's a lot of juniors out there. There are not very many that are successful, but with the OR group, okay, of the 5 or 6 companies that we founded or acquired in the past 3-4 years, we have 2 that have projects that are very likely going to be economic, and that's an incredible batting average. I mean, very honestly, it's an incredible batting average. You just don't see that. You get one project, if you to be
one
involved,
project can put you in the Hall of Fame.
Like I like to say, the Opimiska project. I feel like I've been preparing myself all my life for this, and just doing one like that. But to be involved in 2 discoveries within a few years, it's just like, no, you just don't see that. So we've been blessed, but I think we have great crew, great team, and we are well financed. We have really in-house legal expertise with your father, with Alex, and so it's been this combination of the technical, legal, financial, admin, all these things bring together, and being able to identify the right opportunities and going for it. You know, it's just the way. That's how success is made.
All right, well, look, no better place to leave it there, Charles. Thank you very much.
My pleasure.
Good luck out there.
Thanks. Good afternoon, and welcome to this QC Copper and Gold webinar. My name is Charles Beaudry, and I'm the Vice President of Exploration of QC Copper and Gold. We are listed on the Toronto Exchange under the symbol QCCU under the Venture Exchange. In this presentation, we're going to be presenting some forward-looking statements, so we caution you on the interpretation of what we're going to say. As a corporate overview, we'd just like to point out that we have about 146 million shares in circulation, and 37 million warrants and options. Our share price recently is about been 22 cents. So it gives us a basic market capitalization of about $35 million. And we have $16 million in cash in the company. So the enterprise value of the company is on the order of today with the current stock price is approximately $11 million. This project that we have, it's called the Opimiska project. It's located in the northeastern part of the Abitibi in the Chibougamau-Chapais area. Is an extremely favorable project because of it checks all the boxes when you're evaluating these kinds of projects. Firstly, it has the second highest open pit grade project in Canada, and it's the third in the Americas. It's located near a major smelter at Noranda. It's located in Quebec, world-class mineral jurisdiction. It's in a brownfield setting in a historical mining camp. It has excellent infrastructure with rail and highways. Has low-cost electricity with James Bay power lines crossing the property, and a very large major substation located within the property boundaries. We have local labor with mining experience. We have supportive local communities in Chapais and Chibougamau with total population about 10,000, and we have supporting First Nation, the Cree First Nation communities of Uje-Bougamau and Waswanipi. And we're located in Quebec's Plan Nord area with potential financial government support. We have social license. QC Copper and Gold has proactively sought social license to operate in Chapais and is working closely with First Nation partners. Our partnerships include all of the local businesses in Chapais, and in addition, it includes the Mikan Drilling, which is a partnership between Uje-Bougamau and a local drilling company, and Natives Exploration, which is First Nation company that provides labor for slashing and the drill pad preparation, and also for line cutting, and sometimes for core shack activities. We've had several community meetings, and we're going to have some in June. So our idea behind the Opimiska project is that we have a new approach to an existing mining camp. It's kind of the same type of approach that was used in the Canadian Malartic and Detour areas. Canadian Malartic is particularly applicable because in that case the pit is located near the town of Malartic, and our pit is going to be located near the town of Chapais. So we control the western part of the Chapais-Chibougamau district, as you can see from this map, and we have approximately 25,000 hectares of land in the area. Our property includes 4 historical mines, and it represents over a third of the copper production historically in the Chibougamau camp. So it's very significant. And what's special about the geology here is that the vein system itself is spread over a very large area, over several football fields of area. And each of the historical veins that were mined are enveloped with a low-grade mineralization and a halo that is what we are trying to define in our resource. In addition to these low-grade halos around the veins, there's also a number of veins that were not mined historically because they were too narrow. The main point about this is that the historical mine grade was an average of 2.5%, but they were limited to a 1.5% cutoff with a minimum mining width of 5 feet, as a result of which they were forced to leave a bunch of mineralization behind. This is the material that we're looking at. And in addition to the crown pillars, around the mill in particular, there were some veins that they had to leave very thick crown pillars up to 80 meters thick. And this is going to be part of our starter pit, which I'll get into shortly. In addition to the area of the pit, there's the veins extend beyond the pit area, and we're looking at and drilling off some of these veins outside of the pit, and we're confident that we'll be able to define some small satellite pits, both east, just immediately east of the Springer Perry pit, but also along the Cook Robitaille mine trend that's located further to the east. The mineralization style is very characteristic. The veins, the core of the veins are a high grade, sometimes massive chalcopyrite with quartz and magnetite and chlorite, and surrounding these veins is a wide low grade halo. In the case of the photograph to the right, it shows the glory hole, which was a blowout zone at the western extremity of the number 3 vein, and the wall rocks in the immediate vicinity of the glory hole are all quite enriched in copper, as you can see from this image. But generally speaking, the low grade envelopes that we're considering for our project are lower grade, and you can see typically it shows up as discrete sulfide veinlets in the gabbro. So we've defined last fall a mineral resource estimate of 103 million tons at about 0.85% copper equivalent, and the area that we're defining is located in the pit that we can see here, and that contains the Springer veins, the Perry veins, in addition to the saddle zone, which is located at the boundary between the two pits. In addition, we have the eastern veins, and also there's a zone of we call Perry Deep, which is a zone of typically possible underground mineralization that we're going to be working on to define. It's based on a study that was done in 2014 by RPA that outlined an exploration target of somewhere between 3 and 11 million tons at between 1.5 and 2.5% copper. So we're going to be looking at that as a potential addition to the resource. So our 2002 focus is drilling waste into ore. Okay, so we're going to grow the existing resource within the pit shell. So we're drilling waste into resources. Then this offers the best return on investment. It's low risk, high potential, and reward. It increases our copper and gold metal content while reducing the strip ratio. And we're drilling about 60,000 meters, and we're over 50% complete with results exactly as expected, as you can see. So in addition to this, we have a starter pit that we've defined at about close to 11 million tons at near 1.3% copper equivalent. This starter pit is centered on the glory hole and also on the veins that underlie the old mills, which are gone now, obviously. But those veins are going to be part of the starter pit with very low strip ratio, and it's going to be good early cash flows to reimburse capital. So our focus afterwards in 22-23 is going to be we're planning to expand our resource by infill drilling, as mentioned, within the pit, and we're going to further expand our resource along the Cook-Robitaille corridor, which is extensively mineralized. And we're reinterpreting the metallurgy of the Gwillim-Scott-Chibougamau copper faults in the area, which suggests that Chibougamau type mineralization may be found on second-order splays. This project has has really good proven metallurgy. The historical production had concentrate grades over 25% copper with a quarter ounce of gold and 3 ounces of silver per ton. And we're going to be doing some testing, the network this year. That's going to verify what we can expect. Since our average grades are going to be much lower, we need to get a better handle on what our concentrate grades are going to be. But we do expect that the recoveries are still going to be very high, and we also expect that the concentrates are going to be very, very clean. In addition to the metallurgical testing we're going to be doing, we need to do some environmental testing to determine the acid-base accounting of the waste and potentially the ore tailings. And in addition, we'll be doing geotechnical studies on some rock characterization to get a better idea of pit slope optimization. So in conclusion, why should you invest in QC Copper? Well, this is a 100 million ton open pit project. It's the second highest copper grade in Canada. We have excellent infrastructure. We have local First Nation support and qualified labor, and we have a nearby smelter. We have completed over 35,000 meters of drilling since the 2021 published resource, and nearly 50,000 meters since the start of the project. We have completed over 50% of the current 60,000 meter drill program that's in progress with 3 drills. And at the end of the current drill program, we will be updating the mineral resource with additions in the pit by transforming waste rock into ores and reducing the ratio of waste rock to ore, in the satellite pits and on the eastern and southern areas, and along the Cook-Robitaille corridor. We will also evaluate the possibilities with the Roger deposit in partnership with SOCAM. So that's it for now, and we hope to see you shortly again.
Introducing James Sykes, CEO of Baselode Energy, joined by John Ciampaglia, CEO of Sprott Asset Management.
Hi, I'm James Sykes, CEO of Baselode Energy, here with a fireside chat with John Ciampaglia, the CEO of Sprott Asset Management. How are you doing today, John?
I'm doing great. Thank you for having me on.
You're located in sunny California, correct?
I'm in Toronto, actually. I was in California a few weeks ago doing some marketing on the West Coast, which was great to finally be back in, face to face. But yeah, I'm based here at our head office in Toronto.
Okay, excellent. All right, so yesterday there was some big news coming out of the United States. The DOE has mentioned that they want to purchase put in about $4.3 billion worth of purchasing uranium. Can you kind of explain and elaborate more on that side of things?
Yeah, it's a really interesting development, and I think it's not a big surprise to us. This is all about transitioning away from Russia in terms of securing parts of the nuclear fuel cycle that they provide, and those are services. There's a big distinction between how much uranium Russia produces and then how much conversion services and enrichment services they have capacity to provide. And so the Western utilities are material customers to these conversion enrichment services. And the government basically has acknowledged that there's no way to transition the US utilities away from these Russian services unless the government facilitates some kind of transition through assistance. And obviously the details are still to become, and it's still has to go through Congress. But I think the signal it sends is very clear that the government is concerned enough about the transition that they need to intervene. And let's face it, governments generally don't do a good job intervening in different markets. But I would view this as a scenario where we have a legacy issue in our hands, which is the US basically has a lot of idle capacity, everything from mining right through to these different services, because all of this capacity was taken out in the last bear market. And so now you're trying to do a pivot based on an event you couldn't foresee, and you find you don't have the capacity locally. So it's going to be interesting to be seen how this all plays out. But clearly the government getting involved in this says that they feel pretty concerned about it.
Yeah, for sure. There's no doubt about it. This is definitely big news, and we need to keep the lights on. So on the US side of things, is there a fully developed supply chain that can go from mining into the processing side, into the refinement side? Because I know that exists here in Canada. Cameco has the complete supply chain. So is that capacity in existence on the US side of things?
Yeah, I mean, I think the capacity in the US is quite lacking. I think the capacity can be there, but it's not available today. And as I said, when the uranium sector went through a very protracted bear market, it caused serious ripple effects. You know, if you start with the upstream activities, a grand total of 21,000 pounds of U3O8 were mined in the United States last year. That's absolutely nothing. When you think about what the base load requirements are for the fleet of US reactors, it's closer to 50 million pounds. So the US is completely dependent on other countries, including Canada, for U3O8 as a feedstock for the fuel cycle. If you move to conversion services, there's a facility in Illinois that's been closed since 2017. And it will restart next year. But as you can imagine, after being closed for this many years, it needs significant time to ramp up in terms of equipment, safety checks. These are not easy places to operate, and they're highly, highly regulated. So that facility will ramp up next year, and we'll be able to make up some of the shortfall. But it's today, it doesn't really help anybody. So this is the reality, is that we don't have these we don't have the domestic capacity. So what will it take to bring capacity back online? Well, for the mining companies, it's clearly an incentive price that gives them an economic return for their shareholders. But the other part of the puzzle that I think most people don't understand is they need long-term contracting. So they can't restart operations, which is very costly in terms of equipment and hiring, without knowing where the future production is going to. And I think whether you're a mining company or whether you're a conversion or enrichment facility, you got burned in the past cycle by creating capacity that you thought was going to be needed. And then when the market shifted on you, you found out pretty quickly that you couldn't stay in business, which is why mines got closed, conversion facilities got closed. So it's an unfortunate it's an unfortunate reality that the entire supply chain in the West is not ready to pivot to meet this transition away from Russia.
Yeah, so we're looking at many months, couple of years for everything to be fully developed. That is definitely not now. What kind of incentive price do the miners really need to see to bring operations back into full-scale production?
Yeah, I think the answer is it depends on every operation. So if you have a very high grade ore body that was a producer in the past, but it's been shut in right now, you obviously can bring those projects back online, with pricing around where we are today at $50 odd. And we've seen Cameco make those announcements early in the year about restarting MacArthur River. Other projects from Boss Energy and Paladin are scheduled to come back online most likely next year. And so if you've got an existing operation that's been shut in, those are the first ones to come back online. If you are trying to develop a project, obviously with the costs of everything going through the roof, your cost structure is going to be very different because of the big front end CapEx investment you need to make. So, it really depends on each company, but it's not $50. It's probably not $60. It's probably 70 or 80 or 90. There's no shortage of uranium in the world. The issue is it requires a significantly higher incentive price to pull it out of the ground, and it takes a lot of time. So it's not a mineral that's in short supply, but there's not a lot of capacity to pull it out of the ground right now with years of basically underinvestment and curtailment.
Yeah, one of the biggest uranium resources in the world is the ocean, which can we do so economically? Doesn't look like it. So you recently attended a conference in Montreal. Can you kind of give a little bit of the feedback, or what was the overall sentiment in the nuclear space at that conference?
Yeah, it was very interesting because I got invited to speak at the World Nuclear Fuel Conference, and this was specifically on just the fuel cycle. So it was attended by several hundred buyers of different utility companies around the world and different people involved in the supply chain, and they asked me to speak. And so it was a little bit different for me because most of the time I'm speaking to different investors, and utilities are obviously have a different role in the ecosystem. You know, the mood there at the conference was a bit somber, and I say that because they're in a bit of a jam right now, and it's really related to the fact that if you look at the U.S. utilities, you know, about 16% of their conversion and enriched uranium still comes from Russia, and in Europe it's closer to 20. And so they're all trying to figure out, you know, how do we pivot away for obviously all the right reasons from that supply, and there is no immediate solution. So the folks on the panels that operate these facilities were pretty clear that, you know, we're not just going to restart capacity and make these big investments unless you commit to long-term contractors, because, you know, we're not going to go down that path again and get hurt if things change in the marketplace. So there's definitely some anxiety. Obviously, the news that broke yesterday would have changed I think a little bit of the mood. But, you know, utilities, I would say generally are probably not sure exactly how the government is going to step into the market. My guess is they probably don't want the government to be overly involved. You know, it's a free market, and the government is usually not the best party to kind of fix issues in the marketplace. So, but definitely there's an issue. And I think, you know, this is a legacy problem. It took years to develop. As I said, some of these plants have been closed since 2017. So, you know, I always say legacy problems take years to develop and they take years to solve. And I think that's what the nuclear fuel supply chain is dealing with right now, is how long is it going to take? And it's not weeks or months, but it's you know, it's 1, 2, it's 3 years. How long is it going to take to build capacity up locally to basically eliminate their reliance on foreign players like Russia?
Man, I think this is a really good industry for investors to get into. Now's the time. If we're, you know, with the lack of supply out there, really, the demand really hasn't changed.
Yeah, I mean, obviously, in this cycle, there is a positive demand element as more countries either look at nuclear for the first time, extend the operating licenses of existing plants, but it's really more of a supply story. So in the last cycle in the 2000s, it was all about demand. It was all about China building out its fleet, and there being scarcity of the commodity. The last few years in the bear markets, you know, really about supply constraints, supply disruptions, and the only way you're going to fix a supply shortage is incentive pricing, and that's what the thesis has been about. And I talked at the conference about that was the fundamental thesis when we started talking to people a year ago. And then as we started talking to more and more institutions around the world, it became clear that this whole idea of energy transition, mostly coming out of COP26, seemed to be the big catalyst, because a lot of governments seem to make announcements that recognize that there's no way they're going to hit their targets for greenhouse gas reductions without some mix of nuclear. That seemed to really, you know, add to the thesis that governments are starting to change energy policy. And when that happens, things start to really go. And then all of a sudden, Feb 24 happens, and you've got now the ultimate storyline, which is not only are we trying to transition away from fossil fuels, now we have severe energy crisis in Europe. And this whole idea of energy security is starting to become part of the narrative, and can have a very powerful impact on government energy policy. And we saw this happen in the 1970s after the oil crisis. That was the catalyst that really led countries in Europe and Canada and the United States to build out their nuclear programs as they try to get away from reliance on Middle East oil. So, you know, if you think of this invasion of Ukraine as a potential shock to the energy markets, it could act as a very powerful catalyst to shift energy policy as well as sentiment amongst businesses and consumers, which I think gives politicians the courage to change energy policy. And let's not sugarcoat it. Nuclear energy is still a polarizing topic for a lot of people. I think a lot of it has to do with misunderstanding and misperceptions about it. But the reality is the science is real. The safety track record is very good. And we just can't abandon all of our energy transition goals because the supply chain and energy has been disrupted because of the war.
I'm glad you mentioned all that. I'm a firm believer in nuclear energy. You know, it is one of the safest baseload energy sources out there. It's the highest efficient baseload energy source, really. And I desperately think that we need it in the way this world is going as we adopt more energy usage. Electric vehicles are coming on. That requires more electricity generation. We've got cryptocurrencies, which are huge draw also on electricity. So our requirements for power keep going up, and we really need to address that. And so there's no better source of energy out there, in my opinion, than nuclear. It's been, like you said, it's got a great track record, great safety track record. There are few accidents that people really focus on and deters their thought process on the thesis of it. But hopefully we can see that all change. Let's talk about the Sprott asset then for a moment here, with just kind of giving an idea of how it all works. Sprott, SPUT, and yeah, hopefully you don't ask all the questions that I have, but
sure, I can give you a little overview of the trust, and it's been a very interesting ride with this product since we launched it last July, and it's kept us very busy. And it's been a big success for us, and it's been a big success for our investors. You know, we acquired Uranium Participation Corp last July, and with that, we reorganized the company into a more traditional investment fund. And that investment fund structure is really the preferred structure for many investors today. But more important than that, we really changed the dynamic of how it operated. And what I mean specifically is we provided a lot of transparency on a daily basis to the world around how the trust operates and what it's doing day to day. This is really important. The uranium market, to begin with, is highly opaque. And so when you're dealing with an opaque offering and an opaque market, you don't build a lot of confidence amongst institutional investors to get involved in a sector. So when we restructured the company into a fund and we created a nightly net asset value, it really demonstrated to the world that we can operate a fund in a much more transparent wrapper. So what we basically do is we publish every night what the net asset value is, so you can see, is it trading at a premium to its net asset value or a discount? How many pounds of U3O8 does it have? Did we buy any pounds each day? And we basically disclose this every night. This transparency, I think, has allowed the fund to trade much more in line with its net asset value. As a result of that, we've been able to raise a lot of capital using a capital raising mechanism called an at-the-market offering, which previous to the way they raise capital is much more shareholder friendly, has lower friction costs. And I think as of right now, we've raised about $1.85 billion US since we acquired UPC last summer. So we've had a lot of capital come into the fund. We've acquired, I've lost track now, but somewhere around 37 million pounds of U3O8 over that time. So as investors add more capital in the trust, we go out and we buy more U3O8. So right now we're just shy of 56 million pounds of U3O8. And you might wonder, well, how much is that? That sounds like a big number. If you think about powering all the nuclear reactors in the world, and there's about 440 of them, you would need about 180 million pounds per year of U3O8 as your initial feedstock that eventually gets turned into nuclear fuel to operate those power plants in a year. So the stockpile is quite big. And one thing that's important about the trust is once the material goes into the trust, it basically doesn't come out. We don't sell any of the material. We don't lend out any material. It's sequestered. And I think this was one of the key topics that some of the utilities that I met earlier this week were interested in understanding a little bit better, because they saw investment funds come to the market in the last cycle. A lot of funds bought uranium, and then when the trade went south, a lot of those pounds came back into the market and utilities were able to buy them. And I made it very clear to them repeatedly that don't think of this stockpile of material as a piggy bank for you to come and call on when you feel like it. It's not available. It's for the investors. So there's no redemption mechanism. We don't loan out material, and it's a very different kind of structure than our other trusts right now. So right now I think the trust is just shy of 3 billion of AUM. It started off at 630 million last summer, so it's had tremendous growth since its inception.
Okay, thanks for explaining that. Yeah, because I've had a lot of colleagues who were also kind of curious as to really what the long-term strategy or goals are behind Sprott. Was it simply just a vehicle to really double on the investment and put it back out into the market when it was desperately needed, or what was going to happen? Because yeah, there are a lot of new physical players out there who are purchasing uranium off the market, and yeah, sounds like Sprott's really differentiating yourselves.
Yeah, I mean, there definitely are some non-utility buyers that have been buying pounds. There are also some, uranium development companies that have been buying pounds of uranium to kind of mitigate any kind of production shortfalls that they have as they try to engage with utilities and long-term contracts. But eventually those pounds will be sold either in the market or to utilities. But Sprott's very different. We view it as a perpetual trust. If the price of uranium went up, if it doubled tomorrow, we don't just say, hey, here's everyone's money back. We don't have any financial incentive to do that. We want the trust to operate and give investors exposure to the uranium sector.
Okay, just to make it clear though, you are purchasing unrefined uranium, correct?
Yeah, so what we buy is U3O8, which is also known as yellow cake, which is essentially a yellowy powder that's stored in steel drums, and it's an incredibly heavy, dense metal. And just to give you a sense of the weight, if you were to fill one of those steel drums about 3/4 of the way up, it weighs 1,000 pounds. That's where the term heavy metal comes from. So it's stored at facilities in France and Canada and the US. And it basically is stockpiled at those licensed facilities.
Yeah, so even as other physical uranium buyers out there, if they were to get their material back onto the market, you still have to refine it, you still have to convert it. So there's still quite a number of months from any of that material hitting the market just to being able to be used in nuclear power. So.
Yeah, exactly. It's a very long time cycle to actually take U3O8 and actually convert it, enrich it, and fabricate it into the end fuel pellet that goes into the reactor core. It's a long process. And one thing I should mention about the utility sector, it's the polar opposite of just in time. When you think about, let's say you're running a nat gas plant, every day you're subject to filling your plant with nat gas from a pipeline. So you're basically, unless you've hedged your pricing, you're susceptible to price increases and any kind of supply disruptions, which is what's happened in Europe, and which is why the price can go up 800% at a time when you do get these snags. If you contrast that with a nuclear power plant, these plants get refueled about every 18 months. So once they get loaded and fueled, they just run continuously. You really don't have any price exposure, and the price of the uranium as a percentage of the overall operating cost of a nuclear power plant is only 5%. So it's a very small portion. In sharp contrast, if you think about nat gas, it's about 70% of the operating cost is just your fuel. So it's a very different model. And the reality is that to have a stable and reliable grid, an affordable grid, you need to have multiple sources of energy, whether it's renewables, nat gas plants, or nuclear, all in tandem. And I think the regions of the world that adopted that approach, I think have had the most reliable and most affordable energy. If you're too beholden to one type of technology or one type of fuel, you obviously can get dislocated at times like this.
Yeah, agreed, 100%. So kind of wrapping up very soon here, but what do we see in store for the uranium market, or as far as nuclear energy goes in the future? A lot of people have talked about small modular reactors, saying it's the renaissance of nuclear energy. They should be easier to bring online at a fraction of the cost, and should be able to be deployed in different areas, whereas the conventional larger plants can't be. Is this a reality that we're seeing? Is there a disparity between the Western world and the Eastern world? Any feedbacks you can give on this, on the SMRs?
Yeah, sure. Well, I think there's a lot of excitement about small modular reactors for two reasons. One, the traditional big power plants in most parts of the world have had a hard time being built on time and on budget. And so that kind of scares politicians and utilities around making these big investments, and they drag on. Now, the reality is, as I said, it's a big upfront CapEx investment, and then there's much lower operating costs versus, other forms of energy. The second knock against the big plants is that they're really suited for big metropolitan areas, big populations. So, for example, I live in Toronto. The Pickering power plant's been operating since the early 70s. It powers a huge part of our city here. If I live in a smaller town, let's say several 100,000 people, or 500,000 or 1 million, I don't need one of those big facilities. And so these small modular reactors, the hope is that they're easier to build, they're quicker to build, they're lower cost, and they're more versatile for more application. And where we're all kind of watching very keenly is this idea of converting existing sites that have coal-fired plants on them and turning them into locations for SMRs. And you can understand why this is getting support. So let's say, for example, I'm a town in Wyoming, and I'm not making this up, this is real. So I'm a town in Wyoming, and I have a coal power plant, and ultimately it's going to close because they want to move away from coal. Well, you could have 500 or 600 people working in a small town at the power plant that could lose their jobs. And that obviously can really hollow out a town and a community. So the idea is, how do I retrofit that location, which obviously the locals will support, and turn it into a SMR? And so this is actually happening in a town that's been picked in Wyoming and funded in part by some governments, including the US government and Bill Gates. And this will be one of the first pilot projects that I'm aware of. Now there's 70 different designs for SMRs around the world. They're all going through different stages of development and approval. So it's kind of a space race right now in terms of, who's going to be the first to get approval for design, and then who's going to commercialize and deploy and build these things. So it's not going to happen overnight. Obviously the testing and the checks and balances on any new technology are extreme, but we're talking about the next decade. So, kind of 2030 and beyond, we think there's real application for these SMRs. And if you go around the globe, the US government has earmarked funding, the French, the UK, South Korea's earmarked funding. Everybody wants to fund this because they view this as the next technology to help deal with energy transition and energy security. So it's going to take time to play out, but I think it's a very exciting and it's part of the whole story.
John, thanks for everything. You've been a wonderful wealth of information. I wouldn't expect anything else as CEO of Sprott Asset Management. It's been great to have this discussion, and I think you've laid out a lot of what we can expect in the future. There's long timelines in the whole energy cycle. There's long timelines when it comes to mining and conversion and just getting from mining to nuclear fuel. That cycle is not something that happens overnight. We're in a world where we have very little in the way of supply, and yet demand is still there and continues to rise as more nations are now adopting nuclear energy, and China is really leading a race on it. So it's from an investor perspective, I think this is one of the hottest commodities that investors could definitely witness. in closing, could you just give a very quick summary as to what your personal thoughts are on the market timeline? Are we going to see something like 2005, 2007, where it spiked and then it bottomed out, or do we see something a little bit more gradual over the next 10 years?
Yeah, I mean, one thing I've learned about the uranium sector is that it moves very slowly, and I don't mean the price of the commodity. I mean just the whole ecosystem, and it moves slowly because, as I mentioned, it's the polar opposite of just in time, with utilities, more or less buying inventory years in advance of when they need it, long-term contracts, long procurement cycles, and all of that. But I think, if you look past that, you have to recognize that there's been a real pivot here, and I say it starts with governments because they set the stage. Governments around the world have been huge supporters of renewables over the last 30 years, and that's been very, very positive to diversify our grid and move away from fossil fuels. But I think governments have also learned that you cannot become overly reliant on renewables because of their intermittency. So whether it's raining less or it's not blowing as much as your model predicts, you then get into a squeeze where you don't have enough reliable baseload power, and then you have to fall back on coal and nat gas. So the governments around the world have kind of realized that. This is where nuclear, I think, as you mentioned, it's a very reliable baseload form of power. Governments are realizing this changes energy policy, and to be quite candid, I mean, governments have not supported nuclear for a long time. So when you have the Biden administration supporting nuclear in the way it has already, I think that's a real sea change, because historically Democratic administrations are not pro-nuclear, and you've seen this administration come out with support in infrastructure bills. There's a credit program of $6 billion that plants can apply for right now to help them compete and stay open. And then you're seeing a whole bunch of countries for the very first time acknowledge they want to explore nuclear, whether that's countries like Indonesia, Poland, even the Philippines is reviewing. So you have a whole bunch of countries saying, you know what, I think we better look at this again. So it really shifts policy, it shifts sentiment, and people's energy bills, particularly in Europe, have gone through the roof. And so all of a sudden, you see these polls from places like Finland and whatnot, and it's amazing how countries that have very strong green movements, all of a sudden people are like saying, yeah, we need to revisit this technology, because we can't be relying on Russia. We can't be relying on natural gas prices, which just went up 800% on us. So it's really changed, and that's the story that investors around the world, whether you're a retail investor or an institution, are piecing together that storyline, and they're saying, hey, this is a really interesting sector. And I would say it is not a crowded trade. If you think about all of the money that's gone into just about everything in the world, commodities have not been a source of a lot of capital other than the last 12 months. So investors for the first time are starting to look at uranium and a lot of other commodities, and the money is just starting to move. And I've been telling people that the biggest obstacle is actually investability. And what I mean by that is that if you're a big institution and you say, this is a great thesis, I want to get some exposure, you don't have a lot of ways to do it. There's just not a lot of market cap depth or depth of companies. I mean, we did a study that said, okay, if you took the market caps of all 80 publicly traded uranium companies in the world, you get about $30 billion. I mean, it's 1/10 the size of Exxon's market cap. So there's really not a lot of depth yet in the market, because the sector is recapitalizing itself, and it's happening now, and it's going to continue to happen. But a lot of the big money that we talk to are still on the sidelines. So it's still an early stage trade, and for that reason, we think there's a lot of runway left.
Excellent. Investors have not missed the boat on the uranium train. That's really good to know. John, once again, yes, it's been an absolute pleasure. Thank you for taking the time out of your day to speak with me. James Sykes, CEO of Baselode Energy, here with John Ciampaglia, CEO of Sprott Asset Management.
Introducing James Sykes, CEO of Baselode Energy, joined by Cameron MacKay, VP of Exploration, Baselode Energy.
Here we are, Baselode Energy for Ore Days 2022. What an exciting event. And it has been a while since we've done our last one. I'm James Sykes, President, CEO, and Director of Baselode Energy, here with Cameron MacKay, VP Exploration. Cameron, do you remember the last Ore Days? Felt like a long time ago.
It does feel like a long time ago. It was a little bit of an awkward situation, having to wear masks, going into a building and then sitting 30 feet across the table from one another. And yeah, a lot has changed since then.
Yes, it certainly has. And you know, even our journey, we've come a long way in 9 months. And we made a discovery last year in September 2021, and it's just been full throttle since then.
Yeah, no, it's been a crazy, crazy time. Super exciting. And yeah, it's been one of the busiest but most thrilling times of my life.
Oh, that's great to hear. Likewise, no, it's been a great journey for sure. So one of the things that has really been great for the company is the Accio discovery. You know, we've made some really great, we've had some really good success with drilling out here. Discovery has grown immensely. Can you kind of fill us in a little bit more about what's going on at Accio, some of the dimensions and other results?
Yeah, so I guess some of the big high-level takeaways is the sort of main zone of mineralization, which occurs at pretty shallow depths between 75 meters and about 175 to 200 meters below surface. We've got a strike length on that currently in excess of about 350 meters, and at its widest point, it's about 110 meters across. Pinches and swells a little bit, but there's a lot of infilling that will hopefully grow that, both in the east-west direction and also strike length to the south. Really exciting recent discovery is really, really shallow mineralization that we found in a new pod that sits just 25 meters below surface, right at the base of the overburden. And we've hit that along 3 lines now currently. And it ranges basically from 25 meters below surface to about 50. It's basically 25 meters thick at its thickest point, and it's about 120 meters in strike length currently. Lots of room to grow, and it is at its widest point, it's about 40 meters across. So, and also to note too, like our best, thickest, highest CPS return results are off of that shallow discovery. So really exciting times.
Let's talk about CPS actually for a minute, because we don't have any assays back yet, which is quite surprising. We've submitted assays, we've submitted all of our samples into the lab back in March, and we still have nothing back. So we have been reporting CPS, counts per second, which is a form of measuring radioactivity, just as similar as becquerels and curies, but it's the amount of radioactivity that your handheld scintillometer is being exposed to per second. So on average, well, the higher the CPS typically is, the higher amount of uranium that you have in the core. So because we've been reporting in CPS, how do you feel about the results that we've been putting out?
I mean, again, like I've said this before in previous videos, like I'm not going to speculate on the exact grades. I do have an idea in my head of what it's going to be, and it's going to be good. Like, I mean, we're not talking Cigar Lake grades here, but we're definitely talking some nice numbers. There's going to be some really big, juicy numbers that come out. And some of them are going to be not as high, but I mean, I think when you look at the overall picture, and the shallow depth is going to be like a major selling point for it. And I think we're going to have something that's going to be really attractive.
You've talked about the discovery at 25 meters depth, and that was never really planned, was it? No,
we were targeting the main Accio mineralized zone, the one that's 175 to 200 meters. In that hole, we were expecting to hit it at about 175, and yeah, we came right out of the overburden and right into mineralization. Very happy coincidence. Certainly we'll take that. We did hit the lower zone as well, but yeah, definitely happy to make that discovery.
So we've had a lot of news releases. Basically every 2 to 4 weeks we put out news, and it's almost as if every news release we've got something new coming out. Not just results based, but in terms of our thinking. So with the original Accio that we had, we were looking at something between 100 meters to 150 meters depth, maybe even shallower, around that 75 meter mark. But can you kind of explain how things have really evolved since we started drilling this winter?
Yeah, I mean, it's been a long, complicated journey, and it's certainly not over. We've got some fresh ideas that we're going to be testing in the future as well. But what it looks like right now is we're on the mineralization that we've discovered to date is on the western limb of a anticline that's plunging to the north, and so everything's sort of shallowly dipping to the west. And so we started off drilling to the west because a lot of our intersections and oriented core numbers showed that things were dipping to the east-northeast, and that's true when you're on the eastern limb of the fold. But it looks like the mineralization is concentrated on the western limb of the fold, where things are dipping the opposite direction. So we were getting these spotty results where we were sort of skimming the top of the mineralized zone, or maybe like undercutting it a little bit, and we were scratching our heads a lot trying to figure out how to figure this thing out. And we eventually put 2 and 2 together, and we said, well, maybe this upper zone and this lower zone are connected, and it's just dipping the opposite direction. We turned the drill around, and sure enough, that was the case. So, yeah, it was like there were some mistakes made, obviously, on the front end, but we righted the ship and we got it turned around, and we've been putting out better and better results ever since.
Yeah, very quickly turned around too, and it's simplistic mistakes, to be honest. I wouldn't even call them mistakes. It's all part of the learning curve.
That's right. It's just an evolution of our understanding of the deposit. So,
we went in with a model, as all typical Athabascas or a lot of structural deposits within the world seem to follow the fabric. It's just the easiest place to break your rocks. Mm-hmm. That was our model, and it turned out to be slightly different.
Yeah,
so
that's right. There's nothing wrong with that.
Nope, but we found it. We found it very quickly, and everything's been pretty successful so far. So back to that 25 meters, because that is a big selling point, I think, for Accio. Mm-hmm. That is something that we have not seen in the Athabasca in years. It's got a lot going for it. Do you think that there is open pit potential? We're not talking about grades or size, but let's just talk about the vertical nature of that, or just how close that is to surface.
Oh yeah, I mean, if the pounds are in the ground, it's coming out by open pit. There's just no two ways about it. I mean, 25 meters below surface, that's an open pit. Now it remains to be seen if it's got the size and the legs to keep growing to something that's economic to take out of the ground, but I mean, results are encouraging.
Yeah, one thing I gotta point out too, though, is that Accio, in a lot of terms, is not a typical Athabasca deposit.
No.
Based on the grades that we saw from our discovery drill holes last year, those are not typical Athabasca grades.
No.
But I think what is setting Accio apart from everything else out there is that it's got a lot of characteristics of a typical mine.
Yeah, exactly.
And that's huge.
Yep. No, I mean, that's the whole Athabasca 2.0 thesis. It's about mineability. It's not about getting the biggest, sexiest number, although we'll take those when we can get them too. But yeah, it's what are the things that are actually going to make it out of the ground in the long run. So, or in the short run, we hope.
Yep. Oh, a short run indeed. Yeah. 6 to 12 years. Yeah. That's it's been historic production, discovery to production, right? So let's hope that we can follow through. Our drilling rates are pretty quick. We've drilled 15,000 meters in 50 drill holes since the beginning of this year, averaging less than 300 meters a drill hole. So those are going pretty quickly, and probably about 130 meters, 135 meters a day. So we're definitely pumping out the core and swamping our geos.
Yeah, no, shout out to our drilling contractor, Full Force Drilling. They've given us stud crews right from the get-go, and those guys are pounding it out. Like, I'm not going to complain about it, but we are buried in core.
Yep, yeah, great problem. And all of our crew keeping up with all of that and managing through all the stress levels, and yeah.
Absolutely, we're burying our geos, and that's okay.
Yep, as they're smiling in the background for sure.
Yeah.
So we've still got a lot of drilling to go. We are planning for 20,000 meters, but we're fully funded for at least 40,000 meters. So we can keep the whole Accio train going for quite a while now until the rest of the year for sure, and even have some to go back in the next year. We did that great financing last year, 9.2 million bought deal. That was done very quickly. It was absolutely phenomenal, and that really gave us the legs to do what we are doing now. We had a lot of warrants cashed in last year. We had about 3 million plus. So that was great to see that a lot of people supporting the company in that regard, and hopefully we'll see some more coming in. If we're 85 million shares outstanding, if we don't have to go back to the market and we can keep getting some more warrants come in and just get some better results and get our share price up, we're going to be in a very nice position with less dilution on the next raise. So let's definitely keep hoping that we keep going down this track. Let's grow Accio. Let's find some more. We've got some beautiful targets out there, and let's definitely hit this thing out of the park. We had the inclusion into the ETF as well.
Mm-hmm. That was exciting.
Back in March, that was super exciting. Yeah, that was absolutely phenomenal, into the North Shore Global ETF. So hopefully
now Sprott.
Now Sprott, exactly. Yep. So big holdings there. So hopefully we will also find our way into the Global Uranium ETF.
They're doing their re-rating coming up in a few months. We meet all their credentials, so let's keep our fingers crossed, because that's one of the best ways that we can see that the market is really supporting Baselode. We are one of the top performing uranium companies this year, and that's a credit to everybody involved in this, from myself, yourself, all the guys in Toronto, especially everybody up here, full force, our geo crew. Everybody's coming together and really making this happen. All of our investors who have been watching us and been supporting us. We get a lot of great feedback from news releases, and people really love the videos that we're doing. So we'll keep punching those out, and we will keep this company going forward. It's full steam ahead for Baselode.
Yeah, let's keep doing it.
All right. Thanks very much, Cameron, for this, and happy Ore Days, everybody.
Happy Ore Days.
I'm James Sykes, CEO, President, Director of Baselode Energy, one of the Ore group of companies. Welcome to Ore Days. Welcome to Baselode's segment. And I hope that you take a lot away from this. If those of you who are unfamiliar with the story, we made a discovery last year that we called Accio, and it is a near surface uranium discovery, one that we think is quite revolutionary and really hasn't been seen in decades. So we're happy to bring this all forward to you. But if you also are very aware of some of the problems we're seeing in the world today with energy crises and so forth, we're firm believers that one of the best energy sources out there, which is low CO2 emitting, full baseload energy power source, is nuclear energy. And that's why we do what we do. We're looking for the fuel to empower nuclear energy. And so we are part of the Ore group of companies, Baselode Energy. We've had at least 15 times return since our IPO in June 2020. So it's been absolutely fantastic ride for the company. We'll get into Accio in more detail, but just to let you know that we were originally doing a 20,000 meter drill program, but now we're upping that to 30,000 meters, still fully funded for it. We are fully funded for up to 40,000 meters of diamond drilling, what this 30,000 meters should take us through to the end of the year. Kind of crazy how we went from a 3,000 meter drill program last year, made the discovery, now we're up to 30,000 meters. So everything has just gone from so small to just we've been kicking it into high gear, and it's been great. Myself, James Sykes, I've got a proven track record working with Next Gen Energy, Hathor Exploration, even going back to Denison Mines. As I mentioned, we're fully funded to see this drill program through. We've got about 15 million in the treasury, no flow through commitments, which is quite a nice situation to be in. And we've got great capital structure. About 17% controlled by insiders and 5% controlled by the Sprott ETF, URNM. So excellent holdings. Got some great projects, all based around the Athabasca 2.0 thesis. And if you're looking into uranium, the fundamentals are perfect. The demand is increasing while the supply keeps decreasing. There's such an imbalance going on. And we really need to see the price of uranium to be incentivized new mining. And in order to get there, we need to see contract prices between that $60 to $80 per pound range. And we're not quite there yet. So we can be very confident that we will see the uranium spot price move northwards in the months and years to come. It's really not a question of if, it's a question of when. And since 2018, really, we've seen that spot price continuously moving up, and with a lot more volatility in 2021 last year, and we can expect that to continue moving forward. So this is the perfect time for any investor to get into the uranium bull market. A lot of people made a lot of cash in the previous cycle between 2005 2007. You can see when it peaked up there to close to $140 a pound. I've heard from some analysts that we can see such things even higher. So we will see what happens in the future, but the price has to go up. Otherwise, the utilities turn off the power. Athabasca 2.0, this is a strategy that I've personally been focusing on for the past decade or so, and we've been working on it as a whole for the company. And really goes back to the idea that in order to move a discovery forward in the Athabasca, the most lucrative form to do so is either with an open pit mine or an underground mine that is accessible by declines. Now, there are greater than 40 uranium deposit clusters, so multiple deposits within an area, really really makes a cluster. So such as Clough Lake, there's about 10 deposits over at Clough Lake, over 17 deposits at Uranium City, but those are basically clusters. Now, out of those over 40 clusters, only about 25% of those have gone into production. You got to ask yourself the question, why? Now, if you've got so many deposits, what is really hindering these from going into production? Because a lot of these have extremely high grades. And only basically two out of that 25% have ever gone into underground mining with a shaft in the Athabasca itself, and that's Cigar Lake. And I think this really answers the question of why. Cigar Lake and McArthur River are both extremely high grade, high tonnage uranium deposits. Nothing else that has been discovered in the basin comes close to Cigar Lake or McArthur River. They're both over 20% grades when they started, over 300 million pounds. These are the unicorns of the industry. This is what people want to find. And I personally believe that it's because of those grades that people are seeing that those mines have, is that everyone figured, hey, you got to have high grade, but you look at all these other great deposits out there, your McLean Lakes, your Midwest Rough Rider, these have grades that are exceeding 1%, which is at least 10 times higher than the global average grade, and yet they're still not into production after 20 years, after 40 years, 50 years. So really it boils down to the depth that you can mine sustainably in this environment. And that's for an open pit within the Athabasca Basin. That's basically down to 100 meters depth. And with the image that you see here, all the deposits that are in red have been mined out. Anything in gray has not been mined. And it's really a function of depth. Triple R and Arrow are the only two gray deposits within the reds, but those are some of the more newer discoveries, having been discovered within the past decade. So there's still time to ramp things up on those ends. But Accio fits within these historic open pit decline type of mining scenarios, and this is where the Accio discovery, we think, is probably one of the most interesting discoveries made in the past few decades. And we've got similar grades. So those open pit grades go anywhere from 0.2 to 0.4%. So again, you don't need these extremely high grades. You don't need your 2%, your 4%, your 20% to have an open pit mine. Yeah, they'd be great. They'd be absolutely wonderful, but you don't need them. And that's been proven in the Athabasca area. We've got similar type of grades that we're seeing. We've only got 4 holes back from last year with assay results. We're seeing grades from 0.13 to 0.24%. Great thicknesses too, though. 2 meters, 5.5 meters, 15.5 meters. So there's a lot of potential here, but we're also seeing high grades within Accio as well, up to 1.3%, 0.6%. So the grades are certainly there. And with all the intersections that we made last year, they were between 90 and 120 meters from surface. That's that open pit range. That's what really distinguishes Accio from amongst our peers. But even more recently, we discovered near surface mineralization. So basically as close as we can physically get on the geology side of things, and something that we internally call the overburden zone. So what the overburden is, just glacial sediments that were deposited about 10,000 years ago when the glaciers receded, and they left all the sand and boulders behind as they receded. So at that contact with the basement rocks, that's exactly where we're starting to see mineralization, up to 25 meters, true vertical depth beneath the surface. That's extremely shallow. You could dig away the overburden and then to dig a pit to get down to a little bit lower mineralization in the pink. You're mining ore as you go. So right now we've defined something that is between 25 to 75 meters beneath the surface. It is open in all directions. I must point that out. About 25 meters wide, and so far we've got mineralization at these depths within 110 meters strike length of each other. And this is the type of material that will really push Accio to the forefront, that you're not mining down 200 meters to start an open pit, or you're not mining down 500 to 700 meters to start underground mining. You're going down 25 meters, you're extracting the overburden, which you'd have to do anyway, and then you start mining right away. So this is quite quite an effective and efficient type of deposit. And this was Athabasca 2.0 right from the get-go. You can see in this hole here, hole 38, right at that overburden basement contact, boom, we're getting very nice mineralization. And in a more recent discovery that we released earlier in June, or I think it was May, but we've got the shallowest mineralization that we've seen starting at 25 meters depth from surface. Very high levels of radioactivity over 30 meters. So it is quite continuous. And some of these pictures that you can see here, anybody who's been in the uranium industry would look at these and know that this is legitimate uranium mineralization. This is very exciting material. So we're happy to be able to see that within 50 meters of surface. But it's not just the near surface stuff. It's also that shallow mineralization, anywhere from 75 to 200 meters beneath the surface, things that we still consider to be open pittable because we don't have sandstone overlying our mineralization. Sandstone's actually to the east of where our mineralization is, but the bulk of our mineralization is between that 100 or 75 to 150 meters depth. So that pink zone that you can see there, which is just basically what I'm talking about, it's 110 meters wide, and we've got it on strike length for approximately 375 meters. Again, open in all directions. And we've seen a number of high-level radioactivity intercepts greater than 10,000 counts per second. So we do know that the grades are there. We haven't received any assays back from any of the drill holes, but from what we can tell based on the scintillometer results, high levels of radioactivity is definitely a good thing. And what we are seeing in that lower zone, it's very similar to other basement hosted uranium deposits within the Athabasca. Lots of clay alteration, you're seeing hematite overprinting, and you've got mineralization associated with these. One thing I point out with this picture in particular is that with all the pinks and the yellows that we're seeing, to me it indicates that this has not been the final resting place for mineralization. This has been more of a fluid conduit, and that somewhere down the road we will see higher levels of radioactivity. And we've been seeing that to the southeast. Radioactivity has consistently increased towards the southeast. And you've got visible uranium right there. And this is part of the high grade mineralization that we intersected. The black grains, the black nuggets that you can see in this picture is uraninite. And that's exactly what we want to find. So we know it's there. And we've got other examples of higher levels of radioactivity, which no assays, but we can assume that this will have a higher grade associated with it. You can see all of the yellow orange minerals associated with the red veins going through there. So the plumbing system is in place for sure. As I mentioned, we are doing a 30,000 meter drill program. It was previously 20,000, but we decided to up it more recently. In 2021, we completed 4 drill holes for about 1,600 meters. That was our discovery drill holes, and 3 of those intersected mineralization. As of today, with this ongoing 30,000 meter program, we've almost completed half of that. So we're at about 14,000 meters drilled in 47 drill holes. Now, 25% of those have intersected mineralization, and ACCIO continues to grow with each and every single drill hole. We've got a lot of other more exploration style of projects or targets that we will also test within this meterage. Especially right within the ACCIO zone itself, but also on some more distal geophysical targets. But the geophysical anomalies that we're seeing that are associated with ACCIO extend for at least 1 kilometer. And we've just flown ACCIO and the Hook project with an airborne MT survey, and then we are starting to interpret those results, and hopefully we'll be able to see some additional targets that come out of that. So a lot to expect from ACCIO. 30,000 meters, we're basically halfway through. We've had amazing results the whole way throughout the program, and I hope that we will continue to deliver. I don't see why not. One of the last things to mention about ACCIO and just some of the prospective nature within this discovery is that we're so close to the highways and power lines and even the mill. So there's a lot going for it, not just in discovery potential, but also infrastructure. And one of the things that I have to mention with all of those discoveries, all of those open pits and historic mines, basically all of those required a mill to be established prior to mining. The 2 that went underground in the basin, Cigar Lake, MacArthur River, Both of those are using pre-existing mills. So the mills were there before they started mining those. And I think that really helped the capital costs to really move those projects forward. But with Accio, we're in proximity to 3 pre-existing mills that are licensed. Key Lake being the closest one. We're about 70 kilometers northeast of it from there. So we really hope that we can prove Accio to be a sustainable open pit style of deposit with the mill right there. Because if we don't have the capital costs required to put a mill into operation, that's a huge cost saving. And then you've got near surface mineralization. So as soon as you dig away that overburden, you can start shipping material down to the mill as it is. Doesn't get really better than that. It's, again, Accio is quite a lucrative exploration project. And as it continues to grow, we think that this will be, or at least we're really hopeful that this will be the next Athabasca mine. And this is what we want to see. Just to the benefit of all of our shareholders who have been with us since day one, and all new coming investors, we want this to be the best uranium company out there, bar none. I'm not going to get into our other projects, but we do have the Shadow and Catharsis project and also Hook Southwest. All of our projects were staked on the same fundamentals, and we believe that there's potential for discoveries to be made on all of these projects. So keep watching Baselode, not just for Accio alone, but for all of our exploration potential. We've got about 85 million shares outstanding, with 30 million warrants and options. Our share price as of Friday, June 3rd was $1.08. We listed publicly in June 2020, we listed at 10 cents. So we've seen over $1 share price quite a number of times within the past 24 months. So we have done investors some great justice. Market cap is closing in on that $100 million range. And as far as cash goes, we are fully funded, 15 million in the bank. And we're burning about $1 million a month with the exploration program. 2 drills and helicopter support is costing us about $1 million a month. And that's also including M&A as well. So we're fully funded to see the rest of the year through. And then as far as holders go, as mentioned, we've got the Sprott ETF, URNM, holds about 5%, company insiders being QC Copper and Gold as well, about 17% institutions, funds, 45%, and then retail. We're very heavy on the retail side, which I love to see because I got a lot of respect for all of the guys who came in and have supported not only my career, but also Baselode, and they remain loyal and expect to see the share price higher. So we also want to see that happen, and we want to reward all of our shareholders, regardless of who they are, retail, institution, or the ETF and insiders. We want everybody to definitely walk away from Baselode as being one of their best investment choices that they've ever made. That's who we are. Great bunch of guys. We're dedicated to what we do. I think we're very knowledgeable in what we do, and we will continue to achieve success in every stretch of the road. So again, I'm James Sykes, CEO of Baselode Energy. You can reach out to the company directly at info@baselode.com. You can reach me myself at jsykes@orgroup.ca. Go to our website, but you can also follow us on Twitter, LinkedIn, and YouTube. I would love to hear from anybody watching this. Let me know what you think about Baselode. If you have any questions, by all means, please direct them to the email addresses. Thank you very much for watching. I hope you enjoy the rest of Ore Group's Ore Days. Take care.
Introducing Anthony Moreau, CEO of American Eagle Gold, joined by Matt Watson, CEO and founder of Precious Metals Commodity Management, LLC.
With me here today is Matthew Watson, President and CEO and founder of Precious Metals Commodity Management, LLC. Matthew is an expert in all commodities. He's going to give us a special presentation and touch on battery metals, which is in the news and very important to the future of electrifying the world. Matthew, thank you very much for joining us.
Tony, thank you very much for the invite. Appreciate it. We are going to rumble through about 20 slides in 30 minutes. So a fairly high content presentation, very typical for me. I started off in the world of precious metals and have grown basically into critical minerals, and basically everything that's colored on the periodical table here as shown. I'm involved with clients in different ways in these spaces. And there's some repeat themes going on here that I want to make sure everybody in this forum fully understands. No matter what metal we're talking about, we have to understand the foundation, what's driving this mineral super cycle that we're just beginning. So let's get going. I'm going to go fast. Just real quick about myself. Again, Precious Metals Commodity Management. I'm based out in the Silicon Valley here in California. A number of clients, including mining concerns in the precious metals world. I do precious metals reports a couple times a year. I do standalone reports on things like e-waste, rare earth elements, and this clean energy mineral constraints has really been very popular over the past 3 years. And that's basically when you look at all my speaking events, and you can find a number of videos and papers from me. Basically, my mantra has been the same now for about 3 or 4 years. I've been kind of leading the way as an analyst, preaching that this is going to be the century of clean energy transition and mineral constraints, like none other than we've seen in human history. So I've been pretty consistent in this messaging. For anybody who's truly interested in this discussion, there's really 3 agencies and I think 4 key reports, roadmaps that are fundamental to understanding the transition that they want to see to renewables and to our power grid, that are going to drive a lot of this metals demand. So there's links I provide to all these key reports here. And I want to go through 2 basic big ticket macro trends that are driving all the activity that's going on here that we see. One is the cost of renewables is getting cheaper. Over the past decade, we've seen renewable costs come down dramatically. They're right in the cost range of fossil fuels. So there's a big push, as you guys all understand, to accelerate renewables. IRENA, the International Renewable Energy Agency, they basically lay out roadmaps every couple of years on what they want to see us do from a renewable perspective. Let me give you a pictorial of what those roadmaps look like. So first of all, in 2018, the global power grid, about 86% was conventional and about 14% was renewables. And as we move forward into the future, and by 2050, what do we want to see? Well, their old roadmap from the 2018 publication, they wanted to see that by 2050 that renewables grow to 23%. Well, there's been a big shift in the past couple of years here. In 2021, they came out and put out their latest roadmap, and suddenly this 23%, they've changed it now. They wanted to see it jump to 74%. And since we're at 14% here and they want to get to 74%, just to give you a sense, 90% of all new energy installations need to be renewables to make this the resulting structure when you come out of the end of the pipe in 2050. That's an awful lot of renewables. These renewables are going to include, solar. So on the left chart is a series of roadmaps that came from this IRENA. Every couple of years, they put out roadmaps, and the roadmap got bigger and bigger until they got to about a 1 terawatt of solar PV by the year 2035. Well, now they've just come out with the 2021 roadmap where they've taken it out to 2050, and they've jacked that number way up. Now we're looking, they want to see 14 terawatts of installed solar by 2050. That's a big number. We're just now passing 1 terawatt of global installations today, and they want 14, just to give you a multiple of how much growth needs to go on in solar. With this, we'll go a lot of silver and a lot of copper for you silver and copper folks. How about wind? Same sort of charts. The old roadmaps, they showed a progression of demands they want to see installed on wind. Forget that, now they're going big. By 2050, now they want to see an incredible 8.1 amount of wind. If you're a copper fan, boy, this chart's for you. The loadings for copper, it's 3x higher for onshore wind, but 6 to 10x higher on offshore wind. And when they talk about renewable projects in North Africa, and you have to transmit that power to the UK or Spain or somewhere in Europe, you're going to use an awful lot of copper to get there, just for what it's worth, and a lot of zinc as well for what it's worth. Finally, the other big macro trend that's going on is the electrification of everything. And we see this in our daily lives. Of course, we got all these new renewables. We got EVs that they're propagating at an enormous rate. 5G can't grow quick enough. It's exceeded expectations on growth rate. Smart buildings and homes, you're going to see more and more eco-sensitive approaches to what we're doing, not just LED lighting and reducing power consumption, but things with the glass and the perimeters of the buildings, with coating of glass. Heavy industries are trying to clean up smart cities with sensors everywhere. And of course, all things electronic. I love to tell people, we had about 1.7 billion connected devices in the world in 2018. That jumps to 4 billion very quickly. And so both in the clean energy and in the electrification of everything, in my simpleton view, and I'm more of a supply chain guy by background, I just think there's a total disconnect in very fundamental supply chain basics. And again, I was one of the leading analysts out there 3 or 4 years ago pushing that, hey, there's not enough of this stuff. We're driving off a cliff. And now more and more analysts have come to the same conclusion. There really is a huge disconnect. And to the point that it's interesting to note, even Tesla and other companies are now generating what I think is a seismic shift in the vertical integration where they're buying their own mining interest. And we're going to see more of that. It's going to happen. There is really just a big disconnect. Part of the electronics growth is the fact that our cars these days are computers on wheels. There's an average of 9 to 12 CPUs per vehicle. It's an astonishing amount of computing power, and it's growing. So when you have ICE or a gas, a diesel, an internal combustion engine, jumping to a hybrid, jumping to a full range Tesla BEV, jumping to future like Toyota Mirai fuel cell electric vehicles, or even in the future you hear about, I've seen autonomous vehicles, driverless vehicles. The content of electronics climbs in each of these. So that's a lever that's driving part of the growth in the electronics. And then just the grid in general. And here's this arena again. Here's our global power grid. It's measured in terawatt hours. And so in 2020, I think it was 27,000 terawatt hours of global electricity generation globally. I thought we were going to, by the time we got to 2050, we're going to have to double the grid. IRENA says, no, we need to at least triple it. And I think they're right. And what they're going to do is they have to set aside a new portion in this peak, for example. If you're going to be putting 1.5 or 2 billion EVs on the road by 2050, you need basically to grow your power grid by 50% of its present. You got to grow it 50% just to support the charging of those vehicles. So when you look at this chart, again, I think metals. I think there's copper. I think there's aluminum, conductive metals off the charts, infrastructure. An awful lot goes into this. And the IEA has been warning us, and you could go into a good reference is to just go into the video and to YouTube and do IEA critical minerals, and you'll find 30 videos, and they've been articulating very clearly, hey, there's a huge growth rate in the level of what they deem to be critical minerals. And you can see in the middle there on the legend, there's a listing of what they think are the critical minerals relative to the clean energy transition. Right away, I'm screaming, and I've actually been making some contact. Silver needs to make this list. They don't have silver on there, but it needs to. It's part of the solar expansion and electrification expansion, including EVs. Platinum group metals, and as we move into the hydrogen economy of the future, it's platinum, iridium, and ruthenium that become the 3 very special platinum group metals. They need to be on that list. This list isn't very hydrogen economy centric. It should be, and they're talking about a next generation report where they will add that in. And then finally at the bottom, rare earths, and neodymium, dysprosium, and scandium, a very interesting rare earth, I think also needs to be on this list. But let's just look at the loadings. So let's look at an electric car, like a Tesla versus a conventional gasoline car. Your copper demand grows by a rate of 3x, as well as a lot of nickel, lithium, manganese, graphites, cobalt, wow, all this stuff for the batteries. Huge growth rate in the amount of critical minerals with the EVs. What about power generation? Same thing. Offshore wind. Offshore wind in particular uses 8x or more the amount of copper than the conventional power grid uses. Onshore wind uses 3x the amount of copper. And lots of zinc. And so if you're a copper or zinc guy, this information becomes more important. So we're going to start driving these metals with these transitions. And then you guys, more as a mining and investment community, you know the challenge. It's an ESG challenge. More and more, there's just ESG hurdles that are put in front of these mining interests as they try to get the projects off the ground. This is why the timelines from funding to mining operation have grown. They're doubling as we're talking here. Even open pit interest can take 10 years from funding to operation. And so we're kind of hurting ourselves with all these ESG challenges in front of us, creating barriers to how fast we can go. So I'm going to run through a bunch of demand cases, and I do a green versus red, a low or base case demand versus a high demand. And I do it for a whole bunch of these clean energy topics. One is the powertrain mix. What's the percentage penetration of EVs? Things like the solar, this IRENA, they have, this roadmap they showed. What if we do only half the roadmap versus all of the roadmap? Wind, what if we do half versus all? Fuel cell vehicles, what if we do about 9 million a year by 2050 versus 18 million a year? Electrolysis for the hydrogen economy, what if we follow the Hydrogen Council and what they say they're going to do at half or 100% of what they say? And then ammonia, don't think of ammonia as being part of the hydrogen economy. It is. Ammonia and hydrogen are essentially one and the same. Just trust me, but the ammonia market's going to at least double, if not grow by 6 to 10x as a fuel source for heavy maritime and other applications. So ammonia is going to play a key role. So I'm going to show you metals demands under the green versus red case, all these things lined together. One of the key things is, what's the vehicle mix going to look like? And this is a chart, I'm going to run through it quickly, but basically here's a series of countries that have made declarations where they want to see ICE vehicle, internal combustion engine vehicle bans. No more gas, no more diesel. Norway goes first. They do a whopping 170, 180,000 vehicles a year for the whole country. Woo-hoo! They're going to go green first. Will Ferrell loves them. Nice Super Bowl ad from Will Ferrell here, right? And then a bunch of other European countries go. California starting with some heavy duty first. And then by 2035, everything is supposed to be zero emission. And so forth. Where China ends up, where America ends up, which is more and more looking like 2035 in other countries, it's going to create a kind of a tipping point to where you've got to get your percentages up. So in 2025, you only need 0.2% of the vehicle mix to be electric, ranking all the way up to 82% of the mix by 2050 with this. And so I show two states here. I'm sorry I had to go through that with a little bit of pain, but here's my powertrain mix. And this is really an important, how rapidly can we transition to these EVs? You'll see I have gasoline in blue, diesel and it's gray. Then we get into battery vehicles with gas as well, and hybrids in the yellow. These are small batteries, by the way. These are about 1/10 of the size of a Tesla battery in green. Tesla batteries, by the way, are 1,200 pounds of battery materials in the floorboard of the car. Don't tell me there's not a lot of weight per vehicle. There's lots of weight. And when you're selling 100 million of those, yeah, that's going to be a lot of demand for all those metals. So this is what I think is doable, and it's basically a terawatt growth rate and a CAGR discussion. How fast can we grow lithium, nickel, cobalt, even copper and graphite expansions to meet the metals demand that they need? I think we're going to need about 2 to 2.5 terawatts by 2030, growing out to about 6 terawatts by 2050. If we did that zero emission case, like that chart previously was showing us, where you had these steps with different transition years in 2025, 30, 40, and so forth, where more and more countries sign on, they want to get rid of the blue and the gray. They want to see us push into the green as much as possible. One of the problems that regulators don't realize is, again, the size of the batteries in these BEVs. These things are about 10x larger in the green than they are in the yellow. And Toyota Priuses and hybrids are very effective at increasing fuel efficiency and reducing emissions. And yet they want to push for utopia with a full Tesla type of full range, fully electric EV. At the top, you see a little bit of fuel cell electric vehicles that are only going to penetrate so far. We're PGM volume limited there. There's just not enough PGMs. That's another storyline. And so I show a chart now in terms of lithium batteries. It's really a CAGR game. How quickly can we expand the mining? And what I've done here, just to walk you through this little staggered line here of my terawatts of battery demand that we're going to need, that is shown here in this dash line. This is light duty, this dash line. When you add heavy duty EV demands, it grows a little bit higher too. So when you have LDVs and heavy duties both, so basically you're going to need about, some 15 terawatts of battery demand by 2050. That's huge. And in fact, represents a 15.5% CAGR from where we started in 2020. Doing 3 decades straight of anything at a 15.5% CAGR is an extremely fast rate of growth, especially in mining. It just hasn't happened in the past. The fastest mining ramp I've seen in the past was some of the PGMs in the 60s, 70s, and 80s, where it grew at about an 11% CAGR. Well, as it ends up, that's where I put the base case, is down here at 11% CAGR land. I think that's doable. By the way, to hit these zero emission dates where they want more sooner, we're going to miss those dates. You're not going to get fully true zero emission transitions like they think. I could state that with very high confidence. And so basically, it's a mining expansion problem. I'm going to just show you one chart. So here's lithium demand. And when I show these demands, I show the base case, remember all those different scenarios, including the powertrain mix on the left, and my zero emission mandates case on the right. And you can see the amount of lithium demand that is coming our way is just substantial. And what I start doing is I just do simple analysis where I take 2021 through 2050 to sum up how much lithium is going to be needed. I'm going to start putting that in the context of global reserves and inferred resources in a moment. Huge amounts of materials are needed. I could do that for cobalt and nickel as well. By the way, a little fun fact, lithium batteries will be getting cheaper for decades. And suddenly this year, we're now seeing an increase. Gee, why can that be? How can lithium batteries be getting more expensive? Well, that's real simple. Prices are off the chart. So here's lithium. All these are 5-year traces. Suddenly lithium goes from here. It's hard to see in this color, but it jumps way up. Huge explosion in lithium in the past year. Cobalt's up. Nickel, everybody's heard about the nickel story. It's up. And so as a result, the battery prices are up. Yeah, it's no surprise. Let's quickly talk about copper and silver. These are the conductive metals. They're needed for the electrification. And just to give you some simple engineering facts, here's the conductivity rating of metals on the periodical table. Silver is the most conductive metal on the periodical table. They set this table up where copper is the baseline, 100%. So let's call that conductivity of copper as kind of the baseline, 100%. Gold has 70% of the conductivity of copper. Well, that's not bad, but of course it's super expensive and scarcity issues. Aluminum, which is used for overhead power transmission lines globally, is the next best available choice. It's 61% of the conductivity of copper. Silver is used in solar panels just for the reason it is such a conductive metal. It's more conductive. It's got 105% of the conductivity of copper. And then when you go beyond aluminum, it just falls off the face of the earth. So really your transmission and electricity transmission, these are the key guys: silver, copper, and aluminum. Here's the story in a nutshell. Base case on the left. In the case of, again, the powertrain mix plus half of the renewables, the wind and the solar that they want. This is what the outlook for copper demand looks like in my base case versus on the right with, the clean energy world gets everything that it wants. And just to highlight, annotate this chart, so I've highlighted the categories that are clean energy related: the EVs, the wind, and the solar, and the growth of the power grid. You get a sense when you look at these charts how much clean energy is hitting the go-go button on your demand. It's accelerating demand. Now, it's not all the demand. There's still plenty of infrastructure and copper wiring demand elsewhere. But my goodness, this is really kind of highlights the point that the clean energy transition just accelerates these demands. And what do you got to do? Well, you got to double or triple the rate of mining. That's true on all of these elements that I'm looking at. So what's going on with the price tag on these things? Well, copper obviously has gone up. I think has more room to go. Silver has enjoyed quite a spike and will continue to climb. Aluminum is climbing substantially with all sorts of power concerns as well there on smelting. Hey, and by the way, solar panels, remember they've been getting cheaper for 4 decades? They love telling you how much solar and clean energy is getting cheaper and cheaper. Well, that's true as long as it's true. And they don't tout this a lot. You don't hear it. But PV modules are up 7.3% since 2019. Why? Because all the fundamental materials that go into the solar modules has gone up. The silicon wafers are polysilicon, aluminum for the framing, glass sheets, the silver that's used, front and back sheets have gone up. I don't have the exact percentages there. Steel's up, copper's up, freight is way up as they ship finished modules to these large utility installations. So we went from a low of about 21 cents per watt. We're up at 36 cents per watt. That's a pretty big increase in your module cost. That's funny, when material prices go up, so does your technology cost. And here's just a graphic. Aluminum. These are all 5 years. Aluminum's up, polysilicon, steel, copper, silver is up, and then glass is even up. Just to highlight. Well, yeah, of course your panel costs are up. Oh my goodness. Rare earths. This is a complex chart. Here's a table that shows some of the dollars per kilogram price tags for the 17 rare earths. When you plot this out like a TAM, where you take the volume times the price and you plot it over time, the 17 rare earths really are a 3-metal game. And I think a 4th, scandium, will become extremely important. 5 of the rare earths have fairly high price tags, but really it's neodymium that's the key to this. And neodymium has exploded. I've got clients that deal in the batteries that are very concerned about this. Why? All of our, not batteries, magnets, excuse me, that deal in magnets. Why? Well, neodymium is paired with iron, which is paired with boron and an alloy concoction. These create the best magnets the world can make. Magnets are fundamental to windmills and these wind turbines. It's fundamental to the motors and the ICE engines. It's all the motors, like windshield motors, wiper motors, any motor, for auxiliary, windows and doors and all that. There's typically magnets involved. Electric vehicles create another brand because the motors themselves have batteries built into them. They're trying to design out using magnets in the EV motors. But right now, those three are big. And same thing, a base case versus the zero emission case. And just again, to annotate, the clean energy component, clean energy is driving almost entirely this need to triple the neodymium mining rate to meet future demands. Holy smokes. And so finally, I'm not going to go read through this chart. I'm just going to leave this table in there if anybody wanted to see the numbers. Here's a summary of all these metals. So I've got lithium battery metals here on the left, nickel, cobalt, and lithium. And on the left-hand side, typically I've been showing that green low case demand versus the high case demand below it. And I summarize, here's what the summation of the demand is in millions of tons and recycle expected, net demand on mining, global reserves, inferred resources, and put this in some percentage context. Nickel, from a mining perspective, huge ESG concerns, right? Nickel mining and, these laterite ores, these nickel pig irons, all the extra smelting, the CO2 impact, the environmental impact, all the high pressured acid leaching and the acids into the environment, much less that so much of this is going on in a region of the globe called the Coral Triangle. It's frightening. Cobalt, of course, that comes from the Congo, and that's a frightening situation top to bottom with extreme poverty and human rights concerns there. Lithium, there's plenty of metal in the crust, and in fact, the global reserves are probably understated. The reason is there's lots of lithium in the salt flats, but we don't have a good extraction method from the salt flats, from what they call the brines. If we can develop a direct extraction method from the salt flats, then you can open up and get some bigger deposits like the Bonneville Flats or like the Salton Sea in Southern California. And you could, I think, really accelerate the rate of extraction. That's the best hope for the battery set, is to do a direct extraction on lithium. My electrification metals, copper and silver. As we electrify everything, you're going to need them. There's no getting around this. And the EVs and the solar just accelerate the silver demand. You're gonna have to trust me. I don't have enough time in this presentation, but platinum, ruthenium, iridium are huge for the hydrogen economy. All the fuel cells for transportation and all the electrolyzers for generating hydrogen, much less conversions of hydrogens and ammonia. And then the rare earth oxides, like I described. Neodymium needs a 3x growth in mining. This DY needs a 4x growth, even a higher rate of growth is needed in DY, but they come out as an REE pack of metals. They don't come out as just a basket of metals. They don't come out just as individuals. And then scandium is a very interesting rare earth that if we had 15x the mined amount, we could use it all. Scandium today, 80% of the scandium goes to one application, solid oxide fuel cells and Bloom Energy. And yet there's tons of applications sitting on the sideline dying to use scandium, including aluminum production, where when you dose 2% alloy of scandium, fundamentally changes the aluminum to make it have the strength similar to a steel. And so lightweighting efforts using scandium would have a lot more room if there was more scandium available. And so lots of information on this chart. And so I try to plot it. And this is basically the summary here. So again, my base case on the left, high case on the right, lithium metal, the battery metals, the conductive metals, hydrogen economy metals, and rare earths. And I put it in the context first of known global reserves. These are USGS 2022 numbers. So basically my base case, you got to go mine 100% of your nickel, your cobalt, and 70 some odd percent of your lithium of the known reserves to meet the base case demand. And then you have to go get some extra from the next bucket over, which is called inferred resources. The definition by USGS, what's a global reserve? These are economical to extract. We know where they're at. We have enough drill holes. We know the compositions. There's an extraction plan that's been generated by projects with all the processing that's economical to do. Inferred resources, there is lower ore grades, or the technology doesn't exist, or the depth, or something about water access, or whatever, access to other resources may constrain you. Push these into inferred, to the next level bucket. And then beyond that, you get into, hey, you need exploration and discovery. And I put these things in the context of Well, percentage-wise, you can base case need 100%, and then you got to go grab pretty large percentages of the inferred resources for nickel. Versus the zero emission case, well, forget about it. On the battery metals, you got to go even bigger still. Conductive metals in the low case versus the high case, you get pressed no matter what. Copper and silver are a great plays from a mining investment long-term. PGMs, look at how much of the PGMs. You know, there's 150 to 200 years of PGM known reserves, most of it in South Africa. Unfortunately, it's some of the most complex mining on the planet. It's a half mile to a mile deep. A lot of the PGM miners aren't exactly lining up to go double their mining rate. And yet that's exactly what I'm arguing. We know where those reserves are at. That's what we should be doing. Rare earths, it's a misnomer. They're not rare. They're actually fairly abundant. Ends up we have 450 years worth of known reserves. And even with accelerated demand, you know, we got lots of known reserves. We just got to go get it. The problems with rare earths is it's toxic to extract. You're generating about 2,000 metric tons of toxic waste for every 1 metric ton of rare earths extracted. These are very acid and destructive. China does about 90% of these. And of course, they don't seem to mind. China doesn't mind that they have an acid lake out back with all the slurry and the offtake that's just been accumulated. And so they've created an environmental nightmare. But there's plenty in the US and Canada. We really need to develop these rare earth projects as well. And so there you get it. I mean, in a picture, boy, we should be pushing the PGMs harder and the rare earths harder. We know where they're at. There's not much of a guessing game there. I think you could have more of a CO2 impact with these actions. Lithium batteries, I kind of see we're going to get jammed no matter what on the lithium batteries. It's going to take a technology change. It's going to take a chemistry change. It's going to take technology evolution to get us there. And lithium brine extraction, I think, is the key to that bucket. Conductive, anyway, you get the picture. It's a lot of information I've rolled through, and so I tried to paint some conclusions. Again, those ESG concerns, they're everywhere in the lithium battery set. Conductive metals, we're going to need them no matter what, essential, but man, it's going to be tight. PGMs for the hydrogen economy. I didn't get into auto catalysts here, but I can get into some of the palladium and rhodium issues there and why those are climbing. Rare earth elements, they're dirty but plentiful. And we need to, on so many of these metals, double if not triple the rate of mining. And that's where you guys come in. Again, this is Matt Watson, Precious Metals Commodity Management. We've covered a lot of information very, very rapidly. I appreciate your attention. Thank you so much for your time.
I have quite a few questions. I don't want to take up too much of your time.
No, I'm sorry. You tried to confine me to 30 minutes. That's why I told you this is going to be tight. And that's the most condensed version I can give, by the way. And obviously, I ran very fast through that. But if anybody has interest and wants to dive deeper, obviously get a hold of me and we'll walk through it at greater length.
A few things are going to fire off here, Matt. How green is renewable energy really? You know, with the safe jurisdictions, not having the supply, having nickel come from Indonesia, rare earths coming from China, is this kind of like eating a hot dog? You don't want to know where it comes from, because it sounds like a lot of these electric vehicles are going to be powered by coal, and all the commodities they're going to be mined dangerously in other countries.
So first of all, on the renewables themselves, so wind and solar, the big problem with wind and solar is that they're variable. They're not reliable. And the penetration rates in our power grids are increasing. And so places like California, where I live, and I go to a number of clean energy conferences with the best in the world, they're basically turning off solar pretty much every day. Doesn't get touted a lot. What do you mean you're turning the damn solar off? You spend all this money and subsidies and you install more and more every year and yet you turn it off? Why? Because we have too much during the daytime. They can't throttle the conventional gas and oil power grid on and off like a light switch. You could turn gas plants off like a light switch, but it may take you 3 weeks to turn it back on. And so in the context of within day, hey, while the sun is going hot, turn it off, you can't flip the gas on and off like a light switch. It just doesn't work that way. And so as a result, they end up curtailing the renewables that they can turn off, they could disable. Well, nobody wants to hear about that, but we're not even using all the renewables. What are we going to do about it? We're going to install twice as much or 10x as much. Well, what's that going to do our power grid? Well, you're going to have to balance that daytime and even seasonally using energy storage. And I think, quite frankly, just simply the hydrogen economy is going to be the best vehicle to do large-scale storage to help balance the grid both within day and seasonally. And there's a lot to that answer. Now, are they really green? Well, solar panels, there's about 8% of the mix that are extremely toxic, that have cadmium, that really shouldn't go into landfills. So there's a lot of concerns I have about the recycle stream, and I'm working with clients on developing recycle streams to get more people like First Solar doing recycle of solar panels, because they have a 20 to 30 year life, and we're right at the cusp of huge volumes of those starting to show up into life. Are they really clean? I think the wind is clean. The biggest issue with the wind is really short durability and how quickly they tear down, and disposal of these fiberglass wind turbines, which are getting forever larger and larger. Huge landfill problems. We don't have a good recycle system yet on wind turbines. And so that too is a complexity. So are they cleaner? Yes, they can play a very vital role. I just worry about percentage-wise, how big can we go? And as you can see from the plan, they want to go enormous. And how do you take a daytime solar and make it effective for you at night is really the big challenge there. And that's why the hydrogen economy is so important. How's that for an answer?
That's a good one, Matt. And I have another one for you. It seems like every metal is going up. Is there any metal that's not going up, that's going to be in the decline?
Boy, that's a good question. So one of the metals that gets a lot of attention is palladium, one of the platinum group metals. Some 85% goes into catalytic converters, into emission control systems for gas and diesel. So in gas and diesel, as its penetration rates decline and more of these EVs take over, you're going to have a surplus of palladium, especially since the fact there's about 1.5 billion gasoline vehicles on the road today. I like to think of it as the world's biggest pool account. All the palladium, platinum, and rhodium that's in those catalytic converters will come back through recycle in time. So, but the problem is you got a huge amount of palladium out there. And so the recycle amounts on palladium are going to push palladium into surplus. It's not a question. It's a timing question only, but it's a win, not an if. And I think by 2030, you're going to see palladium start pushing into a pretty significant surplus. This is why Nord Nickel, the world's biggest individual nickel mining site and the world's biggest palladium site, that's why they're worried about next generation applications of palladium. What's next after the automotive catalysts start to decline? And they're trying to drive R&D projects to create new demands to basically keep palladium propped up along with the rest of the PGM basket long term. Platinum, I'm not worried about. Ruthenium and iridium, I'm not worried about. Rhodium, I'm not as worried about. But palladium is one I think will push into surplus in time. Not in the next 2 years. I think there's more upside on palladium first before it gets to that peak, but it will in time. By 2030, I think you're going to see it start a downward progression.
Now, Matt, if everyone's going to be having electric vehicles in the next 20, 30 years, where's all the power going to come to power those?
So that's the big question. This growing the power grid 3x is quite interesting. And then the more I get into this topic, the more I think it should be 4x growth in the power grid. There's some sections of Australia that I think people are really interested in this topic to study. Adelaide, Australia, which geographically is on the coast on the kind of southern eastern section of the island, right next to the Tasmanian island. And there they have about 50% renewables, but they're doing huge amounts of desalinization, which just like electrolyzers, generating green hydrogen is power intensive, doing desalinization, very power intensive as well. I think the other constraint, it's not on the periodical table, but water is going to become more and more of a geopolitical discussion for human need, for agriculture, for everything. And so I could see the need to grow this 4x, this power grid, when you put into mind the need for all the desalinization that's going to need to occur. And yes, as long as we could use green energy sources and impact some of these industries during the daytime hours with processes that could be variable and take advantage of the excess renewables during the daytime, the better. I think you can influence some heavy industries and some operations like this with some greening effect, if you will.
Well, Matt, you touched on almost everything, but what about uranium? Uranium, I think, is the key to actually powering the United States, Europe, et cetera. Where does that come in the mix? When does that start going up?
Well, so this is my problem as an analyst looking at these clean energy initiatives. I see the holes in them quite clearly. One of the biggest holes is the cost, right? It's that upfront chart I showed you on the levelized cost of solar or wind. Those are accurate costs, but that's when the wind and solar is on and blowing or the sun is up. It's not a fully burdened cost. And since they are variable, the fully burdened cost is actually much higher. And so countries like Germany and California and Australia, countries that are doing heavier percentage deployments of renewables are seeing their energy grid costs climb about 5 to 6 times faster than the rest of the world. And even EVs. I mean, you can see this. It's going to create an inflationary influence through all this process. Metals are going to go up. Everything's going to get more expensive. There's going to be a pushback financially at some point. This is going to break. This isn't going to work. And frankly, the more I study the CO2 impacts, the more and more I worried a lot of these plants don't work. And so I think it's fascinating to me from a just purely clean energy discussion, some of the biggest advocates. Now, I'm a conservative. My politics are fairly conservative, but my daughter teases me, "You'd never vote for a Democrat in your life, Dad." And I go, "Yes, I would." There's a gentleman by the name of Michael Schellenberger. He's on the ballot in California for governor. He is a ex-George Soros funded liberal who helped Obama come up with the Obama Green New Deal. He was the architect of a plan called the Apollo Project. He was one of the co-authors, and he sold it to candidate Obama. Obama executed on that. That's when Obama blew all that money on the Green New Deal. He played a key role in rolling out some of these renewables. He's anti-renewables now. He wants it in much more regulated doses and in a controlled fashion, but he's convinced renewables are not the answer. Instead, people like him are truly green and really into the details. They want nuclear. They say the only answer on clean energy is nuclear. You need to have that reliable power grid in the background. In fact, that's a discussion, by the way, in the context of this variable renewables. Here's California, here's Germany wanting to kill nuclear early. They want to terminate nuclear plants at basically half-life. You build a plant, you get an 80-year life. Your CO2 impact from nuclear is during construction. Once you've blown your wad, then it's emissions free. You run it free. You got to manage nuclear waste, but there's no more emissions after construction. Why would you turn a plant off at its half-life? Well, because they're fearful of nuclear. Well, get over it. In California, it's 9% of the power grid. In Germany, it was even more. And as they've taken that stability piece out of their power grid, suddenly they become more unstable. And you have the events with, the renewables locking up in winter in Germany, or the Texas situation, or California brownouts are going to grow in frequency. And this is going to create some pushback. So I think there's some advocates, including people like Bill Gates and some people that are really on the front edge of some of these clean technologies, that are advocating very loudly for nuclear. And yet the clean energy community is resisting this. And just now to step back, two big blocks of issues the clean energy folks are getting in our way on. One is mining. And don't get me wrong, I could spill, I'm ESG concerned on mining, especially in the lithium battery set, are enormous and real and need more attention. And so some of the hurdles are warranted, but ask an environmentalist, "Oh, so you're into mining?" No, I'm not into mining. I want to stop. So these things are in conflict with one another, and we've got to grow up and we've got to come to grips with this. France is actually the country that's got the most unique situation. They're about 75% nuclear. They're the ones that bailed the Germans out when their power grid failed with all their excess nuclear. Why would you take that away? And so this is a fundamental argument that's occurring right now that we've got to come to grips with. Yes, I'm pro-nuclear. Yes, I'm pro-uranium. There's, I think, a number of the people invested in uranium in a big way, and you know who those people are. They see this. They see this demand. It's going to come. We're seeing new nuclear installations in the Middle East in a number of areas. There's a lot of silver, by the way. About 33,000 troy ounces of silver with every nuclear 1 gigawatt plant, by the way. So there's some demands this will create in addition to uranium that I think are warranted, and I think we need nuclear for stability in the grid. All right.
One final question, Matt. Who's going to build these mines, and who's going to afford to? Because we're the junior exploration business. I think it's a good business, actually, because all we have to do is find the resource. Who's actually going to build those mines? And I see two conclusions. You mentioned before reserves, they got to be economical. The only way you can get economical is the price of copper, for example, getting from $4.50 to $8, or the governments and the companies actually have to subsidize and pay for these mines themselves. What's the shoe that has to drop here?
So the only way to make this work is for just massive inflation, right? This is a self-defeating project with the amount of minerals that we need. On the copper, right? Forget how much we've mined historically. You need to double all the historical mining on copper. You need to double it in the next 30 years, right? I mean, it's that simple. Good, easy to say, hard to do. So to the mining discussion and investment, here's Matt saying we need to double, 2x the mining on all these metals. We need to double the investment dollars, at least. It's not triple, because of today's inflationary prices, it's going to go up. You need more than 2x the mining investment, and that's not occurring, as you know. And then there's other, I think, strategic problems going on, like lithium. I look at all the greenfield projects on lithium. And I add up like the top 10 or 20 projects. I have a sheet on this, and it's about 1% of the global reserves of lithium. Well, you just saw my chart on how much lithium. We need to go big ass on lithium, not all these small little projects. And so although there's all these little miners guys that want to go, we need to go after some of the salt flats in a big way with that direct extraction technology that has really yet to be demonstrated. But that's where I would put my eggs in the basket, is working on the processing and opening up some of these other truly large resources. Things like the Salton Sea in Southern California, you could double your known reserves if you had a direct extraction approach that would work just with that one deposit. There's one outside of Mexico City, the Bonneville Flats, all over the globe. You know, the lithium triangle in Argentina, Bolivia, and Chile at 12,000 plus feet, huge. You know, it's 56% of the reserves, but it's at 12,000 plus feet, and there's no water up there. Right?
Well, I think the thing you're forgetting, though, it's good looking permitting in the United States. And look, if you're going to be putting billions of dollars in capital to build something, do you want to do in South America, Asia, anywhere besides really Canada and Australia? I don't think so. And then you come to Canada, like you can't even get a nickel mine built in Michigan. I think Canada is really the lifeline for the U.S. Our group has nickel with Metal Energy. It's got uranium with Baselode. It's got copper with QC Copper and American Eagle Gold. And I think the U.S. is going to be looking a lot at Canada as their source of metals, which I think is the future. Now, Matt, we talked about it's impossible to build a mine, and you said the only option here is inflation. Now, what's the self-fulfilling prophecy here? I think it's gold going up in the very end.
I think we're at just the beginning phases of this, and we're seeing metals prices jump like crazy. And my message is you haven't seen anything yet.
Well, thank you very much, Matt. So this is Matt Watson, CEO, founder of Precious Metals Commodities Management, LLC. Matt, how can people reach you if they want to work with you, consult with you, et cetera?
You can look up preciousmetallscommoditymanagement.com. You'll find my website. All my contact information is there, as well as on the presentation package as well. I have it posted throughout.
And Matt, really quick, your 3 favorite commodities moving forward, what are they? 1, 2, 3.
Oh, I'm big on palladium in the short term. I'm big on silver long term. Big on copper long term. Really, those are my 3 focus. And then rare earths. Love to have more rare earths. Boy, really hazardous, again, toxic process. We can't just let the Chinese do it in a dirty way. We have to do it better and do it ourselves.
Okay, well, thank you very much, Matt, for your time. Extremely interesting, extremely engaging, great presentation, and hopefully have you back next year. And please, if you want Matt's contacts, please contact info@orday.com.
Introducing James Sykes, joined by Mike Sweeny, VP of Exploration, Metal Energy.
I'm James Sykes, CEO of Metal Energy, here with a discussion with Mike Sweeny, the VP of Exploration of Metal Energy. And we're going to give the listeners a little bit of a rundown on Metal Energy and why this is such an exciting exploration company with a lot of upside potential. Mike, it's a pleasure to have you here.
Thanks, James. I'm glad to be aboard. Just tell you a bit about my background. I was 30 years with Falconbridge, Xstrata Glencore in Sudbury, working in the Sudbury Basin, exploring for nickel, copper, PGEs, successfully involved in the discovery of the Onaping Depth, Fraser Morgan, and Norman West deposits. And during my time with Falconbridge, I was out to Thompson and the Manabridge area, as well as early in my career, I was also involved in the Lac des Îles deposit up around Thunder Bay. So, you know, when I saw that those are the projects that Metal Energy has, I was anxious to jump aboard and be part of this exciting adventure.
Yeah, so it sounds like you're going to make the big discovery for us.
I'm hoping so, that Manabridge is going to be the next nickel mine.
All right, so basically with your background then and your knowledge in the nickel space, and now that you have been to Manabridge, so we completed 2,300 meters in 6 drill holes this winter in phase 1 drilling. First drill, basically the second drill program, I guess, for Metal Energy, our first one being at Strange, which in those meters that we did at Manabridge, how would you rate those rocks? Were they what you would have expected to see? Was it everything that you've seen in the past?
Yeah, it was very exciting, and the intersections between the ultramafic package that we were targeting, I mean, it was anywhere between 50 to 160 meters thick, which is right where we had anticipated to be. We got some great sulfide intersections within those holes, as well as testing some open space. So that's kind of what, you know, I was expecting that we were going to get out there, given the previous drilling that was in the area. So very exciting.
Yeah, I think that's pretty key that we're filling in the gaps in the open space. Like that really grows what we've envisioned for sure. So how the data that we've been using, all the historic drill hole data, you find that very reliable then?
It seems to be holding up pretty well. I think our upcoming program, we're certainly going to confirm some of that information and make sure that it is continuous for the upcoming program.
So right now we've identified a strike length of about 1 kilometer from the Manabridge mine workings. So the Manabridge, for those who don't know, Manabridge mine was a past producing mine between 1971 and 1977. They mined about 1.3 million tons at 2.5% nickel and 0.3% copper byproduct. So there is a lot going for it. Now, Mike, with the grade that I just mentioned and even the size that I mentioned, and we've shown this in some of our models on our corporate presentation and in other videos, that the old mine workings are very small compared to the envelope that we're exploring. So do you think it's possible that we can have similar type of mineralization within that envelope?
Oh, most definitely. And I think even some of the results that we got this past winter indicate that we do have the potential for some high grade, you know, massive sulfide zones within the envelope, and you know, even down to depths that we haven't looked at before. I mean, it's only been tested down to about 300-400 meters with some of the underground drilling. So there's excellent potential for some high grade zones within that main mineralized envelope.
Oh man, that's great to hear. That is very good to hear. And it's not just high grade; it's sulfide nickel, which is exactly what we need in today's current market. So that's phenomenal.
Yeah, definitely an advantage to have the sulfides in hand and for processing, and even the much better grade. Even with a little bit of sulfide out there, you get some pretty decent grades.
What about the rest of the project? So we've just been talking about the kilometer strike length. For those of the listeners who don't really know Manabridge, again, there is the Manabridge North deposit, which is, I can't remember, about 3 kilometers northeast of where the Manabridge mine is. So that's another high grade nickel showing. What about the rest of the project? There's a lot of really untapped space out there. We flew an MT survey. I don't know if you've had a really good look at that, but what are your thoughts on prospectivity within the whole exploration area?
Well, I think it's really excellent. I mean, some of the preliminary results from the mobile MT suggest that we do have some targets that haven't been tested before, which is really exciting. And it's a fairly extensive package that we have on the east side of the property, which is where the looks like the ultramafics are continuous up through that area as well. And so hopefully, you know, going forward, we'll be able to get some recce holes out there and get into some good mineralization, or even at least get some of the good rocks out there.
Yeah, I value that information for sure. That's my thoughts exactly too. You know, it looks like the ultramafics on the east side are maybe even thicker, but they're definitely a lot longer. There's a lot more strike length to them, and there's a lot of evidence of folded geology, which if you look at some of the other Thompson nickel belt deposits, they're associated with the fold hinges, either along the limbs or directly at the hinge himself. So, you know, having 2 or 3 of those folds on the eastern side of things, on the greenfield exploration side, yeah, that's big news for us. So I think we've got a lot going for us in terms of what to expect from Manabridge. And we've got 100,000 meters. We've got a permit for up to 100,000 meters over 3 years. Do you think that's enough to really move Manabridge mine itself into, I guess what we want to do is bring that into an NI 43-101 resource? Obviously, we want to see this mine get move forward into a mining scenario. If we can pull it off as an open pit to start, I think that'd be absolutely brilliant, with a decline down at the depth, but obviously that all remains to be seen. But yeah, 100,000 meters, can we pull off the resource at Manabridge while still doing greenfield exploration?
Oh, most definitely. I think that's plenty of meters to get through at least this summer. We can, get the 10,000 in, and that should give us a really good indication of how much more we need to drill on the main Mana Bridge itself to get that up to a 43-101 resource level. And there's certainly lots of extra meters that we can get out and drill some recce holes out on the other target areas. So that's, 3 years, 100,000 meters, no problem.
Can you give a little bit of detail regarding the summer plan? So how exactly is it going to be implemented, and what could people expect down the road?
So we're going to be setting up drill sections about every 50 meters heading north from the previous mine workings. We have to stay about 100 meters away from those. And we're going to be drilling fans of holes. So we'll be setting up and drilling, 4 or 5 holes on a setup. Each hole is 200 to 400 meters and about 50 meters on the pierce points down along those sections. So that'll give us a really good idea on the continuity of the mineralization between between the sections, as well as within the main mineralized envelope. And also, as we talked about, confirm some of the underground drilling that's, there's an exploration drift that kind of heads out underneath where we're going to be testing. So that'll be good confirmation for that.
Awesome. Some big news down the road. And yeah, my intention is really to start putting out news every 2 to 4 weeks. 4 weeks should be the latest. We want to keep our investors updated as frequently as possible. We'll have the handheld XRF at site, so we can do the same thing we did with the last news release. I wouldn't want to report any of the nickel or copper grades from the XRF because it's not very, it's not representative of the rock that you see. It's only representative of the spot that the XRF has seen. So just a little surface spot. You never know what's in the rest of the rock. But I think if we do that, just put out the widths of confirmed nickel copper sulfide mineralization, I think that would be fantastic. Again, keep people updated, and I think that we'll just bring them along for the ride, and hopefully we see this thing turn around. So Mana Bridge, yeah, Mana Bridge is absolutely wonderful. It's a great project. That's definitely our flagship. I think we're all embedded into it. We all have a lot of faith that it will move forward efficiently and effectively. And I really do think that given the nickel market, it will be a necessary mine of the future. So let's continue cranking that out. But I guess we've got another project that we're still waiting to put results out. So we did complete a drill program earlier this year in winter. We completed 1 drill hole about 700 to 70 meters down into the sedimentary basin of the Mid-Continental Rift on the Strange project, North Bay area, North Bay, Ontario. And you were there, you've seen the rocks. So can you kind of give us an idea of what to expect? Like from what I saw in the log, and to be very honest, I'm not a nickel geologist. I'm a structural geologist with a background in uranium exploration. I do know basins, being the Athabasca, but we had a lot of mafic rocks. Is that what we want to see, or is there a certain kind of mafic rock that we want to see? Can you kind of expand on what we did at Strange?
Sure. Yeah, I was up there in January and February when we were doing that drill program. We did get some good mafic rocks in the first hole. I'm not sure whether they're the ones that are best for nickel mineralization, but we did explain the mag signature that we were testing with the first hole. We have a second hole potentially planned up there on a slightly different looking magnetic signature, and we're hoping that once we drill that, we're going to get the right mafic rocks that are going to be basically host for a nickel deposit up there. So still got potential, but we need to get back in there and complete the 1 hole.
Yeah, because the target for the second hole is a much stronger magnetic anomaly, is it not?
Yeah, definitely, and it looks more like what we were anticipating with the theory of an ultramafic flow kind of intruding into the sediments, and so that the magnetic signature seems to represent that more in the second area. Okay,
but the first hole did confirm that we do have mafic flows within the sediments. So the rock types, the rock types not being nickel bearing that we saw in the first hole, they are the right type of overall geology that we want to see, correct?
Correct. Yeah.
Okay.
Definitely have the possible.
Are there any other deposits in the world that share similar geological features that people could reference to?
Well, there's the Eagle deposit down in Minnesota that certainly bears similarity to what we're getting at, we're looking for at Strange, as well as the Tamarack deposit. So those are two, significant deposits that are in the area.
Yeah, those are very significant deposits. They're definitely well known.
Yeah. So, and then we have the Lac des Îles PG deposit around Thunder Bay, and there's several other mafic intrusions that are nickel bearing up there as well. So it's a really good potential area. There's a Crystal Lake Gabbro is up there as well. So quite potential for some good nickel up there still.
Yeah, not just nickel, but copper and PGEs too. And we're talking, so between the Eagle mine that you mentioned and Lac des Îles, that's what, like a few hundred kilometers of open ground, really, isn't it?
Yeah, the mid-continent rift area up through that whole area is huge. I mean, it's massive, and there's lots of areas that still haven't been tested, and that's when we got the Strange project. That's why we were able to kind of get into an area that really hadn't been tested down to the basement contact. So that's why we're there.
Awesome. So now that we know the geology, we're very comfortable with it. We've got some excellent geophysics to follow up on. That, yeah, I think Strange is a very exciting project. Not as exciting as Manabridge, but any discovery that is made at Strange just really changes the whole scope of not just metal energy itself, but also the surrounding region. It opens up that whole area for further exploration, and it would just be another hotbed of diamond drilling and resource companies coming into the area. So it's has that huge potential, and let's hope that we hit it on the second hole.
Yeah, definitely worth getting up there and getting that hole in there.
Awesome. Okay. Really, there's not much more to go. We're a well-funded company. We've got about $5.5 million still in the bank, some of that being flow through, and most of that being the hard dollar state. So we're very secure in that end. The Manabridge project that we have coming up, 10,000 meters. We're estimating about $4 million to operate that program. So that will still leave us with some hard dollars in the bank to see us through into the next year. So definitely a very good situation to be in. We've got about 80 million shares outstanding. Market cap's around that 10 million mark, which is quite low in my opinion, especially with Manabridge already in our back pocket. So internally, I think we have obviously we have a much better understanding than the rest of the people in the outside world, but it looks great. Manabridge looks really great. The envelope that we see based on historic drilling is quite robust. There is a lot of potential nickel mineralization in that whole envelope. And so with the 10 million market cap, now if we can start defining a deposit that is the size of, well, let's use Tamarack as an example. So Talon Metals, they've got a huge market cap, well over 100 million. I think they're closer to 500 million market cap. That right there would present us with a 50 times return on investment at today's current prices. So that's big upside potential. And I think we will definitely have something quite lucrative coming out of Manabridge. So it's a great time for investors to get into metal energy. No doubt about that.
Yeah, I'm looking forward to getting the first few sections in and then getting some results, and hopefully by September, October we should have a really good idea and some good news coming out from Manabridge and moving us forward into the winter program in 2023. So really exciting.
Awesome. All right, Mike. So I think we've basically covered all the bases. We've got two projects that we will continue to explore. Manabridge, our flagship, we will continue marching on that one. Definitely that requires all of the attention. So yeah, that's what people can expect from Metal Energy in the months to come. We've got a pretty long plan. We've got at least 3 years planned of exploration at Manabridge alone. So we will be a very active company. I guess in parting, let's just quickly talk about the nickel industry in itself, because you have been in the industry for a long time. I've been following it just because of the electrical vehicle space, but also some of the battery components for renewable energies. Nickel metal, cobalt cathode batteries are I'm not going to say the best, but they are the highest density and they have some of the best output. But they're definitely a nickel source, or sorry, a battery source that will be required in the future. So with, throughout your career, have you seen fundamental changes in the nickel demand scenario as we're witnessing today with the EV sector?
Yes, because when I started with Falconbridge 30 years ago, I mean, the primary use of the nickel was stainless steel. It's still a big source of or driver of the nickel market, but with the EVs coming on now, I mean, everybody's out looking everywhere. China's trying to secure mass quantities of nickel for their economy, and everybody else is out there trying to find nickel properties and get them into production. Looks like in the next year or so, we're certainly going to be a shortage of nickel, so it all bodes really well to get Mana Bridge and our company back up into the mining space. So it's really exciting.
All right, let's make it happen. Yeah, sounds like EVs have definitely revolutionized not just the nickel space or copper space, but a lot of other resource spaces. So as long as EVs are here to stay, which I can't foresee them going away. In all honesty, I can't see oil and gas going away as much as people want to see the reality of that. I don't think it's a feasible scenario for the globe as a scale. I think if we can start knocking down some of the things, just EVs are here to stay. There's no doubt about that. I've driven in a hybrid, haven't been in an EV itself, but the hybrid was amazing. That was a fantastic vehicle. So I can't see them going anywhere at all. And as they continue to stay around, so will nickel demand. There's no doubt about it. And Metal Energy will thrive in this environment. We will, we'll increase Mana Bridge. We will do what it takes to really show that Mana Bridge is the Cadillac in the nickel resource space.
Yep, and Metal Energy will be there to contribute to the nickel demand in the future.
Awesome. I'm James Sykes, CEO of Metal Energy, here with Mike Sweeny, VP of Metal Energy, here for Ore Days 2022. And we hope that you enjoyed this initial conversation of Metal Energy. If you want to follow up the company, you can contact myself directly at jsykes@oregroup.ca. You can go to our website, check out our website for sure. Follow us on Twitter, LinkedIn, email the company at info@metalenergy.ca. We're always accessible to take some calls and hear from people. So thank you very much for watching, and have yourselves a great rest of the day.
Thanks, James. Enjoy Ore Day.
Hi, I'm James Sykes, CEO of Metal Energy. Welcome to the Metal Energy segment of Ore Days 2022. Very exciting time, and I hope you enjoy or will be enjoying the remaining of the Ore Days events. Lots of great companies, lots of great interviews and presentations. So if you're interested in the whole nickel and green energy metal space, well, this is where Metal Energy really fits into the Ore group of companies. This is our main focus, and we want to contribute to the world in a meaningful way. So just kind of running down Metal Energy, part of the Ore group of companies, 6 great, excellent companies with a lot of investor upside potential. Metal Energy super cycle is definitely here. There's no doubt about it. Nickel, copper, even uranium for the energy side of things, lithium. We're looking at a whole new world, a whole new way that we use metals, especially in electric vehicles and in renewable energies. When it comes to battery components, these are some of the things that are driving what we are seeing today. Is it going to go away? Not at all. This is the future. This is now. And we are seeing electric vehicles being deployed at a higher rate each and every year. Same with renewable energies. So we need the batteries to support these endeavors, and nickel will always be a very big component of this moving forward. So Metal Energy, where do we fit in? We've got the Mana Bridge mine, Thompson Nickel Belt. Thompson Nickel Belt, for those of you who don't know, is one of the world's richest nickel districts. I think it's the 5th largest nickel district in the world. It's also the 3rd largest sulfide nickel. And it's sulfide nickel is what you really want when it comes to battery metals, because that's the type where you can get 4 nines nickel. If you don't know what that means 99.99% purity. That's what you need for batteries. Whereas the laterite nickels, historically, you can get them up to 2 nines, so 99%. Believe it or not, but that extra 0.99% contamination really, or uncontamination, really makes a big difference when it comes to batteries. So sulfide nickels are much preferred battery choices. Manabridge mine, though, formerly owned by Falconbridge, mined between 1971 and 1977. They produced about 1.3 million tons at 2.5% nickel and 0.3% copper, down to a depth of roughly 400 meters. And you can see that Manabridge is roughly 100 kilometers away from Thompson itself, which is where they are still mining. They've got a smelter in place, and this is the right district that you want to be in. But the Manabridge project itself has a lot of potential on it for multi-million ton deposits, especially with high grades. Now, back in the day, back in the 70s, when they were mining, they did see an uptick of nickel price. However, we have not seen the nickel price that we're seeing today for decades. We're basically at all-time highs for the nickel spot price. So this is the right price environment that we want to see. And there's no doubt that this will continue to stay elevated. This is, like I said, nickel and batteries, they're here to stay. So we have to incentivize more nickel mining to continue to meet the demand. So there will be a supply-demand imbalance, if not already happening. So Manabridge mine, looking at it from a new perspective, because back in the day when they were mining the high-grade chutes, and you can see that all in the dark blue. That was the 1.3 million tons that they mined out. But the lighter blue, that large envelope that you see, is everything that they had left in the ground. And there's a lot of open potential along this. And this is where we come at it with, again, a whole new perspective, is that we're looking at the possibility for open pit style of mineralization. So trying to fill in some of those gaps near surface, but also trying to define a sizable resource at surface, and then filling in some of the gaps at depth. It doesn't take much to add some tonnage when you're hitting grades like you can find at Manabridge. Grades where you're seeing 2.6% nickel over 16.5 meters, 4% over 8.7 meters. So quite exceptional grades, but also quite exceptional width, 65 meter of continuous nickel mineralization. 25 meters, 40 meters. So there's a lot of nickel potential within this. So what we've done is we've taken all the old exploration workings, basically figured out that there's a lot that they didn't follow up on. And that's where we started our phase 1 drill program earlier this year in March. We drilled 6 holes for about 2,300 meters. All 6 holes intersected nickel mineralization, or sulfide mineralization. We've confirmed with handheld XRF that it is nickel copper bearing sulfides. Absolutely fantastic. We are still waiting on the lab assay results to get those back. But 2 of the holes in particular, holes 1 and hole 3, we intersected mineralization where there was no interpreted mineralization beforehand. So the envelope grows, the envelope gets bigger, and that's exactly what we want to see. Some of these intervals, hole 3 and hole 4, had multiple intersections of sulfide, nickel copper sulfide mineralization. So we know that this whole system pinches and swells and bifurcates, and there's a lot going on. So the first pass drill program was really to get an idea of what controls the mineralization. Does it exist where there hasn't been drilling, which we're proving so? And we do see a lot of potential that this will just grow, that this has an amazing potential for a sizable resource within that envelope. But also if we continue to hit mineralization such as this, where you're getting massive net textured and brecciated sulfides, that's the type of stuff that can add tonnage to your resource very quickly. And that's what we want to figure out. So how are we going to do this? Well, we are initiating a 10,000 meter phase 2 drill program. It just started in June, this first week of June. And we're going to pound through it. We're going to try to work our way to establishing a resource. We're going to target the upper 300 meters of the mineralized envelope, again, trying to really focus in on the potential for an open pit style of idea. We are going to target for high grade. It seems to be a little bit sporadic, but once you find a high grade, it really adds up quite quickly. And that's definitely what we want to do. And then we're permitted for up to 100,000 meters of diamond drilling for the next 3 years. So we do have a lot of potential on the go, especially on the exploration side of things too. It's not just about following up the Manabridge mine site, which is that big yellow star on the left-hand side, but there's also the Manabridge North deposit, which is the orange star. And then we've also got a much larger greenfield exploration environment that we can explore too. We just recently completed an airborne MT survey. Results are being looked at and reviewed, but the potential that exists on this project for multiple high-grade, multi-ton deposits is quite high, and this really distinguishes us. Looking at the Manabridge North deposit, these were drilled in 2019 by previous operator. Some of the results that you're seeing there: 12% nickel, 6% nickel. The widths that you're seeing, 5 meters, 6 meters, these are encouraging. But what's really important from these drill holes is that they were all angled drill holes. And look at the depths that we're intersecting from. That's shallow mineralization. That is roughly 100 meters true vertical depth from surface. That's the type of material that could be open pit. This is where Manabridge really stands out, and it's a great project, and we really want to hit it hard. Now, the Strange project is an exploration project that we have out in the Thunder Bay, Ontario area. It's within the Mid-Continent Rift system, which is host to Lundin's Eagle Nickel Mine, which is to the southeast of us, but also Talon Metals nickel deposit, Tamarack deposit, to the west-southwest of us. Both of those are extremely high-grade nickel deposits, and those are basically the best North American or U.S. nickel deposits that we're seeing today. Lundin's already mining. Talon Metals deposit is going to be mining hopefully very soon. But it's a great environment to be in. There's a lot of historic copper and nickel mines that were produced from the Mid-Continent Rift. So we think this is the right environment. We did complete one drill hole this year, ST2201. You can see the red dot for its location, and you can see the magnetic signature that we targeted in that one. Wasn't the strongest magnetic anomaly. We had some logistics that prevented us from getting over to target that area with our second drill hole, but that is still planned for the future. But what we did identify from the first drill hole is that we were looking for the geological model. We were looking for these mafic, ultramafic sills and dikes that occur within the sedimentary basin, which is hypothesized as the source rocks for sulfides. And when you get the two mixing in, especially if your mafic magmas are rich in nickel, when they mingle with the sulfides, that is how you get these nickel sulfide deposits in these sedimentary environments. So we have proven that the Strange project is conducive for said nickel sulfide mineralization. So it's got a huge prospect for having a district scale discovery, and that's what we want to do with this one as well. So where we are, we've got about 83 million shares outstanding, about 24 million warrants and options. Current price is floating around that 9 cents, which gives us 7.5 million market cap. We've got about $5.5 million in the bank, so definitely plenty to see us through this 10,000 meter drill program at Manabridge. And we do believe that we'll see a lot of success and be able to raise that share price with this current drill program. But what I really want to point out, though, is that there's a lot of upside potential with this, a huge amount of upside potential. When you compare the market caps that you see on the right-hand side of the image, and even just throwing out that the historic resource, 1.3 million tons at 2.5% nickel, you can start to see, even with comparing to class 1 nickel, then there's a lot of upside potential for Metal Energy to be at least $100 million market cap company. We think that there's far more mineralization, not only within the envelope of the Manabridge mine site, but also to the north, at Manabridge North, and also along the entire greenfield exploration strategy. And then any discoveries over at Strange also just add to the whole investment potential. So we see this as being a very lucrative investment opportunity for a lot of people out there. And now is the time to get into it for sure. There's no doubt about it. This is who we are. A lot of great guys on this, a lot of experience. Our VP of Exploration has been in the nickel, copper, PGE industry for the past 30 years. Mike Sweeny knows a lot. He's seen the core from Manabridge, and he's got some great working ideas. So excellent group of guys. We are Metal Energy. We're planning to hit it out of the park. You can reach us via email below, info@metalenergy.ca. You can reach me directly, jsykes@orgroup.ca. Go to our website, follow us on Twitter, LinkedIn, and even check out some of our YouTube videos. Thank you very much for watching, and I hope that you enjoy the rest of Ore Days. Take care.
Please welcome back Stephen Stewart, joined by Peter Schiff, economist and host of The Peter Schiff Show.
Peter, thank you very much for joining us here at Ore Day. For those of you who don't know Peter Schiff, he's a very well-known, world-renowned economist and host of the Peter Schiff Show. So welcome and thanks for being here, Peter.
Oh, Stephen, thanks for inviting me on. Appreciate it.
So you've been watching you over the years, and you've got some really well-formulated opinions and thoughts on fiat currency, gold, a new product called G-Coin that you're working on. To me, this all sort of speaks to the level of trust that seems to be eroding at the Federal Reserve and the monetary system and the fiat currency. What are your thoughts?
Well, certainly I think that the entire dollar-based fiat currency system that the world has been on since 1971, I think is coming to an end. I think that the public is going to lose confidence in the fiat currencies that are issued by the central banks, in particular the US dollar. But of course, if these other fiat currencies are backed by the dollar, well, then they're all going to go down because they all suffer from the same problem. You see, the dollar, in order to be viable, needs to be a store of value, because money, in addition to being a medium of exchange and a unit of account, which the dollar clearly functions as those, it also needs to be a good long-term store of value, not only so I can save my money and spend it in the future, but so I can loan it out to somebody and they'll repay me. And when I get my money back, it'll have the value that I'd had when I loaned it out. And in fact, historically, the dollar was a very good store of value. Certainly, even before we went off the gold standard, it was a much better store of value when we were on the gold standard. But the idea was that you could take your dollars and you can put them in the bank where they would store their value. But while in the bank, they would earn interest. And the interest would compound as you left your savings in the bank. And so that the longer you left your money there, the more purchasing power you would have based on compounding interest. So you had an incentive to save, which is very important in a monetary system, because savings is what results in economic growth, because it's savings that fuels capital investment, that increases productivity, that raises living standards, that creates employment opportunities. So you need a currency that is stable and that encourages savings. Well, clearly, we don't have that anymore. I mean, the central banks all around the world are specifically telling people our currencies are not going to be stores of value. You cannot hold them. The Federal Reserve, as one example, we now have an inflation target of 2% per year. Now, before that, the goal of the Fed was price stability. Prices would stay the same over time. There'd be no inflation. That was the goal. Now, they didn't often succeed. In fact, they pretty much never succeeded. But at least that was the goal, was that prices were stable. Well, if their goal now is that prices go up 2% a year, well, the Fed is telling you that every year you're going to lose 2% of your purchasing power. You're not going to have any stability. In addition, the Federal Reserve holds interest rates, at zero. I mean, right now, they're above zero, they're at 1%. But if inflation is 2% or greater and you're getting 0 or 1% interest, you're not getting enough interest to offset what you're losing. And the longer you save your money, the more you're going to lose. Now, of course, today we've got inflation, the way the government admits it in the US, of 8%. And you pretty much have this type of inflation all around the world. In Europe now, even Japan has got an inflation problem. But interest rates are still close to zero. So if you got 8% inflation, and again, that's the government's version of inflation. In reality, it's about twice that much. Prices are probably rising by 15% a year, even though the government claims they're only rising by 8%. But even if you accept the government at its word that we've got an 8% increase in prices, yet you're getting a 1% yield on your dollars, you're losing 7% a year. So the amount that you're losing is substantially greater now. And I don't see that changing. The government is talking about fighting inflation. The central banks are talking about fighting inflation, but that's all they're doing. They're talking. They're not actually fighting inflation, because you can't fight 8% inflation with 1 or 2 or even 3% interest rates, because you still have negative interest rates. You're still encouraging people to go out and borrow money and spend it. In order to fight inflation, you have to reduce demand for credit. You have to have less consumption, but no, we're still encouraging it. And no governments, particularly the US government, is reducing government spending, which is at the core, the reason for inflation, because the government is spending money that it doesn't collect in taxes. And now the Federal Reserve is printing the money, monetizing the debt, spending that money into circulation. That's the inflation. It's the expansion of the money supply. And the money supply is not going to stop growing because the government is not going to reduce spending. That nobody is talking about. In fact, even the Biden administration is talking about increasing government spending as a way to fight inflation. So they want to pour gasoline on the fire under the assumption it's going to go out. They need to cut government spending, or they need to raise taxes on the middle class, not on the rich. If you raise taxes on the rich, you reduce investment, and that reduces supply. We don't want to reduce supply. We need more supply. We have to reduce demand, which means we have to raise taxes on the middle class, because they're the ones that are consuming. And if we raise taxes on them, they'll stop consuming, or the government has to cut Social Security, cut Medicare. None of these things are going to happen. So inflation is going to continue. We have so much debt, they'll never let interest rates be positive, not even close. And so we've destroyed the monetary system. There is no way that you could use the dollar or any other fiat currency as a long-term store of value. So the world needs an alternative. Everybody needs something as an alternative to the dollar or the euro or the yen or any of these currencies, because you can't save them. You can use them in commerce. I mean, as long as somebody is willing to accept them, and that, may change. People may no longer want them, but as long as, the grocery store will accept dollars, well, I can use dollars to buy groceries, but I'm not going to save my dollars to buy groceries next year, because the price will be a lot higher. So I want to get rid of them. But if I want to save, I've got to find something else that I can save. Now, there are a lot of people out there in the crypto community that think that they've got the answer, right? Oh, well, we're going to save Bitcoin. Bitcoin as an alternative because it is a viable store of value, because there's only 21 million Bitcoin. And so Bitcoin could work. Bitcoin can be a replacement for the dollar or the euro or any of these other currencies. And I don't believe that that is going to happen, because I don't think Bitcoin has any of the characteristics that would enable it to succeed as a store of value the way gold succeeded as a store of value for thousands of years and worked as money, worked as a medium of exchange, as a unit of account, in addition to store of value. People think Bitcoin is some type of modern version of gold, digital gold, gold 2.0. They think it's even improved on gold. Well, none of that is true. Bitcoin is fool's gold. All it is a token, a digital token that is marketed and represented as if it was digital gold, but it's not. It's just a string of numbers that was created by solving a math problem. And in the process, lots of energy was consumed and wasted solving a math problem to create something of absolutely no intrinsic value. See, the reason that gold is a store of value is because gold actually has value that can be stored. What is the value of gold? Gold is a precious metal. It is the most useful metal on the periodic table. Gold's properties as a metal can be stored for future use. So it's ideal as a store of value. And then because of its other properties, you can melt it down, you can make it into coins, Every coin is exactly the same. Every ounce of gold is exactly like any other ounce of gold. So if I loan you an ounce of gold and you pay me back, if you pay me an ounce of gold, I'm whole. And that's where Gcoin comes in, because I think Gcoin has, or was created to be the best digital version of gold. It is a crypto token that is 100% backed by gold, and each G coin represents a gram of gold. And if you have 10 G coins, you can actually go to the company that is creating them and that is storing the gold and get your gold. You can get a 10-gram bar of gold in exchange for your G coins. So your G coins will always be worth an ounce, a gram of gold. If they're not, if the price of G coin were to ever fall below a gram of gold, well, you could just go and get your gold. If the price ever got too much above, then the premium would ultimately come down, because people would not buy them. They would just buy gold. And so you have a natural arbitrage that's going to go on. I would imagine that G coins would trade at somewhat of a premium to the melt value of the gold, just like a Maple Leaf or a Krugerrand trade above the melt value, maybe 4 or 5% above, because of the added convenience that the coin creates. So I think this is where the world is going. The way to move away from fiat currencies and have an alternative monetary system that the private sector can develop. We don't have to wait for the government to go back to a gold standard. Anybody can return to a gold standard on their own by utilizing Gcoin, because I can run my life in Gcoin. If I am a merchant and I have a store, I can price my products in Gcoin and I can accept payment in Gcoin. You can't do that with Bitcoin. No one can price a product in Bitcoin because it's too volatile from day to day. You'd have to change the price every hour if you're pricing in Bitcoin. Gold is not volatile at all. It is very easy to price your products in gold. We did it for hundreds of years, thousands of years. So you could price your products in Gcoin. People can send you Gcoin to pay for the products. Nobody does that with Bitcoin.
So is this akin to a stable coin then?
Yes, except it's stable to gold. See, the problem with stable coins that are stable to the dollar is the dollar itself is not stable either. So it doesn't make any sense, if you don't like dollars, to take a coin that's stable to the dollar when the dollar has no stability. Now, you also have these stable coins that aren't even backed by dollars, that are backed by some algorithm, like we had with the Luna Terra coin, which went to zero. Right. And so did the Luna token. Those things imploded because whatever these geniuses thought they invented didn't work. And so people wanted a stable coin, but it didn't work. Now you've got this other one out there, Tether, which at least in theory is backed by the dollar, because supposedly Tether Labs, or whatever the company is, there's something like $70 billion worth of Tether in circulation. I think 70 billion.
That's just what they say. They are unwilling to show evidence. I mean,
right now they claim that for every Tether is a US dollar sitting in deposit somewhere. Now I doubt that. I mean, I don't even think they would have 90% or even 50% reserves behind those Tether. I think it is a fractional reserve. They certainly have some dollars, but the question is how many? We don't know. There is no audit. And I eventually think that Tether is going to collapse. And I think that part of the fraud in Tether is that the supply of Tether is artificially inflated in order to prop up Bitcoin. So when Bitcoin price really starts to fall, they just create these counterfeit Tethers and they use them to buy Bitcoin. And that keeps the price up. But the people who are selling their Bitcoin, they think they're getting paid dollars. They're not. They're getting paid Tether. Well, they think that Tethers are the same as dollars. Well, they're probably not. Now, as long as people are willing to accept them as dollars, they are. But what happens when there's eventually a run on the bank? What happens when people who have Tether get worried that maybe I don't have anything and they want to redeem. Now, most people who have Tether can't redeem them. You're stuck because there's some kind of minimum amount. You have to have, millions or I'm not really sure what it is before you can actually get any dollars. So the typical guy with 1,000, 10,000, 50,000 worth of Tether, all he can do is sell them to somebody else. He can't redeem them. But what if nobody wants them? They're going to start to get marked down if people start to be afraid. And so they're going to lose the peg and the price is going to start to crash. And then as that happens, now you get a run and the whole thing is going to blow up. But a coin that's stable to the dollar could work to the extent that they actually hold the dollars in a verifiable form where they're not going to lose them. Because also, what if Tether took those dollars and made very risky loans with them and the loans go bad? Well, they don't have the money anymore. So the dollars have to be kept in something extremely safe where they're not going to be lost. But again, it defeats the purpose. You don't get out of the dollar by getting into a stable coin that's pegged to the dollar. Now, maybe you own a token that is more fungible online, that it's easier to use. You can circumvent the banking system. But even that is changing because now there's all this new regulation that's coming for cryptocurrencies that are going to make using cryptocurrencies a lot more expensive. In fact, I think when they finish regulating the industry, it'll be cheaper to use Western Union. It'll be cheaper to send a bank wire than to send cryptocurrency because of all the compliance that's going to have to be used in order to do it. All that is going to add to the transaction costs. Part of the original appeal of Bitcoin was, hey, you didn't have to deal with all that regulation. Right? Why was Uber cheaper than a taxi? Because they didn't have all that government regulation. Right? Well, as more and more regulation comes on, well, the cost of Ubers are going up, and now it's not as good a deal. Well, that's going to happen to Bitcoin. In fact, the initial appeal of Bitcoin was to criminals because it was anonymous. You could, conduct crime. You could buy drugs or, other things online, with more privacy. But now it's like, oh no, there's no privacy. Everything you do, it's all being tracked. And so Bitcoin is no longer has that appeal. Now the appeal is purely to gamblers who think the price is going to go up. But why should the price go up when it has absolutely no use, has no value whatsoever? So all of this is pointing to something like Gcoin, where you have something that marries the best of both worlds, that keeps the properties of gold, store value, stability, but you improve it with the qualities of the blockchain that makes gold more divisible, more portable, an even better medium of exchange and unit of account than it was in its physical form. That's really digital gold, right? Gcoin is in fact digital gold. Bitcoin is not digital gold. No more than a image of a house is a digital house, right? Because if I say, hey, here's this digital house, look at it, it looks just like a house. Okay, well, can I live in it? Does it provide me with any shelter? Can I raise my family in this digital house? Of course not. Can't do anything with it. I can, look at it. I mean, I can play some kind of video game with it, but it's not a house. Just like Bitcoin is not digital gold. It doesn't have any of the properties that gold has. But Gcoin is digital gold because it has all of the properties that gold has, because you can exchange it whatever you want for physical gold. Now, I can't use my Gcoin to make jewelry, but I can redeem my Gcoin for gold and then make the jewelry. But until I do that, it's safely stored in a reliable vault, and I know that it's there whenever I need it. And in the meantime, if I don't need it, I can have a digital representation of that gold that I could use as a medium of exchange. The store of value is because the gold is stored in a vault, but the liquidity comes from my ability to have a digital representation. And now, if I want to buy something and I'm in America and I want to buy something from somebody in Australia, I can pay them over the internet or using with my Gcoin. And none of us has to go down to a vault. Maybe the vault is in Switzerland where my gold is sitting, but I can transfer ownership of that gold through the blockchain to somebody in Australia instantaneously. And I can do that transaction quicker and for less money than trying to transfer my Bitcoin. to somebody in Australia. Except when I transfer my gold, I'm transferring something. When I transfer my Bitcoin, I'm transferring nothing.
So a G coin is sort of like a US dollar prior to 1971 that's easily transferable and digital.
What it's more like is what existed before 1913. Because prior to the creation of the
Fully
Federal
backed.
Reserve, right? And the Federal Reserve was actually created as a private business. Because under the US Constitution, the federal government can't print money. They're not authorized to print money. And even if it's backed by gold, they can't do it. All the US government can do, according to the Constitution, is coin money, which is take gold and silver and make coins out of it. That's all it can do. The states can't do that. All the states can do is make gold and silver legal tender. They can't make anything other than gold and silver legal tender. And the government can't make anything legal tender because it doesn't have that authority in the Constitution. All it can do is take the gold and silver that the states are using as legal tender and make a coin out of it and decide how much gold is in a dollar, how much silver is in a dollar. That's what the government can do. But that, they can't print money. But they created the Federal Reserve to be a private bank to issue currency backed by gold. And the original Federal Reserve notes were backed by gold. That's how they were created. But before the Federal Reserve, before there was a central bank, there was no central bank. There were just individual banks all over the country. And each of those banks issued its own currency backed by gold. The thing was, there were so many different currencies circulating around. The idea was, hey, let's just have one. Because what if I've got a banknote from a Philadelphia bank and I go out to California and now I want to spend that money? Does somebody in California know that it's real? How do they know? I mean, we didn't even have airplanes. They didn't have telephones. How do you even check, right? I mean, you're 3,000 miles away. I mean, is this real? I mean, I never heard of that bank. The idea was, hey, if we have this one bank that everybody knows about, and then there were other things that they said would be accomplished by the introduction of a central bank. But again, prior to that, you had each private bank would issue its own currency backed by gold. That's more of what G-Coin is. It's a private company. They're not a bank, but they're a private company, more like a goldsmith. Because before the banks were around, it was goldsmiths that were holding on to the gold and then issuing notes that circulated as money substitutes. So we're going back to traditionally how currency was created with gold backing, except it's much more useful because of the improvements in technology that we have now that the blacksmiths didn't have. All they could do was write on a piece of paper, pay to the bearer on demand, 10 ounces of gold, and then give you that piece of paper, that would circulate. But now with G-Coin, where they can create a digital representation of a gram of gold, where you could break gold down into grams, and now it exists on a blockchain where I can exchange my G-Coin with anybody else around the world. Now you have a viable medium of exchange, unit of account, store of value. You have everything that Bitcoin aspires to be, but can never be because of the fatal flaw that it isn't a store of value and therefore can't be stable enough to be used as a medium of exchange or a unit of account, and obviously can't be saved over a long period of time. So G-Coin solves all the problems. And of course, it doesn't have a monopoly. There are other companies that can also create a cryptocurrency that's backed by gold, competing with G-Coin in the marketplace for trust, for confidence. But from all the projects I've seen so far, this one, I believe, is the most viable and has the most potential. And I think it has the potential to be widely circulated and widely accepted around the world. And then, if you have one or several cryptocurrencies backed by gold that are more recognized, then that's what people will want. They may not want, hey, if you come up with some cryptocurrency backed by gold that no one's ever heard of, people might be reluctant to accept it. Well, how do I know the gold's really there? Give me G-Coin. G-Coin I trust. G-Coin I have confidence in. And since Gcoin, the company, it's being issued by a private company, Quinta, they don't want to, they want to cultivate the value of that brand. They want to be able to mint G coins. They want to be able to issue them at a premium, just like any other mint, right? If you have, let's say, the Canadian government that makes the maple leaf, they're going to make sure that every maple leaf has an ounce of gold. They're not going to chintz. They're not going to put a little less than an ounce in there, because if people find out that they're not putting all the gold in their coin, their brand is going to be destroyed, and they're not going to be able to make them anymore. People won't trust them. And so the same thing with Gcoin. They're going to make sure that they have a gram of gold for every a Gcoin that's in circulation. They're never going to want to risk a run on the bank where they don't have the Gcoin there, because it would destroy the brand that they're working hard to cultivate, and that brand will have a value in the market that they want to protect and preserve.
Okay, well, look, no, there's no question, Peter. I believe there's, it's these crypto or digital currencies. It's a nascent market, and I think all of these cryptocurrencies out there that are not fundamentally backed have a reckoning ahead of them. So there's certainly a market out there, provided the trust is there and it's backed by real things like gold. So that's interesting. I'll look into more. But before we close out here, I just wanted to go back to something we talked about earlier, and that's inflation. I think that's something, a prevailing issue on everybody's mind. And you talked about how the Fed is not really taking it seriously. Now, the question is, I don't think the Fed are stupid. I think they're smart. And I think they know what they're doing. Now, my question to you as we exit here is, are they serious about fighting inflation, or do they want inflation?
Well, they've been creating inflation for years. Remember, the central bankers have been telling us that the problem was we didn't have enough inflation, and their goal was to create more of it. And I always maintained that that was a lie. It was an excuse, not a problem. The problem is governments have too much debt. They can't possibly repay it. So the only way out is to inflate it away. The central banks are helping governments repudiate debt through inflation. But also, because governments have so much debt, interest rates have to stay low. Otherwise, there's no way that governments can service it.
So is that their way out? Is that their way out? Is that what they're planning to do?
Well, it's not a way out. It's just a way to kick the can down the road. And they have been successful in doing that for some time, but the success comes at a cost. The cost is they make all the problems that they don't want to deal with worse, because now governments have even more debt, which is even more impossible to service. So governments are keeping interest rates low, not because we need more inflation, but because the government needs it. The government needs the artificially low interest rates. And the central banks have inflated these asset bubbles that would implode if interest rates were allowed to go to a free market level. And they're afraid of the negative ramifications in the short run to employment and the economies if they allowed this whole house of cards to collapse. Of course, the sooner that happens, the better. From a long-term perspective, we have to allow all this stuff to collapse so that we can rebuild something real in its place. Governments are undermining long-term economic growth with artificially low interest rates and inflation. But from a political perspective, they don't think they have a choice, because all they care about is, how do we delay the crisis? How do we make sure it happens later, not sooner? Because we want it to happen on somebody else's watch. We need to get reelected, and we can't run for office in a complete crisis. And so it's all about trying to postpone the day of reckoning. But at some point, you reach the end of the lane, and you can't do it anymore. You can't kick the can down the road. And that's when I think you're going to have a real monetary crisis, where inflation is going to just run out of control, because they can't, fight it. They can pretend, but they can't admit that they can't do it. But eventually the markets will figure it out. And, that's when you're going to see a stampede into gold, because right now gold is not really rising. It's hanging out around 1800, 1850, because all the people that thought we didn't have enough inflation, and then thought that, okay, we've got inflation and it's good, and then said, oh, inflation is high, but it's transitory, don't worry about it, right? All those people that have constantly been wrong about inflation now think inflation is peaked. Why do they think it's peaked? because they think the Fed is committed to eradicating it. Well, why? Well, because they said so. Well, who cares what they say? They say a lot of things that aren't true. They told us subprime was contained. That wasn't true. They told us there was no housing bubble. That wasn't true. Then they told us inflation was transitory. That wasn't true. Now they're claiming they're going to bring inflation back down to 2%. That's not true either. It's not going to go down. It's going to keep going up. And when the market recognizes this, when individuals recognize this, they are going to rush into gold, and they'll rush into G-Coin as another way of owning gold in a marketable form, because a lot of merchants in an inflationary environment with runaway or hyperinflation are going to look for an alternative as a way to be paid for their goods and services with something with reliable purchasing power. And that's where G-Coin can come in. You see, right now, nobody really wants that. For all the talk in the crypto community, especially Bitcoin, about we want Bitcoin as a stable store of value, as an alternative to gold. Nobody is buying it because they think it's stable. Everybody is buying it because they think they're going to get rich. They think Bitcoin is going to 1 million or more. There's nothing stable about that. You don't get rich with a store of value. What you do with a store of value is you stay rich if you already are rich. You avoid going broke, but you can't get rich playing it safe. It doesn't make any sense to claim on the one hand, Bitcoin is a safe store of value. On the other hand, if you buy it, you're going to get rich, right? Those are mutually exclusive propositions. But people are buying it because they think they're going to get rich, claiming it's a store of value. But when people are no longer trying to get rich, when their main goal is to avoid going broke, they're not going to want any of these cryptocurrencies. There's going to be a run on them even before there's a run on the dollar. They're going to crash. And when people really want what they claim Bitcoin is, an inflation hedge, a safe haven and store of value, they're going to want gold. But I think a lot of the people who are used to digital currencies and blockchain, they may not buy real gold. They may not go and buy, gold in its physical form and have the coins and bars shipped to their house. They may just go online and fill their wallets up with G-Coin, which is real money, real digital gold, not fake digital gold, fool's gold, like Bitcoin. So that's coming. You just have to see a change in priorities where it goes from greed to fear. Bitcoin is all about greed. And in fact, the only fear involved in Bitcoin is the FOMO, the fear of missing out. But that's really greed. I'm not going to get rich. I have to buy this because if I don't, everybody's going to get rich but me. When we really go from from greed to fear, I'm going to lose. Inflation is going to wipe out the value of my savings. And Bitcoin is just a pyramid, a Ponzi. And if I don't get out of that, I'm going to lose all my savings there too. You're going to have people rushing to get out of fiat currencies and fiat cryptocurrencies into a real alternative store of value, media of exchange, and they're going to be buying G-Coin.
Okay, Peter. Well, look, that's very informative, and I appreciate your time here at Ore Day, and we'll let you go and enjoy your time back home. And if anybody has any questions, how can they find you? Twitter?
I'm around.
You're around.
I do my own podcasts, the Peter Schiff Show. I would encourage people to listen to my podcast. Usually I do 2, sometimes 3 per week. You can listen on Schiff Radio. I post them all up on my YouTube channel. I also now have a locals channel where people can get my podcasts commercial free, get them a day early. So there's a premium service now that I recently launched. But I think if you make a habit of listening to what I have to say, because most of the stuff that I'm saying, it all happens. Sometimes it happens 6 months or a year later. It's interesting that I often talk about on my podcast how things are happening exactly the way I said they were going to happen, only in the past. And you'll read articles that'll say, oh, this is happening and why it's happening. And yep, that's exactly what I said in real time. So I don't wait until something happens to talk about it. I talk about what's going to happen before it happens, because the information is much more valuable if you have it in advance, right? If you're just being told about what already happened, well, that's kind of too late if you're trying to make money off it or plan. But if you're warned in advance, if you know what's going to happen before it does, that information is valuable. And that's the type of information that I am providing, on a weekly basis on my podcast.
All right, sounds good, Peter. You heard it here first at Ore Day. We appreciate your time. You have a good one.
You too.
Please welcome back Anthony Moreau, CEO of American Eagle Gold, and Stephen Stewart, Chairman of the Ore Group.
Tony, welcome back to Ore Day. You and I have known each other for, 4 or 5 years? We've been working together for a couple years. It's great to work with you. You're the CEO of American Eagle Gold. We had a drill program earlier this year in Nevada. Now we're focused on our drill program coming up at the NAC project up in northern BC. It's been a tough market. No way around that for all gold juniors. But now we're focused on the NAC project. So tell me about what that project means to you, what our plans are, and what, hopefully the expectations can be.
Well, I'm extremely excited about NAC. It has been a tough project, but I think we're in a very good position because we have cash, and I believe we have a world-class targets and high potential to hit some mineralization. What attracts me about NAC, first and foremost, is located in Canada. NAC found us. I was introduced to NAC in August, September 2021. When I first saw it, I said no to it. I took a world-class geologist to bang his hand against the table. I call this guy Dr. Death because he says no to every single project. He said, Tony, you're not a geologist. You can't see the forest for the trees. Because all I saw, Steve, was 0.21% non-compliant grade of copper equivalent of 275 million tons, which is a big deposit. But I saw low grade. And he said, Tony, the future of the copper gold porphyry deposits, they're underground and they're high grade. He goes, this has only been drilled shallow. So 104 meters, different drill holes on this property, over 18,500 meters of drilling, the average depth, 169 meters.
Okay.
If you look at GT Gold, you look at Sol Gold's deposits in South America, those giant deposits start at 500 to 600 meters. There's been a whole lot of work done here. They just scratched the surface.
Okay.
Well, what we do know, there's a giant mineralization at surface. When we drill there, once we get the permits, hopefully by July, we'll be going through mineralization. What we want to do is get to the 500 meter level and hit high grade and show people that this Babine district is for real. It's the next golden triangle.
All right, so let's start from the basics. So this is a porphyry target, correct?
Yes.
Okay, and we're a big porphyry environment. There's porphyries all over the place. There's been historic mines in the area. And when we saw this project, the first thing we saw was the historic work. I believe a lot of it was done by Noranda, a very reputable group. As you said, they drilled a lot of holes, and they've defined, as you said, a historic, non-compliant resources. It's big. What did you say, 300 million tons?
Almost 300 million tons of 0.21% equivalent.
It's low grade, not all that interesting. But
well, Stephen, the thing is, people only drilled shallow there. When Noranda was looking at copper is at 60 cents a pound. You're not going to do underground mines. Now copper's at $4, $4.50. People believe it's going to go higher. I certainly do. Copper's a pipeline for electrifying the world, which we know we're going to do. So people know it. It's only going higher. And these underground deposits, they're the future if you want to find more copper.
So typically these porphyry deposits, obviously they form zonations, and at the top you sort of see the froth. I always think of that like a latte, and it's sort of the froth. And that's kind of what we see with this 300 million tons low grade. Since that deposit was drilled out by Noranda, though, there's been substantial geophysical work done, which has delineated targets at depth. So as we know, these porphyries come obviously from depth. They had never really seen it before. Now we see, all this froth. And with this geophysics, now we've got clear targets. I believe we're planning, 8 to 10 drill holes this summer? Is that the plan?
Yeah, right now we're looking at about 4,400 meters. We have $1.5 million we got from flow-through financing. We're looking at anywhere from 6 to 9 drill holes between 500 and 800 meters in depth. And that was a great analogy you said about the coffee and the froth. And what I think of it is a fire. You got the smoke at the top, but we want to get to the heat. We want to get the fire underneath. And that's where we'll be drilling. And if you look at this area, again, people are looking for open pit deposits. Historically, this has all been shallow drill holes, but everywhere that they've drilled, they've hit mineralization. And if you look at our presentation, you can see the holes that did go deep, they got higher grade. So we want to be the ones that do it. There's been a lot of work done on this. Over $10 million has been put into this. The hard work that was done was the last year. The company that we actually took the option from, they did the hard work the companies don't want to do. They digitized all the data. That took a whole year to do. And they took every little piece of work that was done. There's 5 pieces of work done on there: ZTEM, IP, Geochem, the drilling. Every company that worked on there before, they worked in a silo. They just looked at their own piece of work. You know what they did? They walked away. Why? Many different reasons. Looking for open pit, shallow deposits. Copper price was too low. And what we did is we combined all the different information. Our decision here, it wasn't a closology play. It was a data-driven decision that I was forced to do because I talked to a geologist. He helped us make this decision. He actually did the original mapping at Freeport's mine, Grasberg, in Indonesia. And he said, you got to get this deposit. It is the real deal. When you see one data set that shows a potential anomaly, you might drill. You see 3, you have to drill, Steve. You see 5 that show the same data sets, potential anomaly, it's a home run. Every single piece of work that's been put on this property has shown the same anomaly. You put that all together, we have the drill holes, we're working on permits, and we have a lot of catalysts coming up in the summer, which I'm very excited about. It's all about creating that news flow. It's all about having the investors know that American Eagle Gold exists and the NAC property is the one that we're going to drill at. I can have ounce dollar coins and sell them at Mount Everest at the top of it. I'm not going to sell anything. The key here is allowing people to know American Eagle exists and NAC is our property and explain them more and more about it.
Well, you're right. American Eagle is not known just yet, but I think the best opportunity for that is to have the drill results speak for it. But I guess in order to get there, we had to do, sounds like a lot of work was done in data composition, had a lot of really good eyes look at it. We're working now with Charlie Gregg, who I guess you also mentioned GT Gold. Is this sort of analogous to GT Gold in the same environment, same type of deposit we're looking for?
Yeah, you're looking at it in the same way that GT Gold was underexplored before. You can look at the Golden Triangle in terms of where we are. That's where we are, 10, 15 years ago. Wasn't really drilled, a lot of shallow, low-grade deposits, and they drilled deep in that area, and those are the deposits they're finding. They're not finding open pit, shallow deposits, they're finding deep ones, and that's the Babine District where we're located. And thanks for mentioning Charlie. You can have a Lamborghini, Steve. If you're blind, you're not gonna do anything with it. We have NAC, but the key to NAC isn't just the fact that it's a great property, it's having those great geologists behind them that know what to do. We have a team of great geologists. We have the individual I said first that used to work at Freeport, the copper gold porphyry expert that helped discover Grasberg. But second of all, we have an individual named Steve McMullen. He actually did the original geophysics for Kamoa, that's Ivanhoe's mine in the Congo. He agrees with everyone else. This is a great project. These are great targets we have to drill. And lastly, you need the team at the site on the ground that knows how to make the discovery, knows the ground, knows the area. That's Charlie Gregg.
That's Charlie, yeah.
Charlie led the team at GT Gold to make that world-class discovery. I believe they sold it to Newcrest last year for around $400 million. He's running our exploration play. And Steve, one thing you should know, the mining market is hot. It's very, very tough to find skilled individuals to work for you. And the reason why they work for us, it's not because we have $2 million in the treasury. It's not because you and I are such good people. It's because they love these projects. They're excited to work on them, and they really do see the potential. And what my job is, what your job is, and what our people that work for us on the marketing side is to help the public understand what these geologists know and what they see, and get them to buy the stock and get them to invest, because we really do believe that there's a lot of upside.
All right, so in terms of catalyst, obviously, clearly, we're going to be drilling the NAC project. I think we're getting very close to it. It's now June, probably going to get our permits hopefully this month, maybe July, and then we're ready to go. My understanding is that we've got the drill contractor, we've got our team, we know exactly where we want to poke these holes. I think now is a fantastic opportunity to get involved in American Eagle Gold. We're trading practically at our cash, and we've got this great target. So talk to us about this catalyst. What can shareholders expect in the near term?
Well, you mentioned, Steve, getting the permits, that's key. I think a lot of people don't believe we can get the permits. We have every reason to believe we'll be able to get them within the next month. Within 2 weeks of getting our permits, we'll have a driller on the ground and start drilling. Within 2 weeks after that, we'll be able to send the core and begin getting our assay results. We have a lot of news coming up. If you look at our company, we're fully cashed up. We're in a safe jurisdiction, BC, arguably the greatest jurisdiction in the world to be searching for copper. And we have a great team behind us. We have 3 world-class geologists that all say the same thing. NAC has huge potential, and this could uncover another giant jurisdiction in Canada for copper and gold.
All right, I love it, Tony. There's only one way to find out, and it's never stop drilling. Looking forward to those results. So good luck to you and your team.
Thank you very much, Steve.
Good afternoon. My name is Anthony Moreau. This is my webinar on American Eagle Gold. Our stock is traded on the TSX Venture under the symbol AE. This is our forward-looking statement. It's a quick corporate overview. We have 69 million shares outstanding. It's very tight held. 54% are held by insiders and institutions. Of that 54%, 42% is comprised by insider holdings. This is our board here. And as you can see from our share price, we're not going to hide from it. Our share price has gone down quite a bit, but I believe that creates a good opportunity for investors. I believe we have a good risk profile, and I believe there's a lot of opportunity to come with plenty of news on the horizon. So the focus of American Eagle Gold is on jurisdictions that are perceived as being safe. We are located in BC and we're located in Nevada, two of the safest jurisdictions in the world. Quite frankly, if you want to be located anywhere in the world to be exploring, you want to be in Canada 1, Australia 2, and US number 3. Now, what we're looking for are big ore bodies, world-class ore bodies that if we hit, we will cause big news on the stock market. We believe our shares will go up. Sometimes you miss, sometimes you hit. We drilled in Nevada last December. We missed. Our share price got hit. But we believe our misses are behind us. We're very confident about our project, NAC, that's located in BC. And again, we start drilling hopefully in July. And we're fully funded for our drilling program. So where are we located? We're located in BC. Our NAC property is located right near Smithers, that historical mining here. Now, recently, there's a lot of bit of information in the news and the stock market, the junior venture exchange. The Golden Triangle. The Golden Triangle is northwest of us. You have these huge mines, Red Chris, that's now owned by Newcrest. You also have the GT Gold discovery, Tatoga. Within 3 years, they went from drilling to a $400 million acquisition by Newmont. Our area, we believe it can be the next Golden Triangle. Historically, there's been a lot of mining there. Most of it was open pit. There hasn't been a whole lot of exploration underground, but as I'm going to show you, if you want to find a high-grade copper gold porphyry deposit, you're not going to be finding it at surface. You're going to be finding it at underground, and those ore bodies start at around 500 meters. Historically, on our property, there's been over $7 million of spend. There's been a lot of work on our property. Problem is, the work started, in the 1960s. Copper was around 40 cents a pound. Copper's been up and down since then, but copper never had a consistent streak where it was above $4. Now that copper has stayed above $4 for quite a while, and there's long-term bullish fundamental future growth for copper, makes a lot more sense to be drilling underground as well. With the discovery at Tatoga/Saddle, also with Sol Gold's discovery down in South America, and a lot of the copper gold porphyry discoveries, they all exist underground. And good luck permitting anything that's open pit anyway. So the future really is trying to find those underground deposits, and quite frankly, they exist deep. They're take a little bit longer to drill, but there has been some recent history of discoveries. So that's what we're going for at NAC. So NAC, look, the great thing about it, it is a low-grade surface deposit. It's at surface. Unfortunately, it is low-grade. When I first saw this deposit, when this first came across my desk in August, September, it didn't attract me. I said no to the project. I just saw low grade. That's what the retail investors see. You can be blind. If you have a Lamborghini, it's not going to do you any good. Now, if you have a great property, you don't have great geologists, that's also not going to do you any good. We rely on smart geologists. They're the ones that have the track record to make discoveries. They know the rocks. And I had a certain geologist. He worked at Freeport McMoran. He did the original mapping at Grasberg, arguably the greatest mine in the entire world, a huge copper gold porphyry deposit. It's so big on the copper side. They produce 1.2 million ounces of gold a year there, and that just comes in as a byproduct, just to give you an example of how rich Grasberg is. Anyway, this geologist came back to me. He had showed me NAC once, and he was banging on the table. He says, "Tony, you got to get this asset." And I said, "It's too low grade for me." He said, "You don't see the forest for the trees. You're not a geologist, and what you have to understand is these underground deposits, they have low-grade dissemination of ore at surface." He goes, "You're very lucky. You got a huge halo, a huge resource there already at 0.21% copper equivalent of 275 million tons, albeit non-compliant." He said, "It's like a house fire. At the very top of that house, you have billowing smoke. It's kind of warm." He goes, "You got to drill through that smoke. You got to get into the fire at the bottom of the house." He says, "The same as these copper gold underground deposits. You got to drill through the lower grade that's at the surface, and you got to get into the meat of the deposit, which exists between 500 and 700 meters underground." This got my attention. He said, "You got to get this. If you get this, you're going to have a lot of news coming out." Very worst case scenario, we're going to drill this. We're going to get mineralization at surface. what we're aiming for is a higher grade that's going to exist underneath between the 500 and 700 meter level. The guys that we actually optioned this property from, they spent a whole year, they digitized all the data and they put all the data together. And what it showed was all 5 different data sets on this property demonstrated there's a high potential to hit high grade or underneath. They have ZTEM, they have IP, they have geochem. There's 18,500 meters of drilling. All the work's been put there. This was a data-driven decision to make this purchase of the option. And everything shows that there's an anomaly. Now, if you have one data set that shows potential anomaly, you might drill in these days with 450 copper. If you have 3, you're for sure drilling. 5, you potentially have a tiger by the tail. All 5 of our data sets show the same thing, and they demonstrate the high potential for a high-grade underground deposit. Now, if you look at the picture here, this is Red Chris on the left. Red Chris isn't profitable right now at their open pit. That's low-grade open pit surface deposit. Now, why they got purchased and why Imperial got purchased is for the block cave potential. Imperial never had the money to really demonstrate how they could exploit this deposit. Now, with Newcrest taking over, they're going for the block cave underneath. And as you can see in this box on the left, all the high grade exists at around the 700 meter level. Our deposits on the right, you can see the web at the top. That's a low grade dissemination at surface. And as you can see, the lower you get with those red little squares, the higher the grade gets. Now, no one's drilled underneath the 300 meter level. There's been 104 different drill holes. The average depth of the drilling was 169 meters. Now, they just scratched the surface there. We haven't even hit the bottom of the iceberg here. If you want to actually hit this, these come from apophyses underneath. You got high grade stocks that feed the low grade dissemination at surface. And what our drill plan is to drill 5 to 7 drill holes with a 4,400 meter drill campaign to start testing this hypothesis that the greatest geologists in the world seem to think exists. Now, I mentioned the first geologist that was actually did the original mapping at Grasberg. We have another geologist, his name's Steve McMullen. He previously worked at Ivanhoe. He did the original geophysics at the Kamoa mine. He also has a track record. He also believed that there's high potential at this SNAC deposit. Now, we have Gary, we have Steve, we have a third individual who we believe is actually the key to actually making discovery. His name's Charlie Gregg. And Charlie was the head of exploration for GT Gold. GT Gold's the most recent, closest mine in the area that made a world-class discovery. He has a team. He knows how to work in BC, and he knows what to look for. So he's actually the one on the ground leading the exploration team and actually working in that and running our drill program this summer. So the image on the left just combines all the different geophysics and work and drilling that we had, and it creates the hypothetical stock that we believe exists underneath. So as you can see on the right, this horizontal oval is what we believe could be the ore body. Up above that webbing is the low grade dissemination at surface. And what we're going to do is we're going to drill right through the smoke into the fire, into the heart and the belly of this ore body. So again, we believe that the start of the high grade exists at around 500, 600 meters. We're going to test this with 5 to 8 drill holes, averaging around 600 meters for a total of 4,400 meter drill campaign. You can see our halo is very big. We have a big area of land here. We already know exactly where we want to drill. Again, we had a data-driven decision here. It was all based on geology. We know we're going to come out with news. The question is how high grade our ore is going to be. What people are waiting for right now is our permit. So right here, you can see all the historical drilling. We had some great drill holes. You can go back to the presentation and see them. If we came out with these New Year's releases right now, I believe the public would pay attention. But we're going to drill right through all these low grade at surface and hopefully hit the high grade underneath. So what we're doing right now, the market has to believe us. We missed at Golden Gate. We believe we're going to hit at NAC, but we're waiting for a permitting. We've been working on permitting since December. We've been at site twice. We're working with the First Nations community who we believe and know are our partners. And they support us from everything that we've spoken to them about. So we're just waiting for the BC Ministry to approve our permits. Once our permits are approved, we have already signed our driller, their ITL. And within 2 weeks of our permits being approved, which we hope happens sometime in June, we're going to be commencing drilling within 2 weeks after that. So our plan is to commence drilling in July, early August. Within 2 weeks of us drilling, we'll be pulling core out of the ground. And within 4 to 6 weeks after that, we'll be coming out with our assays. But once our permitting starts, once our permitting is approved, we believe the market's going to start noticing. We believe copper, it has long-term bullish fundamentals behind it. And now that our miss is behind us, I believe there'll be a lot of anticipation for our new drill program. Again, we have great geologists behind us. We have historical work to base where we're going to drill, and we believe we have a high probability to hit something. So please pay attention, watch our story. It's American Eagle Gold. We're traded as AE on the TSX Venture. We're very excited for 2022. We're going to get a permit soon, and we expect to start drilling. So again, AE on the TSX Venture. Thank you very much for watching this webinar.
Introducing Derek Teevan, Vice President, Strategic Engagement.
So Derek, welcome to Ore Day. You're a relatively new addition to the team, but I've known you for about a year now, and I guess when I first met you, I found you to be extremely knowledgeable in ESG community engagements, and certainly your track record speaks to that. You were involved, I think, early days from Detour and even the Victor Pipe. So welcome, and tell everybody a little bit about your background.
Thank you. It's glad to be here. This is a nice, innovative day of getting the messages out. I'm pleased to join the Ore Group with the pipeline of projects that you have. As you know and mentioned, I had been involved previously with some majors with De Beers, as well as helping build the Detour gold mine, right from the early permitting right through to construction and operations. So this is exciting for me to be back at sort of the grassroots. As you mentioned, at the grassroots is where the communities, where the early permitting and relationship with government happens, and where we really set the framework for a culture of inclusivity and for the setting the bar, if you will, or the table of an ESG philosophy for the group of companies. So I'm really pleased. I've had the opportunity to go and visit QC Copper, meet the people in Chibougamau and Chappé, to see their excitement about it, reinvigorating that community with a brand new mine. I think it's fantastic that the energy that they have, the fact that it's going to be that close to town, and what we can actually bring as we develop the asset over the next few years. The same is true around Baselode, for example, and I really like that diversity of your copper, gold, and uranium. That's new. Uranium is new to me in terms of looking at the importance of how you engage with a community when you're dealing with sort of the radioactivity issue. Again, I think the Baselode team is fantastic in terms of how they're engaging with Indigenous communities and local communities about that. Again, the communities are familiar with it in northern Saskatchewan, so while it's new to me, it's not new to them, but the engagement principles, the safety principles are all the same across the group of companies.
Great. So, I guess we brought you in the Ore Group. You've been advising across the portfolio, but really, when QC Copper came out with that resource, and we knew we had a mine here, and we believed that, we knew that the next step was to invest in the community relations, First Nations, permitting. It's a big process. It's a long road ahead of us. And so, as you said, you were just up there recently. I believe you met with the mayor. You met with some townspeople. What was your sense about Chappé and their welcoming of this project?
Incredibly welcoming. It's it's a small Quebec town, but it's like any other small town across the country. They want economic development. They're incredibly proud of the infrastructure that they've built there. They know their history. Again, the mines opened in the 50s in that area, and certainly in Chibougamau and Chappé. They're proud of it, and they see it as an anchor in terms of their future economic development. What's happening in a lot of the small towns is that the youth leave because there aren't long-term jobs. This project could provide intergenerational experience for people. We're going to be a pit, right, overlaid where the old mine was, but that's right at the bottom of the road, right in town. And it was really exciting to talk to the mayor and some of the councillors about their experience with that, their knowledge of other mines that have been built close to town, like Malartic, that they are engaging, but they see this as an exciting opportunity. There will be challenges for us, obviously dust and noise and all the things that go on with any mine, but we know how to manage that. And we have these natural analogs, both in Quebec and Ontario, to look at and learn from. So we can develop and plan with the community and the surrounding Indigenous nations what this project could look like. Again, as you said, it's really early days, so everything is on the table for how we can make this thing work. Clean hydro, again, close to town, welcoming communities, both Indigenous and non-Indigenous, trained workforces, infrastructure such as roads. The power line is right there. The rail line is right there. It's everything that you need to develop certainly a copper and gold project right within in the municipality. It's just ripe to grow.
So when you came in, I think we discussed building what we had called a best-in-class ESG and I platform in order to move this project forward the best way we could. So talk a little bit about what that means to you.
I'm excited about that because what I saw in the OR group is a group of collectively minded individuals all doing exploration projects. What I see, having just started, is a group of people who want to build to the next tier. So advanced stage production, whether that's bulk exploration, but build a basic framework for a dynamic company, either to build and or to sell. But we have to continue to develop the assets. We have to invest in obviously in the people. That means everything from reinvigorating or creating a very positive board culture. We need to look at our board members. What does that look like? We need to look at the staff that we have, make sure we have the right people in place in Chappé, Chibougamau. We have to look at what the sort of the next kind of, I'd say, 18 to 24 months of milestones are. And that's just to build the company, never mind the investor and marketing side. We have to be able to commit to the community. We have to be able to go in and say, we're going to do X number of drill holes or meters, and we need some more space there. We've opened an office. It's a cute little office right on the main street. That's fantastic. It's the right things to do. But we have to create a vision for the company that we can get buy-in from, again, the local First Nations communities as well as the municipalities. Copper is a hot commodity. It's going to be a hot commodity. It's a hot commodity for the government of Quebec and from Canada. While not a critical metals, it is critical to the decarbonization of certainly the transportation sector and the vision that everybody has in North America and Europe for how we're going to decarbonize and reduce CO2 emissions. So this project it hits all the right notes. It's the right future metal with a growing market, with a willing community. And so we have to build our company in such a way that we can service all of those people, those communities, those stakeholders, and ultimately the market. And I believe that our shareholders will reap the rewards of that.
So the industry often talks about transition. Over at the OR Group, we talk about transitioning from fossil fuels over towards green energy metals. That's something we're very invested in. But in addition to that, I think the whole industry has really transformed its messaging in terms of ESG. I think the industry, by and large, has done a relatively good job as of late with ESG, and that's going back a decade or two relative to other industries, but there's still it's an evolving process. What I think we've done better is bringing it to the top of our messaging and packaging it appropriately and communicating that. Still, there's room to grow. But the big picture, how do you see ESG and how important is it to the mining industry?
It's critical to the mining industry. Two things that are unique. For example, different than packaged goods, a Coca-Cola or a bread company, they're often in the communities. You see those every day. Mining had a historic reputation that we've been, decades in rebuilding and reframing. But we probably haven't taken pride or as much pride in what we're doing on a day-to-day basis. Corporate social responsibility was giving back to the communities. It was being responsible. It was sort of outward facing. I think the way I describe what's happening in mining today is that we've taken those principles of environment, of sustainability, of governance, and brought them back into the core of who the companies are. Now, that's happened certainly at the majors. They have ESG committees where they might have been just the audit or, for example, the operations committees looked at sustainability issues, water management. What we see now is exploration companies who want to aspire to have great projects that they can either develop and or sell. They're, like the OR Group, are instilling the ESG values in everything they do. And that means that you have good community relations, you have great Indigenous relations, that you're careful and considerate about the environmental protection and or inspections, things that you might not have looked at as deeply or exploration companies didn't do as actively in the past. That's critical to our success. As you know, we get asked what are exploration companies doing, the exploration teams, the drill crews, what are they looking at, and what type of fuels do they use? How are they managing water and mud within a municipality or out in the bush? QC Copper is the ideal where we're starting with this, but the Eco Logo model in Quebec is the first sustainability principles and third-party audited process for mineral exploration. We've jumped on that, and we're looking at all of their models of excellence to ensure that QC Copper, which will be the first of the OR Group companies to have this Eco Logo, I'd say its ESG has been pushed down. It's been pushed down and or taken up by the most responsible exploration companies in Canada, and OR Group and QC Copper is certainly one of those.
So Derek, as we wrap up here, I got one last question for you, and it's ultimately, how does ESG drive value from a shareholder perspective?
It's a great question, because ultimately that's what we're trying to do. So I believe that shareholders are interested in the culture of a company. Do they have a can-do attitude? Have they done it in the past? Have they minimized or identified and minimized risks, whether that's human risk, again, people, environmental risk, and other stakeholder risks? Are they successful at planning? I believe that ESG is about planning. It's about understanding what you have to do, executing, and reporting on it. And that excellence is what's ultimately going to drive shareholder value.
Awesome. Thank you so much, Derek. Glad to have you aboard, and best of luck in the months and years ahead as we develop these projects.
It's exciting to be here.
Great.
Introducing Stephen Stewart, Chairman of the OR Group.
Okay, so here's an introduction to Orefinders and Mistango River Resources. These are OR Group's gold-focused exploration companies in Canada. Orefinders was the very first of our OR Group companies, and since then, it's accumulated a substantial equity position in Mistango, QC Copper, and American Eagle Gold. Orefinders has a very strong balance sheet with over $6 million in cash, plus its working capital position in the other equities, in addition to a $60 million exploration agreement with our largest shareholder, Agnico Eagle. Currently, Orefinders is actively exploring these joint venture projects with Agnico, who are paying our exploration bills. Meanwhile, our team is actively pursuing new opportunities to invest our treasury. And also, Mistango is in a near identical situation in that it has a strong balance sheet with $7 million in cash and a $60 million joint venture agreement with Agnico Eagle. Both Orefinders and Mistango have amazing land positions within the Kirkland Lake District, which straddle both the Macassa and the Kerr-Addison mines. This is exactly why Kirkland Lake Gold and then subsequently Agnico Eagle have made such substantial investments in both Orefinders and Mistango. So the bottom line is this: Orefinders and Mistango have strong balance sheets and a motivated team looking for new opportunities in a distressed environment. I think investors with a little bit of patience who want leverage to the price of gold should take a look at these two companies who are well positioned in trading near their cash levels. So please watch the following presentations for Orefinders and Mistango. Thank you. Hi everyone, this is Stephen Stewart. I'm CEO of Orefinders Resources, and I'm very pleased to be here for OR Day to update everybody on Orefinders, our first OR Group company ever, and a shareholder in many of the subsequent OR Group companies. So here we go. So the highlights of Orefinders. Well, first, I'll start off with saying Orefinders is focused in the Kirkland Lake district of Northern Ontario, where a tremendous amount of gold has been produced and continues to be produced to this day by Agnico Eagle Gold Mines. Agnico Eagle is a 9.9% shareholder and has committed to a $60 million exploration program. Bottom line is they're paying our exploration bills for the foreseeable future. They see opportunity to expand their resource base and obviously feed for both the Macassa and the Upper Canada, which will be a future mine down the road, most likely. They see opportunity to add resources, add feed on our projects. And also our projects offer the opportunity to find something new. We are on the same ground that Agnico Eagle had prior to us, and same with Kirkland Lake Gold. Very synergistic. It took us a long time to cobble these land packages together. They're not easy to get, but Orefinders has 3 very nice projects, including the Knight, Omega, and Moreau. We also, as I've noted before, we have 3 significant equity positions in Mistango River Resources, QC Copper, and American Eagle Gold. Those are all part of the Ore Group portfolio companies. 25 million shares in Mistango, which we acquired when we took over Mistango from a proxy battle. I think that created a lot of value for both Orefinders and Mistango. I think those 2 companies are very synergistic to each other. QC Copper was a spinoff. We retained 5 million shares, and I'll note we also dividended out 5 million shares directly to Orefinders shareholders. And more recently, we did the same for American Eagle Gold. So I think that's indicative of the type of opportunities that our team looks to do. We've really developed Orefinders into a diversified land package owner, as well as an opportunity that we've dividended off new opportunities while retaining, I should say, exposure to these other companies. So Orefinders is in the high risk exploration business, make no mistake about it, but we've got a nice risk model where we've diversified by getting positions in these other companies. And we've had a deal that has Agnico Eagle spending huge capital on our projects, looking for something new. In the meantime, we've got $6 million in cash in our treasury. We're a very strong company. And I think that's exactly what you want to look for in this environment, a company that controls its level of dilution, because we're not looking to raise money, we're looking to deploy money. We don't have to spend the money, burn on our drill programs, because again, Agnico's paying for that. Meanwhile, we're being very opportunistic as the market continues to get tougher, and it's tough by evidence of Orefinders and Mistango's share price. These juniors have faced a very, very difficult time. We're no different from our peers, but some of our peers, and in fact, the vast majority of our peers, do not have the strength of the balance sheet. Hence, that presents opportunities. And as I've said here, through Mistango, QC Copper, and American Eagle, our team is pretty good at generating opportunities. Meanwhile, we're also doing significant exploration. Agnico Eagle, Eric Sprott, Kirkland Lake Gold, Osisko Development, they all agree, they're shareholders. This is what we look like from a snapshot. Again, we're basically trading at cash. So if you have a little bit of patience, because patience is required in this business, it's a very high risk, long-term thinking, at least from my seat, business. If you want to make an investment in a team, because that's what an investment in Orefinders is really about, investing in our technical team, investing in our corporate abilities to create opportunities. Who knows what the downside is? I'll never comment on that. There's always downside, but the upside at 4 cents, you're extremely levered to a price in gold. So if we get some tailwinds with gold, and eventually we will, I'm fairly convinced on that, but timing remains to be seen. But also, if you're looking for exposure to a deal that we may or may not do, but I can assure you we're actively looking. These are an example of previous deals we've done with Orefinders. I think this is a remarkable track record that I'm proud of, that we've been able to accomplish in a relatively small company. Again, just diversifies our position, is demonstrative of the type of opportunities we try and do for shareholders. But at the end of the day, really, we're an exploration company, and where are we? And we're in the Kirkland Lake district for now, and that's where our focus is. Why are we there? Well, it's a world-class district, 40 million ounces of gold, remarkable. Very difficult to put together land packages there. And it took us years, and getting on 10 years, to cobble these 3 land packages together. We bought them all sort of in strategic and unique situations. That's sort of been our bread and butter. But these all projects are in and around existing resources that are on our property, or existing mines like Macassa or the Kerr Addison, 2 world-class mines. It's really one of the best places to be. Not just because of the existing resources, but the potential for future discoveries. There's just no question in our minds that there's another ore body that just has yet to be discovered. Over and above the existing resources Orefinders has, we think there is certainly the potential for new, potentially substantive discoveries to be made potentially by a joint venture, Agnico Eagle, or maybe something else that we acquire in the coming months. Who knows when, but I assure you we're looking for interesting opportunities. This is a snapshot of 2 of our Orefinders assets in the Kirkland Lake district, and this needs to be updated to have some imagination that gray and the pink actually are now one company, and that's Agnico Eagle, but it also shows Mistango's position on this map as well as Orefinders, as I said before, has a 25 million share position. So it's worth noting, but you can see we're sort of all around these existing areas, and you can see in the gray there, that's from the Casa. That's Canada's, if not North America's, arguably the world's highest grade gold mine. And then over on the far east, you can see a little bit of purple on that land package. That's the Curratison. That was an 11 million ounce producer, very high grade. In our MacKay project, that's where we've been active as of late, drilling there, looking for something new, maybe something similar to Curratison. There's certainly that style of mineralization comes onto our property. I don't know if the Curratison is being redefined into a very large open pit. It's private, so most investors don't hear a lot about it, but there's a lot of big names who have invested in that project, and their pit comes a couple hundred meters from our property boundary, because we believe the mineralization also comes throughout our property. And in fact, we know it does. So that's quite an important project. And as I said, we are looking for something new on the MacKay, even though it does have high grade resources, as you can see there. We haven't been poking drill holes into that particular area. We're looking for secondary, tertiary orders, systems, or I should say structures, which is very, very often where you find these mineralizations. And when you're on these big, call it the Cadillac break, it's sometimes they're on the break, sometimes they're off splays. And that's where we've been looking, because those areas are certainly underexplored. Just zooming in here on our MacKay project, to confirm, we are waiting on our assays. We did, I think, about 4,500, 5,000 meters earlier this year. We are waiting on the assays. The labs have been excruciatingly painful across the industry. Our MacKay project is no exception. We anticipate having them in June sometime. The rock looks good, but you can never tell in the gold exploration business until the assays come back. So fingers crossed. But yeah, we got a lot of good looking holes, but again, we're looking for something new. You know, we were not going for layups. We were not just poking holes through existing known mineralized zones. We're looking for new stuff. We did some geophysics last year that developed some nice targets. And absolutely, when you have nice geophysical targets along in around a system like we are in on the Cadillac next to the Curratison, you have to test those. So time will tell. So again, just sort of closing words on Orefinders. Really, Orefinders is a bet on our team. Agnico Eagle has their stamp of approval, which obviously was preceded by Kirkland Lake Gold and Eric Sprott, and Osisko the same. Bets on our team. I think that's fundamental view to have on our land position, but also the corporate deals that we've managed to do out of Orefinders. And I'm quite certain that you're going to see more transactions coming forward, and I expect them to be accretive, because again, we're trading at cash. We have a healthy balance sheet. Very few companies need cash, so kind of like secondary, tertiary order structures, we're looking at secondary, tertiary assets that could be acquirable, that are very interesting. These, I can't tell you how many times in this industry that an unloved asset sitting in somebody else's portfolio has a mine on it, just hasn't been discovered because nobody's focused on it. They're focused elsewhere. That's sort of the part of the philosophy that Orefinders has. And part of the philosophy that our group has. Again, just patting ourselves on the back here. It's a very difficult business, but they always say it's a 1 in 1,000 shot for an anomaly to turn into a mine, and that's true by and large. However, if you have the right people, where it's the most important thing in this industry, and obviously I'm biased in this view, but I think our team, our people are great people, and that allows us to substantively reduce that 1,000 to 1 ratio, and because you can fail fast, or you can vet out the stuff that is not going to work, or you look in more high probability areas. And then, of course, you have to have the ability to finance oneself. And our group has consistently shown the ability to finance itself, because we are well financed throughout this entire portfolio. So that's it. Primer and Orefinders. If anybody would like more information on any of our assets, any of our equity positions, our cash position, or what we may be up to behind the scenes, please give me a call. My name is Stephen Stewart. My contacts are there. Thank you. Hi, everyone. This is Stephen Stewart on behalf of Mistango River Resources. We are MIS on the Canadian Securities Exchange, giving you an update here for Ore Day. Very pleased to give everybody my thoughts on what we've been up to. We've had 2 exploration programs so far this year. We'll have another one going back on our Kirkland West project starting again in the not too distant future. And of course, we've got a lot of cash and we're looking for new opportunities. And not only do we have a lot of cash, we also have a $60 million exploration agreement in place with Agnico Eagle Gold, who was spending all of their treasury on our projects. Nice position to be in. Tough market though, no question about it. Mistango has, as I said before, a lot of cash, $7 million in cash, basic market capitalization of $12 million. We've recently had a lot of warrants and options fall off, so the cap structure just got a lot tighter. Shareholders include Orefinders Resources, which is an affiliate company of the Ore Group, of course. The story is Orefinders took over Mistango's operation about 2 years ago from a management team who was not doing right by shareholders. It was a 1 cent stock. It's had quite a ride, as you can see, from 1 cent up to nearly 40 cents and all the way back, not down, but certainly not to where we want to be. I think that's obviously not great for past shareholders, but certainly it's all about shareholders now. I think there's a tremendous amount of value. This is a volatile business. There's no way around that. There's a lot of excitement on our Kirkland West project earlier in 2021. We have not yet found the mother lode. Obviously, Mistango is looking for the extension of the Macassa, which is Canada's highest grade gold mine. We've had 2 drill programs on there. The first one was not overly successful. The second one hit some high grade gold. It was deep, but we were onto the systems and the structure, and that's exactly where we're going to go back later in 2022 to follow up on a couple whiffs of gold. In fact, 2 whiffs of VG. That's always nice to see. But there's work to be done, no question about it. So that's where the exploration focus is. Additionally, it's got the Omega project, which is a lower risk project for sure. It's got about 600,000 ounces of 43-101 resource. So that's a known resource expansion opportunity, whereas Kirkland West was really almost a grassroots exploration project in a very mature district, which just happens to be beside the highest grade gold mine in Canada. So that's sort of the context around the exploration work. And of course, with the Agnico Eagle deal in place, our treasury stays relatively static. We have to pay G&A admin costs, but the exploration bills, which are the heavy bills, the big bills, are paid by Agnico on that $60 million deal. So what are we doing with $7 million? We're looking at new opportunities. And hopefully, as the industry may or may not, but I have a feeling it will get more distressed. And that means opportunities. We love, as a part of the Ore Group, looking at distressed, unique opportunities. It's the best way to make money in this industry. Mistango is very well positioned. A lot of the stuff on this slide I've just sort of overviewed. But again, Eric Sprott, significant shareholder, as is Agnico Eagle, as is Orefinders, as is myself. I'm well aligned, paid cash for every share I have. So I think this company, just like Orefinders, they're almost identical in their profile, except Mistango doesn't have the diversity of the other equity positions, but it's got phenomenal land packages right in the Kirkland Lake District. And of course, it's all backed by the team. And as I've said time and time again, this industry, the most important thing is team. You need a team that's well aligned. You need a team that can fail fast, evaluate technical challenges, finance themselves, and look for unique opportunities. Because it's not just always about the 1 in 1,000 opportunity from an anomaly standpoint. It's also about corporate transactions. And I think our team has done a good job. And we've got ammunition, we've got money. And as most of our peers have less and less money, that presents more and more opportunities. We've spun off a handful of companies. We've been aggressive, on the shareholder activism front, which gave us a position in Mistango and ultimately control. But it's a testament to the Ore Group and the portfolio companies that it's developed from next to nothing. That's where it all started, from zero to where we are today, and that's a testament of value, hard work, and moving forward. So the Kirkland Lake District, if you're interested in Mistango, will be familiar with it. The biggest asset around is the Macassa. It is world class by no other definition, and Mistango developed a position just west of it, and as I said earlier, had 2 drill programs. And it's going to have a 3rd drill program on it. This is high risk drilling, but the rewards could be phenomenal if we are successful. And so really that's what Orefinders is focused on for the balance of 2022, aside from waiting for its drill assays. about 4,000 meters from its omega. This is what the Kirkland West project looks like. In the gray is the Macassa. It says Kirkland Lake Gold there, but it's actually Agnico now as the relatively new acquisition that was made. So Agnico is the real big dog in the area, and of course, 9.9% shareholder, along with that $60 million exploration program. So, you can see the breaks there. There's the Maine, the Amalgamated, the Cadillac, et cetera, all sort of converge in and around our property and the Macassa. And there's definitely gold that runs onto our property. We just have to find more of it in economic quantities. And with every drill program and every drill hole, we learn a little bit more. We're onto a structure that's mineralized. We proved that with our last drill program, and we're actually we hit it deep. We got a whiff actually also at 300 meters, and we're tracing it to surface. So that's expect us to target that area later this year. So that's coming up. This is just an example of the gold. Visible gold, that's mineralized. I've always said one drill hole does not make a mine, and that is a fact, but it's you need to know if these structures are mineralized, and clearly our property, Kirkland West property is. And there's another example of visible gold. So also I mentioned our Omega project. We did a 4,000 meter program earlier this year. We are awaiting assays. Hopefully in June. We've been told we were told it was May, and now we're told it's June. Fingers crossed. The labs have been very frustrating in this industry, but maybe we get lucky on some nice results there. We'll see. I don't want to say lucky. Lucky's not the right way, but in gold exploration, you never know until you have the assays back. Again, we had interesting looking rock. And we're looking for mineralization, which is akin to what has already been described on the Omega, which has an existing resource of 600,000 ounces. So that has inherent value in itself to have that level of resource, a fairly good size resource with good grades, relatively near surface. All next to, I'll note, Agnico's Upper Beaver, which is a big deposit that they've been working on for years and years. And I think the industry is waiting to see whether they build their own mill or whether they'll look to do something at Macassa, which is just sort of down the street. So I think the fortunes of the Upper Beaver have been greatly improved under the single roof of Agnico Eagle now that they also operate the Macassa. This is, I think, Agnico Eagle's flagship area. There's no question about that in my mind. And certainly in Ontario and in Quebec, this is probably the most important part of their portfolio. And Mistango and Orefinders has very key land positions there and very key resources, which become very valuable as the Upper Beaver becomes closer to fruition. Just noted the Omega. I've already sort of highlighted that. So look, that's the bottom line of Mistango. We just summed it up. We've got two great projects. One is a high risk, high reward drill program next to the world's highest grade gold mine. The other is a feed type situation where we think we can take a 600,000 ounce resources and expand it into 1 million, make it attractive there. And then we've got our treasury, $7 million in cash with no home because Agnico is paying our bills. So in a distressed environment, expect Mistango to look for opportunities. If you'd like to discuss my views on those opportunities, you can reach me at these contacts. My name is Stephen Stewart, and thank you for your time.
It's our pleasure to introduce James Rickards, New York Times bestselling author and editor of Strategic Intelligence, joined by Anthony Moreau, CEO of American Eagle Gold.
With me here today is none other than Jim Rickards, famous New York Times bestselling author. Jim's going to give us a speech, just tell us about the state of the economy, gold, touch on everything that we deem to be important in today's economy. And then following it, we're going to give a quick little Q&A. So Jim, thank you very much for joining Ore Day 2002. I really appreciate you participating.
Thank you for that introduction, Tony. It's great to be with you. It's great to be with our audience for Ore Day. It's a great event, and I'm very happy to be invited to participate. Yeah, you said I'll be giving a speech. Yeah, I guess one word for it, but I prefer to think of it as a a kind of a dialogue seminar style. We got a number of topics to cover, which I'll outline in a moment, but keep it conversational, and maybe we'll have a few questions at the end. So whatever we can do to communicate to the audience what's going on. Certainly people read the headlines, they know at a high level what's going on, but we want to do a deeper dive and see both how things are interconnected, and most importantly, probably from an investor's perspective, is where are things going. I always say, if you knew for sure that we were going to have a strong inflationary episode that would persist. Be very easy to construct a portfolio. You'd have a slice of gold. You'd have, probably some equities. You certainly have some commodities, some other hard assets, real estate, land, et cetera. If you knew for sure, on the other hand, that we were going to have deflation, it would also be straightforward to construct a portfolio. You'd have some, kind of short to intermediate term treasury notes, which do very well in deflation. You have some cash actually, which can be your best performing asset in a deflationary environment, because the cash is actually worth more every day. You'd want to avoid debt. So in either scenario, there's some very straightforward things to do. The difficulty, of course, is that we don't know which it's going to be. Right now, sure, we're in an inflationary episode. We'll talk more about that, but this could tip to recession, disinflation, which is just declining inflation or even deflation very quickly. So one needs to be nimble, be prepared for both, and again, we'll talk about that. So that's some of what we're going to cover. The first point I'd like to make is that think of over here we have geopolitics, war, global issues, global policy, et cetera, and then over here we have the world of economics and finance. We have investments and asset allocation, portfolio selection, individual stock picking, commodities, et cetera. And those worlds have always been connected to some extent. There's never been a hard and fast separation. Obviously, geopolitical events affect the economic world and vice versa. So there's always been some connection, but I've never seen a time, maybe since the Middle Ages, if you really want to go back to in history, but I've never seen a time where they're more closely integrated. They're really the same thing. You always would talk about one with reference to the other, but now it's you can't talk about either without really getting immersed in the other. And the truth is they're deeply densely connected. The difficulty is that people tend to be experts in one or the other. There's no shortage of experts on Wall Street in the asset management industry. Investment opportunities. We can, like certain approaches, criticize others. That's all fair game, but there's certainly plenty of big brains out there. And if you go over to the geopolitical world, the same thing is true. I wish more of the big brains were actually in office, but that's a separate issue, but no lack of expertise. The difficulty is finding people who are good at both, really good at both, not just sort of pay lip service, but expert in both and can integrate them. And that's where I think you're going to get the insights that are most valuable. There are a number of people who can do it, not that many, but we're gonna do that today. And again, hopefully the audience will benefit from that. So let's kind of start the rundown. And the first issue I want to tackle is the war in Ukraine. And the war in Ukraine is a perfect example, a perfect case study of what I just said. Meaning, yeah, there's a kinetic war going on. It's brutal. It's slow. Sadly, a certain number of civilian casualties, in addition to the military losses. All wars are tragic in some ways. It's just in the nature of war. And we'll talk a little bit more about that. But that's going on. Again, in the headlines every day. But at the same time, there is an economic and financial war going on as a result of U.S. sanctions on Russia. Not just U.S., but the EU have joined in, Australia, Canada, and other countries have lined up supporting these sanctions. Although interestingly, and this is important, there are a number of what I'll call neutral countries. They don't necessarily support the Russian invasion of Ukraine, but they don't feel inclined to join in really punitive sanctions with Russia. They kind of recognize some of the realities of world trade. And it's a powerful group. That would include India, China, Brazil, Turkey, and other emerging economies, and fairly large ones at that. So it's not just black and white, it's black, white, and gray with, the Russian invasion on the one hand, the U.S. sanctions on the other, but this important group of countries who are neutral. And that's important in terms of having trading partners. The idea that the U.S. will sanction Russian exports of oil. Say, well, we're not going to buy any more Russian oil. The U.S. has already done that. Europe is tiptoeing up to that. They've made declarations. They're not quite there yet. Well, that's fine. But if China is willing to buy the oil, if India is willing to buy the coal, if Brazil is willing to buy strategic metals, then Russian exports and the Russian economy will do just fine. You know, not untouched, but will basically survive in pretty good shape, and the sanctions won't mean very much. So that's why that swing group or that neutral group is so important. So just to kind of talk about the war, and this is the first thing I'll say that's going to come as a shock to U.S. investors. All wars involve lies and propaganda. That's just the case. So the West is lying about what's going on. Russia's lying about what's going on. One of the challenges I've had over the past 3 months since the war began is just getting good sourcing. It's something I learned, professionally in the intelligence community. But your sources, if your source is lying to you, unless you know that and can kind of reverse engineer it, it's not much good, and you can easily be misled. So finding good sourcing is difficult. They're out there, not easy to find. There is some message traffic on Telegram. There's just an alternative to the better known social media channels like WeChat and Twitter and others. But in addition to that, there are some websites. There are some really interesting commentary coming out of some Swiss observers. Swiss has a 500-year history of neutrality. They kind of threw it away and leaned on the European U.S. side of this war. But a lot of people in Switzerland are not happy about that. And I found some Swiss military officers who ended up as UN peacekeepers, and peacekeeper sounds like an easy job. It's not. You're put in the most difficult places on earth. You're a blue line kind of separating two antagonistic sides, but they tend to get some very pardon me, what I call front row seats on some important conflicts. So there's good sourcing out there. So here's what's going on. Russia is winning this war. Again, slow, brutal, a lot of losses, a lot of damage, Ukrainian economy and Ukrainian infrastructure being wrecked in the process. But Russia has now at this point built a land bridge from main Russian territory to Crimea, which at this point since 2014 is also Russian territory, separated by Ukraine. That separation, that stretch of Ukraine along what's called the Sea of Azov is now under Russian control. Focused around the port of Mariupol, which was the home of the Ukrainian neo-Nazi forces, what's called the Azov Brigade or Azov Battalion, had different names, but they have roots going back to World War II when Ukraine fought on the side of the Nazis. They had, Nazi insignias. They were not really very much under control of Zelensky, and that was one of Putin's targets. And they've been, at this point, annihilated or surrendered. So that's been cleaned up, and they're making very good progress. Russia, that is, and what's called the Donbass, which is the main industrial and commodity producing, coal producing region of Ukraine, with two main cities, Luhansk and Donetsk. But beyond that, Russia's getting key intersections, transportation hubs, and there's really a line of control. It runs roughly from Kharkiv in the northeast down to probably Odessa. The Russians aren't in Odessa yet. They've been assaulting it, but bombing it, I should say, but not a full-scale invasion. But if you just move it slightly to the east to a place called Kherson, Kherson is a city on the Dnieper River, which controls traffic on the river itself. The river bisects Ukraine, goes to Kiev. Kiev's way inland, but because of the river, it has access to the Black Sea. But the Russians now control the river because they control a key city at the mouth of the river. It's a little bit like if you know your Civil War history when General Grant took Vicksburg. Well, that was an important conquest. Vicksburg was an important city, but the importance of it was that Vicksburg controlled traffic on the Mississippi north of there all the way up to St. Louis in the upper Midwest. So that's why you really choked off the Confederacy from access to most of the Mississippi River. Russia's tightening the vice. They're at a point now where fairly large bodies of Ukrainian armed forces are being surrounded by Russian forces in what's called a cauldron. You're there, but you're completely surrounded, no escape. We hear a lot about Western arms going to Ukraine. Biden approved some very sophisticated missile systems. Boris Johnson not far behind. Germany's sending tanks, anti-tank missiles. Netherlands have joined in. A lot of NATO countries are pledging some very significant arms shipments. But here's the problem. You got to get it to Ukraine. I mean, you can fly it into Poland or Romania, which are bordering on Ukraine, but you have to actually physically get it into Ukraine. There are all kinds of logistical difficulties, including the fact that the Ukrainian railroad, which was built during Soviet times, those trains run on a different gauge track. The gauge is, the width of the track. Well, if you have two railroads, one's like this and the other one's like this, you can't run trains across that. You've got to stop and unload them, probably with trucks, and fill up a new train. And of course, the whole time the thing's a sitting duck. So the Russians have been pretty effective at identifying these depots and transit points and attacking those. So first of all, pledges are one thing. Getting the weapons there is more difficult. That's more slow. Even when you get them to Ukraine, can you get them to the front, to the eastern part of Ukraine where they're most needed? And even at that, the crews aren't trained. They don't know how to work this stuff. I was reading the other day about a Ukrainian battery group that had some very sophisticated artillery with laser rangefinders for targeting, but they didn't know how to work them. And they had English instructions. I guess it may be becoming an envelope or something, but they were online using Google translators to translate the English instructions to Ukrainian. I'm not sure I could work a laser rangefinder it was written in English, which is my native language, but good luck with that. So it's not really very effective. But the reason I'm spending time on this is everything I just said, which is well sourced, is the exact opposite of what the Western media have been telling you and what the White House has been telling you. They've been telling you, Ukraine freedom fighters and Ukraine's pushing back and Putin miscalculated, and what happened to a 3-day blitzkrieg in Kiev. The question there was, who said there was ever going to be a 3-day blitzkrieg? There's a military tactic called a feint, a probe, et cetera. There are a lot of explanations for what Russia's been doing. No doubt Russia's had some disappointments and failures. There's no question about it, but on the whole, they're winning. Remember, in the early days of the war, you'd see Ukrainian freedom fighters. They would, mostly women in these photographs online, on Twitter, whatever, and they're being camouflaged with their M4s or whatever kind of machine guns they were using. And they were gorgeous. They looked like Vogue models, looked like a runway show. And it turns out they were models. They were, I no doubt that Ukrainian women are beautiful, but that's not the point. The point is these were propaganda photos put out, and it created a misimpression as if there was some, heroic organized resistance. The reality on the ground is much more brutal, much more, I'm trying to think of the right word, just, discouraging. If you're the Ukrainian troops, they are surrendering. So, Zelensky's running around the world. He's, this notion that the propaganda was he's the new Churchill. He's the new Churchill standing up against, brutal attack. That's nonsense. He's a corrupt oligarch. Ukraine is ranked the most corrupt country in Europe and one of the most corrupt countries in the world. It's really been a money laundering operation for mostly Democratic politicians for the last 10 years. And so all that's now crumbling in front of our eyes. But how is the Western media, starting with the New York Times, the Washington Post, NBC, how are they going to explain to the American people when Russia actually does, consolidate its gains, which they're in the process of doing, or there's, some kind of peace treaty, or at least an armistice or some kind of cessation of the hostilities. Russia's not giving the land back. There's never been a war that was easier to prevent. All that needed to happen was Ukraine had to say, we won't join NATO, we'll remain neutral, we'll give some autonomy to Donetsk and Luhansk. That would have been enough to fend off the invasion. You could still end the war in 48 hours with the same pledge, with one big difference, which is you're not getting the land back. I mean, Russia fought too hard, spent too much to get it. They're not going to give it back. They'll consolidate it with Crimea. So this is a disaster for Ukraine, disaster for the American people, and a defeat for the West in the making. But how are you going to explain that to people? It's just another failure for Biden. So let's pivot a little bit to the to the economic war that surrounds this. And again, this is not local. This has global ramifications. So the one of the responses of the Biden administration were economic sanctions on Russia, and these sanctions on paper were extremely tough. I'm a sanctions expert. I did this for the national intelligence community for over 10 years. I've studied it as an economist and as an analyst, so it's something I'm happen to be very familiar with. And I can tell you, and I've read, I'm enough of a geek, I've read all these sanctions, hundreds of pages of documents from the White House and published in the Federal Register, et cetera. And they are the toughest ever. And I, again, followed this closely going back to Iran, North Korea, Syria, and other sets of sanctions imposed over the last 20 years. They froze the assets of the Central Bank of Russia. This is the 11th largest economy in the world. It's not some, pint-sized African dictatorship. It's a big deal. One of the 3 largest oil producers in the world, and a lot else besides, and the largest nuclear power in the world. He froze their central bank assets, which were to a large extent sovereign bonds. Now, Russia, to its credit, had about 20% gold bullion. And that's one of the things that has kept financial panic from breaking out. Because, like, well, you actually have some gold. You can't freeze the gold. You can cut off payment channels so that Russia couldn't sell the gold. But that's beside the point. They still have the gold. That gives them a kind of creditworthiness and a staying power that you wouldn't have without it. So that was a smart move by Elvira Nabiullina, who's the head of the Central Bank of Russia. She's been working on that she and her predecessors have been working on that for about 12 years. Russia's almost quadrupled its gold reserves from 600 tons to about 2,400 tons, not quite, since 2009. But beyond that, they did have a lot of sovereign bonds. They've been getting out of treasuries for a while. They could see this coming, but they have a lot of, German and other sovereign bonds. They've all been frozen. Now, in legal terms, is there a legal basis for this? Yes. I mean, the United States has a statute, the International Economic Powers Act of 1977. That's the legal authority to do what President Biden has done. But it's tantamount to a default. If the U.S. government's selling treasury notes and I buy some, and you tell me they're frozen, I can't collect interest and I can't sell them, what's the difference between that and just defaulting on the bond? Well, economically, at least in the short run, there's no difference. What about the rule of law? Well, I said there's a statute. Yeah, there are a lot of statutes that fall into the category of continuation of government, COG, that many of which were drafted during the 1950s to prepare for nuclear war. Well, this is not a nuclear war. It's a serious war, but it's pretty far from U.S. shores. But all these things are being used to do exactly what I described. Well, did the Deputy Secretary of the Treasury, Wally Adeyemo, who implements these things, he reports to Janet Yellen. Yellen's clueless. She has no idea what we're talking about right now. But Wally does. He's a sanctions expert, but not a lot of real world experience. I mean, he kind of carried Larry Fink's briefcase for a year, but that's about it. The rest of his career has been in, the head of the Obama Foundation and in the White House, the National Security Council. Now he's at Treasury. So he's throwing these sanctions around. So he's got the law right. He had his list, his little shopping list of sanctions, but nobody thought them through. Nobody said, well, okay, if we do this, what's the response function? What does Russia do in return? And that's where we are now. The Russians think not 2 moves ahead, maybe 3 moves ahead, which is pretty difficult in chess, if you know chess. So let's give some concrete examples. So Biden's seizing all the assets of the oligarchs, the Russian oligarchs. So they're seizing their yachts. You see pictures of these yachts being towed out of I don't know, the Las Palmas Islands in the Mediterranean, or Monaco or other ports, and they're seizing their townhouses in Belgravia. That's the very rich upscale section of London, et cetera, and forcing them to divest ownership of football teams, what we would call soccer, et cetera, and more. But Putin hates the oligarchs. This is the point. Putin's base of support is the military, the intelligence units in the Soviet Union, the Orthodox Church, and everyday Russians. That's his base. He hates the oligarchs. He tolerates them. He has never felt comfortable, seizing everything. But he put a few of the oligarchs in jail about 12 years ago and said, look, you can keep your money, but keep out of politics. If you get involved, this is going to happen to you. And the oligarchs got the message and by and large did stay out of politics. but he considers them a rival power center. Well, now Biden is doing Putin's dirty work for him. Putin should send Biden a thank you note. Hey, thanks for cutting the oligarchs' wings. I never really trusted them. That's the kind of thing, it has a feel good aspect to it. It makes headlines. It looks like US is really tough, but we're actually helping Putin. Price of oil has obviously gone up, and the audience doesn't need to be told that, of course, but Putin is making over $5 billion a week, over $21 billion a month in hard currency, meaning dollars or euros, for the sale of oil, because the war itself and our sanctions drove the price up. So Putin is being enriched by US sanctions. Not only are we whacking his enemies, the oligarchs, but we're making him and Russia richer by driving up the price of energy. And those payments are going through. One of the ironies of this is you hear all about these sanctions. I'll come back to some other ones in a minute that are going to impact the world more, but oligarchs and exports and semiconductors and high-tech machinery and frozen bank accounts and all that. But the fact is, the oil and the natural gas are still flowing. The thing you've heard about the most is the thing that has been affected the least. The oil, Putin dialed down the valves a little bit for Finland and Poland, I believe, with natural gas, but not a lot, but just to send a message. Most natural gas is still going through. West Germany is still getting its natural gas. Oil is still going through. Russia is still getting paid. And just to make it even more ironic, Russia is paying Ukraine transit fees because most of the pipelines run through Ukraine. That's what, in some ways, this war is all about. So here you have the West, meaning Italy, France, Germany, financing Russia by buying the oil and natural gas, and Russia's financing Ukraine by paying transit fees. And everything's going on business as usual. There are certain bank accounts that are still open. A lot of them have been closed, but some not. Gazprom Bank is the bank owned by the Russian natural gas and oil companies. So they're still going through. So the West is financing Russia's war and Russia's financing Ukraine's war. I've never seen a war where the two sides are financing each other, but there it is in the world of sanctions. So and a lot of the announcements, again, for the benefit of people following this, have delayed effective dates. These really tough sanctions you heard about in late February, early March. If you read them, and I do because I'm a geek, you'll see that they had 30, 60, 90-day effective dates. More recently, you've heard that there was some climate environmental summit, G7 summit. John Kerry showed up in his private jet, and about a week ago, where they said no more Russian coal imports. But the effective date on that is in August. Europe said no more Russian oil imports, but the effective date on that is December 31st, 2022. In other words, none of these things are in effect yet. So you think things are bad now. You think the supply chain is messed up, and it is. You think inflation is bad. It is. Oil prices, energy prices going up. They are. That's all true. This is about to get a lot worse because the sanctions have barely been in effect. Obviously, the market anticipates that. We know that markets, kind of look forward and they discount to today's values, but most of what we're talking about hasn't even happened yet. So it's about to get a lot worse. And then let me just finish up with two other aspects. One is technology and semiconductors. So the U.S. says no semiconductor exports to Russia. Russia can't get semiconductors. Okay, now that's a big deal. Well, how do you make a semiconductor? Well, it's you basically have what's called a wafer. It's a couple layers of different composites, silicon, other strategic metals, and then you etch the circuits on it. Well, the etching device is a laser, okay, because you're operating at 3 nanometers in most advanced chips. Well, how do you power laser? Well, there's a certain kind of processed neon gas that's needed to run the laser to etch the semiconductors. 70% of that processed neon gas comes from a single facility in Odessa, which is in Ukraine. And Russia's in a position to shut that down. So Russia's saying, in fact, you can cut off our semiconductors, fine. We'll shut down the global semiconductor industry by cutting off the exports of processed neon gas. So this is what I mean by two moves ahead. When we put the semiconductor ban on, did anybody think, oh, gee, Russia could come back even harder? Not to mention, aluminum, palladium, platinum, other strategic metals that are crucial, absolutely crucial to Boeing, Airbus, and other major Western manufacturers. automobile catalytic converters, and even mundane things like plastic tubes that are set the wiring in an automobile. An automobile, first of all, is 1,400 semiconductors. It's basically a computer on wheels. But throughout the automobile, with all these sensors and processors and systems, et cetera, they got several hundred miles of wire. Well, you got to run that through conduits, and those conduits have to be custom made for each vehicle. Guess where they're made? Ukraine. So VW and Volkswagen and BMW have had to shut down, at least temporarily, some assembly lines in Eastern Germany because they can't get that part from Ukraine. And the biggest impact of all, and it's still coming, it's starting to be felt, but not quite here yet, is food. Russia and Ukraine together export or provide 25% approximately of all the major grain exports in the world. Talking about wheat and barley and a few others. Places like US, Australia, and Canada produce more, but we consume a lot of it ourselves, most of it for animal feed. We don't, we eat corn at a barbecue or whatever, but we eat bread, but most of the corn produced in the United States goes for animal feed. So if you reduce the corn supplies, you're raising the price of pork and poultry and beef. And then beyond that, dairy products, because they come from cows, milk and cheese and eggs from chickens, et cetera. So that's one of the reasons all those staples and the supermarket counter are going up, is because there's a grain shortage, but it's worse than that. I mentioned that Russia and Ukraine are 25% of exports. Well, who imports? Let's just do the reciprocal of that. Who imports the Russian and Ukrainian grain? Turns out there's a list of countries where their imports, that's 70 to 100% of their imports come from Russia or Ukraine. So you cut off exports from those two places, and you basically starve the people in those other countries. Who are they? Lebanon, about 100%. Egypt, over 70%. Sudan, Somalia, Kenya, Jordan, a number of countries in the Middle East and Africa. If you cut off Ukrainian and Russian exports of wheat and barley, those people are going to starve. And I looked at the list, the combined populations of those countries where their exports are north of 70% are 700 million people. That's 10% of all the people on Earth. And people say, oh, well, just go buy your grain from somewhere else. Well, there is nowhere else. There's no huge surplus. There's enough. But when you cut off that supply, those countries are in danger of starvation. So by the fall, we could be looking at a humanitarian crisis of unprecedented proportions. And there's several solutions on the table. Russia's meeting in Turkey now to discuss getting some of the grain out of there. But Ukraine's standing in the way, and Ukraine's operating on orders from Washington, and Washington seems determined to fight to the last Ukrainian. Like, they're the ones, the Ukrainians are suffering and dying and watching their economy destroyed. Also, so the US can drain Russian resources a little bit. Well, that's a pretty high price to pay if you're the Ukrainian. So we'll see how it plays out, but the war is going to drag on. One last footnote, the Biden administration has announced that the sanctions will not be until Russian troops leave Ukraine. And there are different interpretations of that. Does that include Crimea? Well, maybe not, but let's just say it doesn't. If you leave Crimea where it is, but the Russian troops have to leave Donetsk, Luhansk, and the Donbass region, Mariupol, and so forth, before the sanctions are removed. Well, I have news for the White House. The Russians aren't leaving. So that means the sanctions may be on indefinitely. Now, you can change your mind or announce a new policy or negotiate something, but this war is not over soon, and those sanctions are not going away soon. And these delayed effective dates I talked about, August and December, that's wishful thinking on the part of the Europeans, where they think, well, give us a few more months, we'll sort this out. Well, maybe not. So all of this is going to get a lot worse. Let's just pivot to China for a moment, world's second largest economy. China is, let's just say a mess. I don't think it's a technical term, but it's a pretty good term. They have a huge debt overhang. Their debt to GDP ratio, when you include corporate, provincial debt, there's not a lot of central government debt, not a lot of debt coming out of the government, in Beijing, but China, a lot of the debt is financed at the provincial level. And that is sky high along with corporate debt, but a lot of the corporate debt isn't really a separate corporate sector as we have in the United States, because these are state-owned enterprises, state-controlled banks. So you really have to look at that aggregate. It's far higher than the US. And the evidence, can you kind of keep the game going with more debt? Well, to a point, but there's an inverse relationship between those debt levels beyond a certain threshold and growth. So China they can borrow more and they can keep the game going, but they're strangling their own growth. China may actually be not after decades of compound, 7-10% growth. They lie about their statistics, so you need to develop a number of different sources, but they're available. They've driven the economy with infrastructure investment, and normally in a country like the U.S. or a developed economy, infrastructure investment basically in the GDP accounts might be around 25%. In China, they're more like 45%. And you say, well, gee, what's wrong with investment? That's the future. That's productivity of the future. It is, and it can be if the investment itself is productive. But this investment is not productive. I've been all over China. I've been to the ghost cities. I've been to some of these white elephant projects. Nanjing South train station has, 20-foot high marble walls and 128 escalators. They're all shiny and brand new, and there's nobody on them. Nobody. It gets a certain amount of traffic, but the $35 approximately ticket from Shanghai to Nanjing on their bullet train, their high-speed train, which does go 300 kilometers per hour. It's a great bargain, but you're not going to pay. You're not going to pay for that infrastructure with $35 tickets. $3,500 might be more like it. So the point being, they've really wasted this. I've gone to the ghost cities under construction with multiple cities on the horizon. It's nice architecture. It's real glass, real copper, real steel, real earth-moving equipment, real labor, and they're all empty. They're just empty. And so, you can drive GDP by spending money on the copper, glass, steel, labor, and heavy equipment. But when you're done, what do you do next? Well, I know the answer to that. They go build another city. But none of this is productive. None of it's going to pay for itself. None of it's sustainable. And then in addition, China's on the verge, I would say not the verge, but they're in an historic demographic collapse. China's population, different estimates, but demography tends to be something you can do with a pretty high degree of accuracy at long range, because I can predict how many 40-year-olds they're going to be in 20 years, because they're all 20 years old today. There's a mortality rate, and you make a couple assumptions, but that is straightforward. China may lose 600 million people over the next 50 years. It was like, 50 years seems like a long time. Well, yeah, but it's starting now. And so the impact of that is just going to accumulate. But there are different formulas for GDP, but if the simplest formula is, population times productivity, what's your working population times the productivity per worker equals nominal GDP. That's the simplest way to think about it. Well, that population goes down, your GDP is going to go down a lot. And so leaving aside productivity, and that's another issue, which is not only is the population declining, but the percentage of the population who are going to be in their 80s and 90s is skyrocketing. And that's highly correlated with Alzheimer's, various forms of dementia, Parkinson's disease, and other, basically diseases involving cognitive decline and disability. Well, you're going to have people take care of those people, which means that you're going to have a greatly shrinking productive labor force, prime age workers between, say, 25 and 55 years old. That group is shrinking, pardon me, but a larger percentage of that group are going to have to take care of the older people. They're going to have to be caregivers. Now, it's a worthy pursuit, but not highly productive. Giving people a bath hasn't changed in about 5,000 years. You have to go to, there's a period in the 1870s to 1930 when indoor plumbing and hot water were introduced. And okay, there was a productivity gain in the art of bathing at that time, but nothing since. As I say, giving people a bath is the same thing. So, so not only will your productivity drop because your population is dropping, but the pursuits that people are pursuing are those that do not lend themselves to productivity gains. So between the debt that's there, the declining population, the declining productivity, and other factors, China is really a pretty hopeless case. And that's, sad commentary for the second largest economy in the world. Against another story you won't hear in the mainstream media. Spend a minute on U.S. inflation. I really don't think I need to say much. Everyone puts gas in their car, shops at the supermarket. I know I do. I have a 16-gallon tank of my 13-year-old car. But the fill up has gone from about $45 to $75 in a very short period of time. I'm sure our participants today are experiencing the same thing. Excuse me. That obviously is a tax. Now, here's the thing. You need gas in your car. So you can grumble and complain about the higher price of gas. I know I do, and I think most Americans do. But if you spend that money, if you spend the extra $30 to fill up your tank, that's $30 that you don't have for other things. Going out to dinner, going to a show, buying a new pair of shoes. Your wife wants to buy a new dress, your husband wants to buy a new suit, whatever. You start to cut down on those other things, those discretionary consumer items, because you have no choice, because you had to spend more at the supermarket and the gas station. So inflation can be self-limiting in the sense that when it takes off, you got to spend the money, but you spend less in other places. That's actually driving the U.S. economy toward a recession. Now, I did an interview the other day, excuse me, and I was asked, Jim, when do you think there's a recession coming, and if so, when? And I said we might be in one right now. First quarter GDP was negative. It was negative 1.5% on an annualized basis. Second quarter GDP, the second quarter is not over. We got a few more weeks to go. But the best estimate, the Federal Reserve Bank of Atlanta GDP now estimate is growth of 0.9% annualized, not 9%, 0.9%. Well, if you have negative 1.5 in the first quarter and positive 0.9 in the second quarter, two things are true. Number one, the first half, as taken as a whole, would be negative. And number two, you're a rounding error away from a recession, because if the second quarter goes negative, even by a modest amount, that's two consecutive quarters of declining GDP, which is the technical definition of a recession. Now, I'm not necessarily forecasting that, but I'm saying that we are extremely close to being in that situation today. So I don't have to talk about, gee, will there be a recession in late 2022 or maybe early 2023? I mean, there may be. We can talk about it, but my point is that we're very close to that, uncomfortably close to that right now. So what you have is something that part of the 1970s economists almost thought couldn't happen, which was high inflation and something close to recession, what they call stagflation. It used to be that people say, well, if you have high inflation, at least you have high growth or low unemployment. No, that's not, and that can happen, but that's not the only outcome. The worst outcome is the one we're seeing, which is high inflation and low growth. And that's where we are right now. That's one of the reasons the stock market, everyone's like, the stock market's really volatile. It's been coming down lately. No, actually, NASDAQ started to crash in November 2021. It's been coming down a lot more since. Yeah, and there are good days. There are always rallies in the middle of a bear market, but the trend is very clear. The bad days are outnumbering the good days. We are in a bear market. It's going to get worse. The question is, will we get to something that looks more like a crash, where it goes down 30%, 40% in a matter of 6 weeks? That is certainly a possibility. I would not rule that out at all. Just talk a little bit about global supply chains. Supply chains are, one way to think about it is, the supply chain is not part of the economy. The supply chain is the economy. There's nothing you can think of, no good, no service, commodity, finished product, manufactured product, et cetera, that doesn't come through a supply chain of some sort. And it involves not just the processes, mining, manufacturing, distribution, retail sales, et cetera. Those are all parts of a supply chain, but there are transportation links between every one of those, from the mine to the factory to the warehouse to the shelf. And the transportation links are breaking down. They could be cargo vessels, they could be trucks, they could be airplanes, different modes, but they're all suffering serious disruption. There's very good evidence. I actually have a new book coming out on the supply chain. It'll be out in November. It's called Sold Out. But there is good evidence that, did COVID make the supply chain situation worse? Yes. Did the war in Ukraine make the supply chain situation worse? Yes. But it didn't start with COVID. It actually goes back to 2018 with the beginning of the trade wars under the Trump administration between the U.S. and China. Now, I'm not here to debate the trade wars. It's a big subject and a separate one. But the evidence is clear that was the beginning of the breakdown, and it's been getting worse ever since. There's some pre-COVID studies of shipping lanes that show that the scarcity of cargo vessels, abandonment of containers, clogs, log jams at ports had already begun before COVID. And of course, everything that's happened ever since has made it worse. Again, but there's a flip side to that, which is, if there was scarcity, which there was, and empty shelves, which there was, do retailers, well, I couldn't get what I wanted, so I'm going to order 3 times as much for the next shipment, and maybe it's delayed. But what happens when the shipment comes in and you get triple your normal order because of the prior shortages, and this triple order shows up at exactly the time when people stop spending because the price of gas is too high? That's happening. We saw it the other day with Target, which they said, hey, our inventories are out of control and earnings are going to be down. You'll be seeing announcements like that from Walmart and Amazon and others ahead. So not a rosy scenario, but we've got the physical war in Ukraine that Russia's winning, although people don't expect that. There's a financial sanctions war which the U.S. is losing, although people don't understand that. Hopefully we've explained that. China is facing a world historic collapse. It's in slow motion right now. You won't hear about that from a lot of analysts, but it's happening. U.S. inflation is strong right now, but my expectation is the inflation will cool off early next year, not for good reasons. Inflation is bad, but the reason it's going to cool off is even worse, which is a recession. Although, just as a footnote, we may be in a recession right now. Don't discount that. And supply chains are breaking down. Supply chains are, it's like if you have a vase, an expensive vase, and you just accidentally drop it and it smashes into 1,000 pieces, you can't put it back together. You got to go out and get a new vase. And the point I make is the supply chain took 30 years to build from 1989 to 2019. It's broken. You can't reverse that process. It's like pushing water up a waterfall. You can't do it. You can start with a new supply chain, and that is what's going to result, but that's going to be very disruptive, and it's going to be costly, and it's going to play out over the next 10 years. So what does an investor do with all this? Well, as I said at the beginning, if you knew it was all inflation, you would know what to do. If we knew it was all deflation, you would know what to do. But it could be either one or both. Actually, I think both sequentially is the most likely scenario. Hot inflation right now, and maybe something like disinflation, deflation by early next year, including a recession. The key is to build a robust portfolio. And I'll say this, but I'll explain it because it sounds kind of obvious. You need diversification. And everyone rolls their eyes and say, oh yeah, Jim, great advice, diversification. We all know that. Well, actually not. A lot of what people call diversification isn't really diversification. They don't know what diversification is. I run into people who have, they say, well, I'm diversified. I've got 50 stocks in 10 different sectors. I've got technology, consumer non-durables, commodities, et cetera. I'm fully diversified. And I say, no, you're not. You may have 50 stocks in 10 sectors, but you have one asset class, which are stocks. And they will all go up together to a great extent or down together to a great extent. There's some idiosyncrasies and there's room for selection, but that's basically how they move. Real diversification is have a slice of stocks. Okay, have some. We'll talk about what you might want in that slice. Some private equity, some technology, venture capital, real estate, cash, gold, and gold mining stocks. That's real diversification because, and also, treasury notes, kind of season to taste. You might want 2-year notes, which are a little less risky, or 10-year notes, which have, they're more volatile. They're not risky from a credit point of view. They do have some volatility associated with them, but in a declining interest rate environment, which I expect later this year, they could produce very large capital gains over and above the coupon on the note itself. So their total total yield could be significant. And in the stock sector, I'd favor energy companies. This whole Green New Deal, I call it the Green New Scam. Yeah, it sounds good. Windmills, wind turbines, solar. I own a very large solar field. I build it myself with some contractors, so I know a lot about it, but I know that it doesn't work at night and it doesn't work in the rain. So yeah, solar power is fine. You can run a facility with it, but it's what's called intermittent, and you still need the grid as a backup. And in every state of the world, solar and wind turbines together, they're not that scalable, but they can contribute. I don't dispute that, but they, because they're intermittent, you can't run a modern power grid on intermittent power. You need what's called a baseline of power to just keep the grid active, so that various circuit breakers and capacitors and other techniques don't kick in and shut the whole thing down. So and just basic economics 101. Here comes solar and wind turbines. They're growing, but energy demand is growing faster. So how do you fill that gap? Well, there's only one way to fill it: oil, natural gas, or nuclear. But nuclear seems to be out of favor. So you're going to be back to oil and natural gas, whether you like it or not, whether AOC likes it or not. So those stocks have been beaten down. So there are some good opportunities there. And again, in gold and gold mining, the thing with gold miners, I always say geology is geology, finance is finance, mining technology is mining technology. There are a lot of similarities. So what distinguishes one gold stock from another? The answer is the management of the mine. Are they seasoned? Have they done it before? Have they had success before? Are they careful about expenses? Are they willing to shut something down if it doesn't look promising, or continue exploration if it does? Make those hard decisions, and that's where the analysis and some experience in the gold mining sector is so valuable. So have your silos, your sleeves, or whatever you want to call them. There's room for equities, treasury notes, real estate, cash, alternative investments, and then finally gold and silver, if you like, and mining stocks. They have a big role. So Tony, I'll toss it back to you. Thanks.
Yeah, thank you very much, Jim. That was very interesting. I have so many questions, but we don't have a lot of time. I'm going to go through a bit of a speed round here. So just to sum things up, the U.S. government's run by tree huggers and academics who don't really necessarily know what they're doing. Is that right?
Yeah, I don't like to get into name calling, but that's pretty right. The problem with academics is they're academics. In other words, I'd much rather see people who have, it's fine to have your education, your degrees. I'm all for that. But if that's your world and that's all you've ever done, and suddenly you're tapped to come into the White House as National Economic Advisor, National Security Advisor, or some other, Council of Economic Advisors, and you've never run a business, you've never been out in the real world, you haven't necessarily traveled outside of the Aspen, Milken, Davos bubble, et cetera, you actually don't know how the world works. And I'd much rather see people who have, you go back to the 1950s, 1960s, even later. The way you got to the senior cabinet level positions in Washington is you had a successful career somewhere. It could be a Wall Street lawyer, an investment banker, an entrepreneur, CEO, et cetera. There are a number of paths. And then they say, oh, this guy or woman really knows what he or she is doing. Let's bring them into the cabinet. And that was valuable. And then when you finish your government service, you could go back or retire, as the case may be. Instead, today, we have a class of people who never get outside of that bubble, the academic think tank policy bubble. They all talk to each other. They all go to each other's conferences. They all read each other's books. They never get any cognitive diversity. I talked about diversity and portfolio selection. That's important, but there's something called cognitive diversity where you actually spend time with people who disagree with you or have different views. And that's how, maybe you can persuade them, or maybe you'll learn a thing or two. And or even just the combination of competing views can lead to a better result. So yeah, we're trapped in that bubble. It's getting worse. It's almost inbred at this point. So I do think that's a detriment.
Well, Jim, calling someone a tree hugger and academic, that's not name calling.
Okay, fair enough.
Compliments. Now, look, you want to put AOC in charge of Walmart or Berkshire Hathaway? That'd be a good litmus test to see how the U.S. government or
Well,
how the US
they did put her in charge of the Amazon expansion in Queens, and she drove them out of town. It's something like I don't want to exaggerate, but something like 25,000 high-paying jobs with benefits in her district, and she drove them out of town for who knows what reason. So she's not only not helpful, she's destructive.
So it looks like the Russians are technically winning, even though no one really hears that in the news. We're gonna get there where we're gonna be working with the Russians again. It's inevitable. We've seen it before. Look what happened with Germany after the war in 1948. Marshall Plan, I think they gave them $15 billion, 12% went to West Germany. If you calculate that in today's terms, it's $180 billion that went to the Marshall Plan. That 12% would represent, around 15 billion. Now, how much money does the US government have to give the Ukraine to help us move on? Because we know the Russians aren't going to give up that land.
Russians are not going to give up the land. The war is not necessarily going to be over quickly. So the question is, why should the US do anything? Now, we probably will. I think you're right about that. But it's a hard question for US taxpayers and US citizens. This isn't we've turned it into our war, but it shouldn't have been. I doubt Russia's going to pay for it. What Russia will do is they'll reap the economic gains. I mean, I read a report the other day that Russia is hijacking Ukrainian wheat. Well, it's not Ukrainian wheat anymore. This is how wars go. When you take over territory, you get the stuff. They used to call it booty or plunder or whatever you want, but that is how wars work. And so if that grain is under Russian control and Russia has vessels and the world needs it, and they do, the U.S. State Department sent out a message to African countries, beware of Russians trying to sell wheat that actually belongs to Ukraine. The Africans don't care. Their people are starving, or they're close to starvation. They're not, it's not like you get a loaf of bread and tells you where it's made. I mean, or a bulk cargo carrier that's not imprinted on every little grain of wheat. So the point is, they're going to buy the wheat. They don't care who's selling it. They need to feed their people. And that bit of sanctioning is not going to do any good. So if Russia controls the ports and they're close to getting there, and if they control the exports for that reason, if you look at big maps of Ukraine, people don't, I don't know when they stopped teaching geography. Ukraine's not some like tiny little country in Europe. If Ukraine from end to end, from east to west, is approximately the distance from Boston to Chicago. And north-south from the Great Lakes to North Carolina. No, it's just like 1/4 of the continental United States. No army in the world is going to overrun that in a matter of days. It could, World War II took, 6 years, depending on how you measure it. So, the progress is going slowly, but Russia is not leaving, and they're going to reconstitute a lot of those facilities, and they're going to have the benefit of the manufacturing and steel production and the wheat, et cetera, from Ukraine, and get the money. And you won't have to help the Russians at all. They'll self-finance using Ukrainian exports. The question is, what does the U.S. want to do? Does the U.S. give up on sanctions? We're going to suffer more from sanctions than Russia. That's already happening. You see it at the gas pump every day, and it's going to get worse. So at what point does Biden, if at all, decide to stop punishing the American people for what the Russians did in Ukraine? Because that's what we're doing. So I guess I don't see an easy solution here. Now, are the resources available? Yeah. The IMF, the World Bank, there are other multilateral programs that could be used to rebuild Ukraine. But there's going to have to be a treaty. There's going to have to be a negotiation. No, the West is not going to want to spend money rebuilding areas that Russia won't give back. Okay. So, but Russia's not going to give those areas back, but they'll finance it themselves using formerly Ukrainian resources. So what's left for the rump of Ukraine? What's left of Ukraine? Not much. So nice job, Zelensky. But there are resources available, but it'll take years. And the real problem in Ukraine, the war is the problem today, but prior to that, it was just the corruption. It was just a money laundering operation for the Democrats. So it's a tough question, but it looks like what's the non-Russian part of Ukraine will just be a very poor country, slowly rebuilt. And there are some resources available.
Well, if I look at this war, and you look at Europe, who I guess supports the war on Russia, who leads Europe? It's Germany. Now, the one thing, Germany needs power. They said they're not going to fire up uranium, no more coal. Natural gas is really the only way they're going to power themselves, and if they cut off the supply from Russia, they're pretty much screwed. So I guess the question is, if the U.S. decides to pull away from Russia, will Europe and everyone follow suit? And then we know time and money kind of heals everything, and then everything will go on how it always was, maybe 5-10 years down the road, maybe 2 years down the road. So I guess the question is, what's the most important thing to the U.S.? My standpoint, it's who's the regime in there, and the most important thing are the votes. Now, what do the U.S. people actually care about? This is going to be controversial, but I think 3 things: it's guns, it's beer, and it's cars. And if you have the war in Russia, your price of oil goes up. So all of a sudden, you can drive less, and more of your money is actually put towards driving those cars and less towards actually buying the beer. Second thing, if the cost of wheat goes up, obviously beer price goes up. That hurts the American people. And lastly, guns. If you cancel the war in Russia, you got all this oversupply of guns that are now going to be in the U.S., and that means more guns to U.S. people. So technically, if you cancel this whole war in Russia, I think you'll get a lot more votes either for the Democrats or the Republicans that want to come in. So I think actually canceling the war actually would be supportive of the U.S. people. So that kind of leads me to think, I think we're actually a lot closer to actually ending this than people think.
Well, if you had more mature, sensible leaders in the White House, that might be a true statement, but unfortunately we don't. I mean, Biden has, I lived through the Clinton administration, the Obama administration. I didn't agree with very many of their policies, but it was kind of a respectful disagreement. What I mean by that is they had a view, I had a view, others had a view. You could have a debate. You could, go on TV or a presentation or whatever and argue both sides and let people make up their minds. And again, the disagreements were real, but the ground rules were you could debate that. That's not true today. I mean, Biden is so ideologically driven, and that's the key to ideology is there's an idea, and the idea is more important than the reality. Now, in the long run, reality always wins. But in the short run, the idea can go very far, contrary to reality, contrary to what a lot of indicators are telling you on its own. So we have, Mayorkas, Jennifer Grantham, Gina Raimondo. They're not just lightweights; they're gross incompetence. So I don't hold out much hope that Biden will do what makes sense. It's one thing to gamble and lose. Okay, I lost. Better luck next time. But Biden just doubles down until he gets to a point where you have a fiasco like the Afghanistan withdrawal. I don't want to debate withdrawing from Afghanistan. I think a lot of Americans like the idea that we got out, but how we got out. Did you have to have 13 Marines and sailors and soldiers killed on the way out? Did you have to drone a car with 7 children because you wanted to pretend they were terrorists? Did you have to give up a multi-billion-dollar facility in Bagram Air Base? So you had to go to the airport, the local airport, which is far less efficient. So they just compound their blunders. And so I guess, could there be a better solution? Yes. Will there be? I doubt it.
So we're talking a lot about politics. Let's get really quickly before we end this into metals, mining, commodities. What are your 2 favorite commodities moving forward in the next year, 5 years?
Well, I'll say gold and silver, but the reason is I tend to approach it from a monetary perspective. Now, I have invested in mining operations that has actually, knock wood, worked out fairly well. I'm privileged to be associated with some of the top mines in the field. I've also been invited to give presentations, not to mention names, but some of the big, gold trusts, et cetera. So I'm pretty familiar with the field, even without having the engineering or geological expertise you need. It's hard to think of a real loser. And what I mean by that is so many of the strategic metals come from Russia. They just do. And I mentioned some of them: platinum, palladium, aluminum, titanium. I don't think I mentioned titanium before. That's another one. Copper, try building a building or running wires, et cetera, without copper. So they're all either in short supply or the price is skyrocketing. So there are opportunities there. I don't, again, I do focus on gold and silver a little bit, or not a little bit, a lot, because I approach this from a macroeconomic point of view, not necessarily an engineering or mining point of view. I will say the following. The price of gold today is about where it was 2 years ago, not much different. Now, ups and downs, yeah, it went up to 2069 in August 2021 and hit like 2040 and early March 2022. There were some dips, some smashes along the way. Sorry, I said August 2021, I meant to say August 2020. There was some smashes along the way and got down to 1678, per ounce. But the main trading range is kind of between 1800 and 1900. It's stayed very much in that range for over 2 years, and when you factor out the peaks and dips, it's about where it was. And it's very frustrating for gold investors. Now, if you can run a mine that produce gold, high grade ore at $900 an ounce, good for you. You're going to make a lot of money, even if the price of gold doesn't go up a lot. But if it does, those mining investments are going to be worth a lot more. I think we all know that mining stocks are a leverage bet on the underlying commodity, versus the commodity itself, it'll just go up or down with the commodity, unless you're using leverage in trading. But a mining stock will go up more or down more, along with the volatility in the metal itself. So why aren't gold prices going a lot higher? So, you just look at what we talked about for the last hour. So war in Ukraine, there's a global financial war, China is imploding. We're probably in a recession. We didn't even talk about nuclear war, but we're dangerously close to nuclear war, the greatest danger since the Cuban Missile Crisis in 1962. So people say, well, gold is a safe haven. Why isn't gold going to $2,000 or $3,000 an ounce in a world where they're moving off? The answer is that there are a lot of factors that go into the gold price, and we know what they are. Interest rates, exchange rates, capital costs, other transportation, logistics, inflation, et cetera. But the number one factor is the strength of the dollar itself. And what I mean by that is, people say, well, did gold go up or did gold go down? I said, gold didn't do anything. Gold's gold. Atomic number 79. It's a metal. It's an element. It doesn't do anything. When people say the price of gold went up or down, what they're really saying is the dollar went up or down. So if the dollar price of gold goes up, it means your dollar is devaluing. If the dollar price of gold goes down, it means the dollar is getting stronger. In other words, look at it from the other perspective. Don't think about, is gold stronger or weaker? Ask yourself, is the dollar stronger or weaker? Because if the dollar weakens, the dollar price of gold is going to go up a lot. And so the easiest way to forecast gold, the dollar price of gold, is to forecast the dollar. Will the dollar get stronger or weaker? Now here you run into a different problem, which is people don't know how to measure the dollar. They look at DXY or the Bloomberg Dollar Index or the Fed Broad Trade Weighted Dollar Index. They're all available, but none of them are meaningful. I mean, if you're a trader or you're in foreign exchange markets or you're export-import business, yeah, of course you care. But none of them are meaningful measures of the dollar. The reason is that in those indices, all you're doing is comparing one currency to another. Mainly the euro dollar cross rate, which today is around $1.07. It's been as high as $1.60. I was in Europe once when it was 80 cents, around 2000. It was great. Went to the best restaurants in France and couldn't spend $100 a night because the euro was so weak. But it's really stayed in a narrower trading range most of the time, between $1 and maybe $1.30, and not too far from where it originally came out in 1999 at $1.16. So the point being, looking at two currencies, yeah, they trade in a range, you can forecast them, but major currencies don't go to zero like a bankrupt company, and they don't go to the moon like Apple stock. They stay in this range, and they're all on the boat together. Look, discussing the euro US dollar cross rate, or sterling or Swiss francs or rubles for that matter, it's like two passengers on the Titanic arguing about who has the nicer cabin. They're at the bar saying, well, my cabin's nicer than yours. No, it's not. Yeah, but you're all in the same boat and you're heading for the same iceberg. The iceberg is gold. So gold is the only way to measure the value of a currency objectively without using another currency as a frame of reference, because they're all the major currencies are in. There's never going to be a world where the dollar collapses. People lose confidence in the dollar, interest rates are skyrocketing, the price of gold is skyrocketing. Everyone says, get me a euro. That's never going to happen, because if the dollar goes down, the euro is going to go down with it. And the same thing with the Swiss franc and pound sterling. They will rise or fall together. Now they fluctuate when you compare one to the other, but gold is your only objective measure. So if you want to forecast the price of gold, do yourself a favor and forecast the strength of the dollar measured objectively and not subjectively against other currencies. And there, I don't think there's any question that the dollar is going to get a lot weaker because of fiscal irresponsibility, economic headwinds, budget deficits, modern monetary theory, high debt to GDP ratios, a whole long list of factors you can look at, all of which are pretty negative for the dollar in the long run. So I would expect a much higher dollar price of gold.
Yeah, I'm pretty bullish on the gold price. If you looked at between 2013 and 2019, I think it averaged $13.50, and then next thing you know, in 2020, it's over $2,000. If you look, Jim, at the gold price right now, it's doing really well. I was down in South Carolina at a wedding, and some guy ran a hedge fund was telling me how great his fund had been doing. It was down 11%. So he compared to the Nasdaq that's down 22%. So even if you're flat, you're doing pretty darn well investing in gold. So if you can say you're flat on the year, people will be asking, can I invest it in your fund? So that's pretty good there. You add in contagion in there, people selling it as well to get their margin calls. I think you only have upside from here for gold. So the fact it's able to stay flat during these tumultuous times is very bullish. So look, it could be $2,000 right now, but before you know it, it could be 3,000. I guess that brings me to the question. You mentioned this, that I hear all this stuff about the inflation. So I guess the question is, and you kind of answered it, if you want to invest in the miners, they have more torque to it, can go up a lot more faster, but the safer bet, still long-term good, is the actual physical commodity. Now, what if you start mixing in inflation there? Because it's all about growth. So if you can't build those mines, or you can't forecast how much they're going to build your mines, you kind of lose your pipeline for growth. So does that kind of ruin the whole thesis to actually invest in the miners to get the torque if they actually can't create the growth or even produce that metal at a price that's going to give them a profit?
Well, in a world, one of the interesting things about gold, the reason gold standards have worked historically is, the price of mining can go up or down, but that tends to be reflected in the price of gold itself. In other words, if the mining inputs, so labor costs, energy costs, transportation costs, et cetera, are going up, well, what kind of world is that? Well, that's the world of inflation, which means the price of gold should be going up even more. So, and the opposite's true. If all those prices are coming down because you're in a recession, then one should expect the dollar price of gold to go down. Also, although gold, you could have a world where the dollar price of gold is going down, but gold is outperforming everything else because stocks are going down even more. And don't overlook that possibility. So, the fact that mining input costs are going up because of inflation is not a major headwind or impediment to investing in gold stocks, because it suggests and strongly that the price of gold itself will go up. But there are headwinds now from other sources. One of the questions you could ask, so why is the dollar so strong? I said strong dollar is the headwind for the dollar price of gold. They're kind of the same thing. Why is the dollar so strong? Well, the answer there is, behind the curtain of the global international monetary system, there's an emerging global liquidity crisis. Now, it's not here yet. It's not full blown, but it's happening. You can see it in inverted yield curves, the 7 to 10 year sector yield to maturity and the US Treasury curve, as well as the Eurodollar futures curve, which no one looks at except for professional traders. But go look at it and you'll see, because the Eurodollar futures curve is interesting. Those are long-term bets on short-term rates. It's basically an overnight rate, but you're betting where it's going to be a year or 2 years from now. So highly revealing, very good track record from a forecasting perspective. And that is steeply inverted beginning about a year and a half out, which is not that far away. So that's the market. And these are real contracts with real people betting real money, institutions really, and professional traders. So what that's telling you is that, do we have inflation today? Yes. Are prices going up? Yes. Short-term interest rates going up because the Fed's raising them? Yes. But looking at it, not that far, a year and a half, 2 years, the market expects lower interest rates. So what does that mean? That shouldn't happen. I mean, that's an inverted yield curve, but that's not normal. So what does it mean? The market's telling you that, yeah, all those things are happening now, but they're going to reverse pretty in a recession, and interest rates and prices are going to come down. So that means a weaker dollar and a higher dollar price for gold. That would be one of the consequences of that.
Well, I work for the War Group. We're a collection of junior exploration companies, folks predominantly in safe jurisdictions in Canada. And I believe in the torque with the miners, but I really do believe that, finding these deposits in safe jurisdictions, Australia, Canada, US are the key. Now, I really actually think the most torque are actually in the exploration companies, because these companies, there's gonna be more and more demand for the commodities, whether it be gold, nickel, copper, uranium. But it's going to be very difficult for these miners to actually keep up with the demand and actually find those deposits in safe jurisdictions where they're not going to be afraid of it being privatized. And we have famine happening all over the world. In Africa, what keeps the government of Burkina Faso, Mauritania, for example, from privatizing your mine? So that's a bit of a plug for our group, but that's why we believe so strongly in the exploration business. And that's why we're focused on great commodities that are located in safe jurisdictions. Now, before I let you go, Jim, I have one final question. And we kind of touched on it earlier, but we have an energy crisis that's already hit us. People think it's coming. We're right into it right now with oil, the price it is, et cetera. And we already touched on Germany's issues. But I believe the greenest metal, literally and figuratively, is uranium. It's actually the key to electrifying the world. You need the copper to bring the energy to different places, but you actually need the uranium to actually power the world. And it really is the greenest metal, not only because it is green, but quite frankly, the only CO2 emissions it has is during the construction phase. There's very little CO. Can you hear me? Sorry. There's very few CO emissions once you actually start producing the uranium. So I guess, Jim, what do you think about uranium? What's your long-term outlook on it? And why haven't people embraced it? Why isn't uranium everywhere? Why aren't people building these modules everywhere, these reactors? I'm confused on it. You're an expert. Just give me your thoughts, please.
Well, technically, it works exactly as you described. France is an example of a country that has built quite a few reactors and gets a significant percentage of its electricity from nuclear reactors, and accordingly, it's less dependent on Russia in terms of oil and natural gas. Japan shut down all their nuclear reactors after Fukushima in 2011, but they're beginning to reopen them. Literally, there was some announcements this month. So technically, it is a solution. We don't have time to turn this presentation into a climate change discussion, but the evidence is very clear that human emissions of CO2 have no clear impact on the climate. Climate does change. I used to live on Long Island Sound. It's a beautiful body of water, but had a rocky shore because 10,000 years ago it was a glacier. So now you can go sailing and go fishing. But so climate does change, but it changes slowly. It changes for reasons that are not well understood. Some of the causes are ocean currents, volcanic eruptions, sun cycles. So there are a number of causes, and it's all worthy of study, good science. But the propaganda from the greenies is nonsense, and they're the climate alarmists. So if you were objective about all that, you would be building more nuclear plants for the reason you mentioned, and you would need enriched uranium to power them. The problem is political. It's what I referred to earlier. It's the ideology of green, the ideology of anti-nuclear, ideology of electric vehicles. It defies common sense. There's plenty of statistics and data that says that that's not the way the world is going to go. But it will go that way, at least in the short run. And you're going to have a train wreck, meaning people are going to have to freeze in the dark before they finally wake up and say, maybe this isn't working out so well. So long run, it is a solution. I think technically your description is correct. But in the short run, there are just some serious political headwinds. Now, so from an investment point of view, how far do you want to lean forward? 5 years, 10 years? Well, maybe it's how long it takes to build a nuclear reactor. So maybe it's not a bad idea to get in now, but in the short run, we won't get much relief.
I guess the end of the question is, do the American people or people in general care more about the environment or their pocketbooks? And I think the answer is the pocketbooks. When the Nasdaq's down 2% one day, I don't think people are really worrying about the trees. So I think that gives you an indication of what's going to
Yeah,
happen.
Uh,
I don't think there's things mutually exclusive. I think you can care about the environment, and the difficulty is when you talk about the environment, are you using real science or pseudoscience?
All right, well, there we have it. Jim, thank you very much for your time. You gave us well over an hour, which I really appreciate. I have so many more questions, but hopefully we can do this again. So this is Jim Rickards, New York Times best-selling author, economist. Thank you very much. And if there's the one last takeaway you can give people that are participating in Ore Day 2022, what would it be?
Even under very adverse economic scenarios and geopolitical scenarios, there are always ways to make money. So you just have to you have to have good forecasting, understand what's going on, and then look for the opportunities.
Thank you very much, Jim.
Thank you for joining us today for Ore Day 2022. We hope you enjoyed today's presentations, and we look forward to speaking with you soon. For more information, please visit us at www.oregroup.ca.